grounded on what they were so famous for, which is innovation, entrepreneurship, and real greatness. But the bilateral trade agreement that India and US have are under discussions. So let this get finalized. For now, the healthcare services per se is not in the purview. And I think that there was some amount of focus required from an America lens. However, to do it from the perspective of a global and a futuristic lens is what we would be hoping for in a country that all of us appreciate and partner with, which is the United States. I believe that the pharma industry in India is strong, is capable, and is a contributor to the world. And the problem of the high prices of drugs in the United States is not merely based on the input cost from India, but on various other considerations of the mechanism of procurement of drugs. And I'm sure that, look into that will create the appropriate kind of alignment on the fact that healthcare should be affordable and available to everyone. And sometimes in India, we don't realize how lucky we are to have healthcare so affordable and accessible.
Well, let's see if healthcare kind of escapes the sell-off today, but it looks like it's going to be a rough ride. It may not be 21,500. I mean, let's wait for these rates to settle because the pre-open will be all over the place the first 3-4 minutes. I would reckon at 908 might be a clear indication. It would well be 21,500, I don't know. But let's wait and watch what happens there. We'll revisit those levels for sure. But like we said, there are a few voices that have come in, right? So let's start with the Goldman view on India. We'll get those graphics up on the screen. They see a 2 to 3% impact on earnings growth in India over the next couple of years owing to the tariffs. No, so not too much. It's just 2 to 3% impact. They've already lowered the below consensus earnings growth forecast for 2025 and 26 by 2%. They now expect 11% and 14% EPS growth for 2025 and 2026. I would reckon that would probably mean FY26 and 27. And the 2026 forecasts are now cumulatively 4% below consensus already. They've lowered the 12-month target for the Nifty to 25,000 from 25,500 earlier. So nothing too dramatic per se from one of the key global houses which looks at India very, very closely. Bear that in mind. So that's the Goldman view. I wonder if the charts on pharmaceuticals, Kushbora, are very disrupted. And assuming you take into account that all of these stocks will start 3-4% lower or 5% lower, where is it that there might be supports? Is pharma a place like that?
So first, I like the idea, which is Torrent Pharma. This stock has actually held its ground for the most part. We've discussed this as a call in the past as well. It's holding its ground. The 200-day moving average support acting up, and you could see some sort of a recovery much sooner than some of the other names. However, if we just broaden the horizon a little and go from pharma to say healthcare, I think that's where most of the trade lies, where the likes of Apollo Hospitals or Narayana Hrudayalaya, so these are some of the names, of course, domestic facing. They've seen good price action as well. I think these are the stocks which I would have focus on. Pharmaceutical stocks not so much. A lot of them are quite divided. But if you want to pick one, then Torrent Pharma. Other than that, the likes of Apollo and Narayana Hrudayalaya are where you want to place your bets.
Okay. One of the stocks that moved quite sharply on the heavyweight side, Reliance Industries on Friday, and we have to talk about it today as well. Like a lot of other stocks, down about 6% or so. Let's see where that settles. But 1,130, both of you all, I want an opinion, right? So, Kush, on the downside, what are the key levels to watch? And this is going to be critical, of course, right?
Massively. 1200 has been the support for the last 2.5 months. It's every time it's touched that, it's rebounded from those levels. The medium term or rather the long term supports in this case come, and I'm rounding it off, closer to the 1100 mark. It's actually 1115, 1120 thereabouts. But with this kind of volatility, you want to factor in that range as well. So 1100 is the long term support zone that Reliance has. I think from here on at these levels, Reliance also becomes a very interesting buy. Mind you, these are not day trades or maybe something that you want to do for a week or so, but if you want to play for 6 to 12 months, maybe longer, these are the levels where you would want to start putting in some money, at least on the heavyweights like Reliance.
Right. Staying with Reliance, Parag bhai, how would you look at the OMCs taking into consideration the sharp fall that we've seen in oil prices? Because you will see inventory losses for OMCs, but in turn, marketing margins will be a positive. How would you play this game, and what would you advise?
So I would see, looking at taking a broader view, I would like to say that, see, just to extrapolate what is happening today, it will be very, I would say, I would be a very casual approach, because see, there are first order impacts and there are second order impacts on everything. Like the first order impact is, as we said, that Tata Motors has stopped shipments to US, right? That will get affected. So IT is going to get affected. Metals are going to get affected. But at some point, everything gets impacted if this continues for long. So I would not it might be a good trading opportunity in OMCs because oil is falling. But who knows, what government does, whether government allows them to earn those marketing margins or puts excise duty and collects money, or this time chooses to pass it on the benefit to the consumer, which is badly required in my view. Because see, look at what China is doing. They are sending a clear message now. They want to strengthen domestic consumption. That is what India should also do, and that is what they have started doing from budget, right? To increase the tax slab, then RBI infusing 3,20,000 crore, then repo rate cut. Another repo rate cut is surely expected. In fact, I would pitch for a very aggressive stance by RBI, turning it accommodative and cutting interest rates more actually. Although I know that everybody is expecting only 25 bips rate cut, but actually we need more in my view. Because you need to stimulate your own economy aggressively, and monetary stimulus is the best way to do that. Fiscal, you have limited, and see, if the global recession really plays out, your tax collections will fall.
Yeah.
So you have to be cognizant of the fact that you have to push it through monetary stimulus.
Yeah, the argument is that the fiscal is already done through the tax cuts that have been announced. Let's talk about, and point well made, Parag bhai. Let's talk about our big brokerage call of the day. MK has initiated a buy call on Feno Payments with a target price of 300. And Harsh is joining in to tell you about why MK is bullish on Feno Payments Bank. Harsh?
Well, yes, 30+% upside on a day like this surely catches the eye, right? So let me first start off with what MK's views are with regard to the business. One, they believe that Feno has built a unique business. It's asset light in terms of focusing more on payments, and it, of course, onboards merchants and thereafter cross-sells products to customers. That's the current model. They believe that small finance bank license is what Feno has applied for, will likely be a lever with regard to growing the lending business and the fee business. So they'll be able to do credit cards, they'll be able to also do lending in a larger fashion, which should aid the numbers going forward. So in terms of business prospects, that will be a big shift. Currently, one is it largely currently focuses with regard to its CASA product as well, which is 25% of its top line and contributes a large chunk to margins. Unlike others, it's a profitable platform, and therefore positive overall with regard to this one. Valuations also seem reasonable at 20 times FY27 price to earnings as per the target price. That's 300 rupees per share.
Got it. But on a day like this, clearly out of whack. Thanks, Harsh, for pointing that out. But look at the downsides today. 908 has happened and the pre-open rates indicate bloodbath. 5% for the Nifty. So somewhere wedged between 22,000 and 21,500. Exactly out there, right? On open itself. IT. Let's pull up IT, Nifty IT and Nifty Metal and see what's happening there. 6.5% for Nifty IT, and Nifty Metal should come up on your screen and wonder what that index is going through after the kind of carnage that we've already seen. 8.5% for metals. Nobody will be spared. Maybe FMCG and staples of the domestic themes might be slightly better spared. Now, Parag Thakkar, come in on this. With the safeguard duty in place, steel companies, right? I was thinking of Tata Steel, for example, got clobbered in trade in Friday, likely getting clobbered today. Let's get up Tata Steel stock as well.
Sure.
But Europe spending, positive for Tata Steel. US exports, positive for Tata Steel. Doesn't get impacted too badly. The stock is getting clobbered.
Yeah, because
is this a chance to buy?
Yeah, I would say that put little bit. So I would put in little money to work in metals also, because as you very rightly said, there is a 12% safeguard duty, and at least before Trump reciprocal tariff came, in Europe also there was a price hike of 10% by ArcelorMittal. See, right now what is getting priced in is a global recession. And in a global recessionary scenario, you would definitely say that metals will take a hit and the metal prices will correct globally. So that is what is getting priced in. Let's see how situation plays out.
So soon then? Why go out and put in money right now?
So basically, see, as a fund manager, you have to deploy money when there is bloodbath. You cannot shy away from it, because nobody knows the future. Right, exactly. Who knew that Trump tariff will? Powell himself has said that the tariffs which were imposed by Trump were more than expected, and that is why he is expecting sustained inflation, and that is why he is not ready to cut rates. Right. So I am saying that the things can evolve, but you have to buy on such a sharp fall day as a fund manager if you have cash. Luckily we have cash.
Okay. So basically, two sectors that you're calling out right now. Few of the stocks, TCS from the IT pack is what you've said. Metals is a sector that you're calling out as well, which could be a buying opportunity.
As Dheeraj rightly said, I'm saying only steel right now. Of course, Hindalco also has a good Novelis business, but let's see how it gets impacted in this entire thing. But I would say that, and see, again, this is a portfolio stock, so I can talk about it. JSW Steel. Now, in JSW Steel, when there is a global recession kind of thing, even if that happens, even iron ore and coking coal prices will drop. So the point is that spreads, which were likely to increase due to the safeguard duty, which has already increased and which will get reflected in April, May, June quarter in my view, we need to see how the spreads get affected actually.
So with all of this said and done, we've not spoken about the banking sector, Parag Bhai. All of the sectors, any downfall, you are going to see an impact coming in terms of banking, right? Because of the US markets. What would you advise? Because that has been a sector which did see buying interest from FIs right now.
Yeah. So see, I have one thing which is there is that one is valuation. On banking, valuations are very comfortable. The only thing is that the banking has not fallen in the last fall. And now that global recession is getting priced in, I would say any rational banker would be very cautious in lending. So the growth will get impacted. Already it was getting impacted due to CD ratios, high CD ratio in some of the banks. Now they'll be very selective in lending, right? Because the global scenario is playing out that, for example, you are lending to exporter. Now that exporter comes into problem, right, due to these tariffs. Now you will be actually monitoring it very closely and lending, right? So those guys, and some of the irrational lenders will suffer even more because they'll lend and they'll find themselves in a problem because afterwards there'll be asset quality issue. So I am saying that the bank nifty or I would say banking space has not fallen that much. So they can fall in this last leg of big fall.
Okay. Kush, you want to add less than a minute left for an answer though. Anything that you're seeing on the screen, of course, it's a sea of red. Practically everything is in the red. So what would you do in this market?
Wait it out. Wait it out for the first 15 minutes, 30 minutes. See if the fall gets extended to 21,500 levels, or do we try to reconquer the 22,000 mark? But as I said in the beginning, this is the storm which you want to just see it out.
You want to weather it.
Yeah, absolutely. Yeah. So just wait it out. Don't be in a hurry, because the reaction that you'll have today will most likely be an emotional one, rather than a logical one. So just wait it out.
Guys, there is literally bloodbath on the screen. So Persistent Systems is down 10%. A lot of IT stocks are down between 10 and 15%. You don't usually see such moves in these pockets, but there is clearly, the odds of a US recession rising to 67% as per Kalsi, probably leading to some of the US exposed companies to really see getting battered. But let's not try and separate the wheat from the chaff. Almost everything is wheat or everything is chaff today, because the correction is unanimous. Here come the first trades. I shudder to think, how bad can it be? Well, 1075, 21848 or 21859 across the board. Banks may be a lot lower or quite lower than actually the benchmarks, but bring up the IT index, 6% down, metals down 8%. Almost everything would be lower. Mid caps and small caps should also be brutally getting punished. 5% for the mid cap index, small caps 7.5%. This is what a risk off truly looks like. Heat map, all 50 should be in the red, I would reckon. Is there a green? No chance. Okay, Airtel may be weathering the storm a bit better. But look at that trend. it would have fallen, but the kind of update that has come in leads to it even more. JSW Steel 9%, Tata Steel 8%. This is really, really brutal. Volatility, an important one. I thank my producers for pointing this out. 27% uptick in volatility. We're not at the end of it all. Almost everything in the red. There's no point in pointing out individual things, but for whatever it's worth, Tata Motors has news. It is not going to supply to the US until further changes happen. A largely globally trade exposed stock, Adani Ports down 8.5%. IndusInd Bank has updates, and that one, after having corrected so much, is down another 6.5% today. ONGC, naturally so, oil upstream will correct. But just before I hand it over to Alex, I just want to, if I can, just show what BP, HP, IOC might be going through. Bharti breaks into the green, by the way, but that could be interesting, that crude price beneficiaries, Alex, as you come in, could be very interesting ones to watch out for. Falling a lot less, especially HPCL.
In fact, this is on the top of my list. I wanted to talk about this because if at all there was a pocket of strength to be had in this kind of a market, it's because Brent crude at 63 or thereabouts, NYMEX at below $60, you would have hoped that this would have seen a pop, but BPCL down about 4% as well. So there's pain here as well. What else is a beneficiary in this kind of market, arguably speaking, considering that the domestic real estate space is still something to watch? Paints, I thought, would be something to look at this morning because crude oil, of course, is something that affects their raw materials as well. But even here, you're seeing a downtick. PCBL Chemicals, I thought, is also because carbon black has an element of crude in it in terms of the raw materials, still about 8% lower. So everything getting hammered. And how? IT. Of course, Neeraj pointing out the large caps that have gotten hit. There are, of course, from the smaller companies also stocks that are getting hammered in trade, likes of Persistent. Of course, it was down about 10% earlier in the session. Now it is down about 6% or thereabouts and still getting hammered. Delivery had a positive update. Acquisition of Ecom Express. Here too, 3.7% lower. Let's see if anything is reacting to a positive update in the fourth quarter. Bajaj Housing Finance, a strong growth in the loan book, sequentially as much as 6%. Even this is getting hammered, 5% lower right now. GCPL, we spoke about this from the FMCG pack. It was a positive Q4. Okay, less than 1%, you will take that in this kind of a market. Indian Bank, 5% sequential growth in the loan book was seen as positive. Again, this is a stock that is down about 4%. But remember that banks were resilient to a certain extent. Some of that selling pressure catching up with the banking pack as a whole. Feno Payments, the last stock on the list, we spoke about this on Brokerage Radar. And we had an update from MK that saw a 34% upside. Well, that upside is even more right now considering that the stock is down 5%. So guys, it's very difficult to find any pockets of strength. In fact, I would go even into the broader markets and search very hard to find any green on the screen.
Absolutely no green in the screen. But what's interesting over here is we've seen the worst opening since March 2020. However, since opening, there has been a recovery of almost 1.4% that's come in on Nifty 50. So now we're around 21,930. Kush, any levels that now you will be watching out for? And you have Bank Nifty, which has broken 50,000 as well.
So I think what we're seeing as recovery is more of an STBT trade being covered right now. So that's the support that you're seeing. Yes, a lot of these names did see a sharp rebound, but in 4 minutes and already you're seeing some fresh selling coming onto some of these names. So I'll wait and watch. For me, 21,500. That's the level that we've been talking about for some time now, where the markets could make a bottom and then reverse. Maybe with this volatility, 21,000 or maybe a little lower, but 21,500 is where I'm looking at as long-term supports for the Nifty. So wait and watch for that mark too.
One thing.
21,000? Did you say 21,000?
He said that, and you see the Wix 53%. We started off with a 27, 28%. If you see Wix right now, 54, 55%. Parag bhai, what would you have to say in terms of the Wix, which is now up 55%? 21,000 is what Kush is indicating. Buy.
No, so I'm saying that for example, my strategy is very simple, and that if I have 15% cash, I'll be putting 4% today back in the market. Still, I have 11% cash. Of course, the 85% of the portfolio will be down definitely, and that is something to worry about. But I'm saying that what you can control is, what risk you are taking in the market. And that's why we sold on those days when actually market was not reacting to the reciprocal tariff. Actually, market was very steady. And that gave us opportunity to raise cash in the portfolio.
Yeah, but by the way, just keep in mind, viewers, that the US futures are still in the red.
Yeah.
So nearly 900 points for the Dow futures. Nasdaq is still down about 4.5%. So bear that in mind as well. What are AMCs doing? Mihir Vora, CEO of Trust Mutual Fund, joins us right now on the phone line. It's an early morning, and I'm guessing the roads are filled with traffic. But Mihir, thanks for taking this call. And what do you think of this? Not just the reaction, Mihir, but the follow-on action that could happen because of a tariff war. It's not something that we've seen in a long time.
Hi, good morning. You're right, Neeraj. These are unique circumstances, and there are first order, second order, third order implications which will be difficult to fathom. But in general, I would say that it might be a obvious thing. People have said it so many times that India will be amongst the least impacted countries in the world as far as the tariff situation is concerned. And second is that if you see structurally, again, today is not a good day to sound very positive. But the point is that 70% of the equity allocation of global portfolios is in the US at all-time high. The weightages of US markets in the world were at all-time highs, almost 70%. And obviously they've shot themselves in the foot. So there will be a shift away from US to the rest of the world. In fact, in the last few months itself, we saw that Europe was hitting 52-week highs, the European markets, after a long time. You saw some money flowing into China after the Chinese tech situation. So even if, a little bit of global money starts getting pulled out from the US into the rest of the world, then India as a small market will be an obvious choice, first of all, because of our insulation towards exports. And we don't really need that much of allocation because we are relatively a small market. So even a $10-20 billion shift towards India can mean a lot for our market. So I'm not too worried in the long term. The long-term story will not change.
Right, Meet, long-term story will not change. That's right. But let's look at two aspects over here. Because from a retail perspective, a crisis is a crisis. Earlier, the crisis that we saw back then in terms of the taper tantrums as well as Lehman, markets in terms of emerging markets, they were impacted by the capital outflows as well as the currency depreciation. Now you're talking about trade flows, investments, and as well as the potential inflation impact. How would you defer the outcome in terms of the three crises that we are comparing right now, and in turn, the action of the investors?
This is a diametrically opposite situation compared to 2008, I would say, in a lot of ways. In 2008, when there was a crisis, people would turn to the US dollar for safety. The people would turn to the US for safety. This time is the other way around. That time, the inflation problem was in other markets. Here we are going to face a deflation problem, and the US will face an inflation problem. So we are in a diametrically opposite situation to 2008. That's why I'm saying I'm not too worried, with India being among the least impacted markets for exports.
Amir, hi, morning, Alex here. I'm just wondering how your own fund house is setting its strategy, because globally you have so many voices that are saying that we're not certain about how things are going to go, but at least as you pointed out, there is relative certainty in terms of certain pockets of strength in the Indian economy. So would you be deviating more towards the India-focused businesses and companies?
Certainly. In fact, I've said it so many times, and the portfolio also shows that. We've also discussed it so many times, that our call anyway has been that, related to the rest of the world, the domestic economy will do better. So India, obviously, before this crisis, was expected to grow at 6.5% GDP growth rate for the next couple of years, which was anyway much better than the rest of the world. We are anyway not exposed that much to the export situation, except for IT exports. So our dependence on the global situation is less. In fact, with the commodities crashing and oil prices crashing, it's actually a bonus for us. So we've always been more positive on the domestic consumptions as well as the domestic cyclicals, and we've always been negative on large cap IT, especially because we thought that they are single-digit growth rate stocks in any ways. because of the long-term earnings trajectory that we saw. And in the last few days, we anyway had reduced a bit more on that. So in terms of positioning, we are very much domestically focused, obviously, but when the market crashes and, beta doesn't work, obviously it doesn't work. But we scanned the portfolio again and again, in the last 3 days, we've been doing nothing but that. But there's nothing that we really believe that we should sell based on fundamentals. There might be pockets of overvaluation, but it's more for valuation rather than fundamentals. So we are that way quite domestically focused in our portfolios. But when the market crashes, obviously everything goes down.
In a situation where the boat is rocked, Mihir, and you are obviously handling small retail money, and you've seen consistent flows, but at the same time, over the last few months, there has been a little bit of a question mark on the durability of, or not durability, but at least on the SIP front, you have more money going out than coming in. And the first time that we've seen those kind of net negative inflows into SIPs, right? So do you think that the industry as a whole will be able to manage comfortably the kind of redemption pressure that could come through? Is that something that you're anticipating?
I don't know why you guys keep raking up this issue of redemption pressure. In the worst of the crisis, we've not seen redemption. We've faced so many crises as an industry, as a market. So I think the question is less relevant, far less relevant now, because we have seen cycles and there have never been panic redemptions in the market. We've seen that so many times now. But SEBI has also, SEBI norms of liquidity of the portfolio, etc., are also being observed and all that. So for the equities, I don't really see a problem, frankly. Our market is quite liquid.
Right. So, Mihir, taking the liquidity into consideration, the crisis into consideration, and your focus to the domestic market, we were talking to Parag Bhai, he's saying, again, cement could be a sector we should be watching out for. Which other sectors do you think would be the ones that could probably make money, taking valuations are cheap, and if you have money on the sidelines, could be deployed at current levels?
Certainly. So I think Indian financials are, amongst the safest in the world, especially the large banks and large NBFCs. And valuations had corrected in any case over the last couple of years, so it as a relative basis. So that's one big safe pocket that I see as a local investor or even as a global investor, if I were to see. It's a very good pocket. My also sense is that if this crisis, really rolls out and becomes worse, then we'll be back to government-led stimuli. Government and central bank-led stimuli over the world. So we'll see lower interest rates faster than expected. You may see a flood of liquidity again being created by central banks, and you will see again government coming into the fiscal stimulus mode, so to say. So I think all those tools which were used and which can be used for fighting a shock, external shock, so to say, the playbook will come into play. And so to the extent you might also want to see, exposure to domestic cyclicals like the government spending linked segments in infra, etc., which are high beta, so they're going to get, they're going to go down a bit more than the rest of the market because of the beta. But that's when the opportunities get created.
Okay, Mihir, and what if the Fed forces the RBI's hand to stay pat and not go ahead with a cut because of the global uncertainty? Now, I think everybody's baking in a rate cut from the RBI next week or this week, right? If that were not to happen, is that an added negative for risk assets? Part one of my question is that. Part two is, can the uncertainty drag the markets much lower than long-term average valuations? Everybody's talking about 18 times and we are already there. Why should we be there only at 18 times? Why can't we go to 17 or 16 times in these uncertain times?
We could. Everything is possible. But again, why would the RBI go hawkish in a situation where inflation is not our problem? As I repeat, the inflation problem is going to happen in the US because of tariffs. We are not the ones imposing tariffs. We are the ones who are proposing to cut tariffs. So the inflation problem, if at all it happens, will be in the US, not in India. And in India, obviously we have kept liquidity tight for so long, and we are just beginning to ease the liquidity situation. So it would be too premature to kind of talk about any kind of change in that stance. Plus, the dollar is anyway weakening. So let's not, I'm saying, I repeat myself, this is not 2008 kind of a situation. It is reverse. Here you are talking about the dollar weakening, not strengthening.
Got it. Mir, not appreciate this. I mean, this is sane advice. Just that the markets seem to be insane currently, and therefore you can't take away the fact that there is a reaction that is very, very sharp. Thanks so much for joining in, Mir. Really appreciate your time today.
Always a pleasure. Thank you.
By the way, guys, wonder, just pull up trend. Did I see a 15% downtick on it? I mean, individual stocks, a lot could happen. 15% for Trent. That's a really sharp one. I don't think Trent has seen a 15% downtick in a really, really long time. We'll get those data points outgoing. Tata Steel is down 10% if I'm not wrong. A clutch of other, I want to see what Persistent is up to, was down 10% on open. I think recovered a little bit. Is it still down? Okay, no, 5.5. So some of the IT stocks, I wonder if Infi, TCS, etc., because that's a bucket that had fallen quite a bit already. It's kind of showing some bounce from the lows, but that might only be from the lows, if you will, still down about 4.5%, 5%. So looking slightly wobbly. Look at that list. Thank you for pulling that up. Coforge, Infi, HCL, everything gone. Okay. Now, Kush Bora, I don't envy your job today. But no, I mean, there's pain on the screen, right? So we got to respect that. And therefore the question is, at 22,165 for the Nifty, it seems to be wanting to defend that 22,000 mark, right? Because we started way lower, and from the lows, the Nifty's really bounced. Is this a positive sign, or would you wait for the day to pass?
No, so I'll go back to the opening comments that we made, that, if we close above the opening level, which now happens to be 21,750, or just to simply put 22,000 mark, if we close above those levels also, this will be a big win. Right now, we've recovered, but as I said, this could well be the STBT trade, closing itself out, and you're seeing that short covering bounce come in, more of that. But yes, if we are able to sustain above the 22,000 mark, that will be a big positive. Banking stocks might actually, help the Nifty hold that level, or maybe climb a little higher, because the recovery on those has actually been quite healthy, and there's a lot of margin of safety there. So you might want to consider perhaps a long trade on Bank Nifty, not just yet positionally, but from at least a recovery standpoint. So 22,000 being held on the Nifty is a very strong sign. At the moment, the put base also that you're seeing, pile on at the 22,000 mark, the 22,000 put, about 84 lakh odd contracts, that's also a very healthy sign. So 22,000 being held, we'll take that as a win for the day.
Okay. So I'm just wondering, Parag bhai, on Larsen & Toubro, we haven't spoken about it. It's down over 5% right now. And Neeraj was making the point, and of course in this kind of market, everything gets beaten. But Neeraj was making the point that the government likely spent a lot more in March. And as a result of which the whole year's target for capex spend is actually likely gone past their target. In that context, and heading into the new year, where you're likely to see a lot more focus on government spend, on domestic focused entities, what would you do with Larsen & Toubro?
So as I said, that we encashed on that Thursday and Friday when it was holding on, Friday morning I would say. But definitely, as I said, I was waiting for this kind of fall to happen and to deploy money. So now from here on, there is no need to sell in my view. Of course, Nifty can go down. Yes, the answer is yes, it can go down, because it's till the entire thing becomes certain on the tariff side, which will take some time, because as Trump has said that he wants at least a break-even trade deficit with every country, and which is very difficult to and as China has also retaliated, that is why we saw this correction Dow and our markets also. So I am saying that from here on the prices have become juicier. So I would say that from here on I would take a very cautious deployment approach, not selling approach. There is no point in selling as an institutional investor in this kind of a panic.
So Parag bhai, would you be calling this kind of a correction a beginning to the end of the correction now, taking into consideration the fall that we've seen? And apart from the sectors that we've spoken, Pharma has been the center stage again. will India be a beneficiary, taking into consideration the CDMO players, the shift that will happen from China?
Definitely, in long run, that is the case. Definitely, in long run, that is the case. But ultimately, you have to also remember that some of the sectors which are impacted the most, like IT and metals, those also can be good opportunities. On the other hand, I would say that, as I said, the clear winners in this kind of, if this continues for long, will be domestic focused FMCG, domestic focused pharma and cement, because these are three domestic sectors. And of course, the second order impact, which is very troublesome, for example, just to tell you, for example, if IT takes a knocking, the hiring takes a knocking, right? And so the indirectly real estate, consumption, everything will take a knocking. I am not trying to paint a very scary picture over here. I am with investors very much skin into the game. So I would like to assure them that I am in the same boat. But I would say that some of these things, some of these narratives can keep coming.
I want to, while you're at it, let's pull up the realty index just to drive home that point. And the constituents of the realty index, all of them are down, obviously. And this is an index that on Friday had fallen 28% from 52-week low. It's now down close to 5%. Everything from a Soba to a Suntech Realty losing 7% or thereabouts. You have Godrej Properties down about 6%, DLF 6% or so. I take your point, and particularly on some of the Bangalore-based players, if IT goes through a little bit of trouble, then you could have a situation in terms of demand slowing down. But what about your Delhi-based players? What about your Mumbai-based players? It doesn't go out of the window entirely, right? So from that perspective, considering that we're already down close to 30%, maybe over 30% after today, right, from the 52-week high, where would you go and deploy?
So there will be selective stocks, and we also have one or two real estate stocks in our portfolio. So there will be selective stocks which will not get impacted so much. But I would say that, see, right now, today is a day when there is a capitulation, right? So today everything you will get, and that is why I am telling viewers very strongly that, and which I keep saying, that we as institutional fund managers sometimes take a very difficult calls which we have to take to protect the interest of our investors, right? Because protection of capital is most important in such times than return on capital. So I would say that in my view, you have to be very careful and cautiously deploy money and keep some dry powder always.
Okay, Kush, one last word really. Some of the pharma stocks are also taking it on the chin. Anything out there that stands out? We started talking in the show about pharma. Anything that you want to leave us with?
Torrent Pharma, the stock that we discussed, if you see in a market like this is holding ground. Actually, it's in the green. So why not stick to strength and venture somewhere else? So Torrent Pharma is the one that I will have on my radar from a long perspective.
Okay, gentlemen, both of you, thank you so much for taking the time out and being with us and sitting through a difficult morning, I must say. And it is looking like a difficult morning for sure. But it's good to point out pockets of strength from a business perspective. And I think that's what we are trying to do. We've gotten you quite a bit of market opinion and more coming on its way. But I think what's happened in business-wise, because a lot of people say that domestic-focused businesses might not be getting impacted. And one of them could well be energy transition, right? And Hitachi Energy in some sense fits the bill right there. They've gotten a new contract from Adani Energy. The revenue potential and the contract value of the latest order seems to be fairly large. Let's get in Mr. N. Venu, CEO and MD of India and South Asia at Hitachi Energy, to talk about this and more. Mr. Venu, good having you. Thanks so much for taking the time out. And at the outset, congratulations on this. But just a word before we talk about individual tariffs, individual order wins, etc. On this whole tariff issue, from a lot of people are opining that the Indian economy may not get as badly impacted and select pockets might not get impacted at all. I want your view on both of these from you, on the impact on the economy, because you would have a great view out there, and your business. Does it have any kind of an impact because of these tariffs?
Yeah. Well, good morning. First of all, thank you for having me in your show. And absolutely, I echo what you're talking about. India is a very robust economy, consumption-based economy, and especially the area where we are in an energy super cycle, especially in Hitachi Energy is in, and the tailwinds of the energy transition so huge. And if you have seen, our focus has been that we are building this company basically for the domestic demand, and we have been consistently saying that we have a huge tailwinds, and the tailwinds will continue. It is a multi-year tailwinds. In our view, the tariffs are a short-term things, and I'm sure it will settle down over a period of time. But our focus to serve the Indian market will continue even more stronger now.
Okay, fair call. Mr. Venu, for the business that you are in, and I think the Heathrow shutdown has shown the importance of grids per se, if
Right.
it was not evident beforehand. But just wondering, for the business that you are in, how is the business momentum looking like? Do you per se get impacted because of the tariffs at all?
No, first of all, Hitachi Energy in India, our play for the US market is very, very small, low single digit. And even that also, the energy transition related demand is very robust in that US itself. And with the differential tariff, India versus rest of the countries in ASEAN, I don't see at all any impact for us.
No impact in terms of the tariff war so far. Let's talk about the latest contract as well, Mr. Venu, from Adani Energy. What's the revenue potential and the contract value? How do you see it weaving into your P&L and balance sheet?
So again, we have been talking about these HVDC projects, which is it's like a power superhighways. How you build a multi-lane superhighway. So these are the required, in a one single lane, one single line, 6,000 megawatt of power, almost close, which is required to 60. It will serve close to 60 million people, and that kind of intensity it will come. It's a multi-year contract, so we will complete in 48 to 54 months contract, and it's a very big order, so it's almost the size of the one which we have booked in the Q3, and this concluded in this new fiscal year. So this order will come into our new fiscal year, and it will execute in as I said, 48 to 54 months. And the revenue of this in the first year will be very low, and the second year it will start ramping up. Second and third year it will ramping up in that. So the key, what we want to say is that we have seen these tailwinds coming much ahead of the curve, and then we started building up, localizing it, creating the new greenfield factories, and then we are taking the benefit out of that. And today, more than 60-70% of the products required for this particular project manufactured locally in our locally factories in India, and that's a key for going forward in that. So we have the talent here, we have the end-to-end manufacturing, engineering, and completing of this project.
Mr. Venu, one quick question is with regards to this current order, which is the Bhadla HDVC project, right? What is the value of that project? And secondly, the Khavda, Olpad and the Pang Kaithal project are also expected to come in the next 12 months. So the value of both of these.
Yeah, see, again, we since the similar projects are ongoing, so we do not want to specifically say that. But it's quite a big order, 5-digit crore order. So you can just talk about, and it's a consortium between us and BHEL, where we have almost 70%, 70% of scope belongs to us, and the remaining is the BHEL. And in addition to that, we have 2 more projects which are come up for bidding, and those are also almost, plus minus, depending upon the scope and business model, will be also in the same range. And those are also are coming up bidding, and in our view, it will go up for finalization anywhere between 6 months to 1 year to get those orders finalized in that.
Mr. Venu, thanks so much for that clarification. I'm just wondering, at the end of third quarter, 18,994, nearly 19,000 crore was the order backlog. Approximately, where does it stand at the end of fourth quarter? And you've specified for a couple of these projects that the completion is 50 odd months, and that the first year revenue recognition is not going to be very substantial, but it'll kick in. It'll kick in the second year onwards. I'm just trying to understand, when it comes to your overall order book, is that a similar kind of a picture for the rest of the order book as well, where the first year perhaps, and FY26, is not going to see a very large amount of revenue recognition, but the momentum will really come through FY27 onwards?
So as you said, our fourth quarter, we just completed, our results are yet to be declared. But if I really look at our third quarter, 9 months of the last fiscal year, our revenue has grown up almost 26%. And with the kind of backlog we have created at the end of the third quarter last fiscal year, almost close to 19,000 crores, we also see the very double-digit revenue growth going forward. That's what we said previously also in that. And when it comes to this new project, that is the one which Badla Fatehpur project, and that project will come into the new fiscal year, the quarter one of the new fiscal year. And from there, we will take it forward for the revenue recognition standpoint, as and when we complete the activities.
Got it. Mr. Venu, the two questions again, both rolled into one. One, do supply chains get disrupted in any fashion from a cost perspective as a result of all of these ongoing tariff issues? I mean, it will be unclear right now, but is there a possibility that something like that could happen? Part one of my question is that. Part two of my question is, again, I refer to the Heathrow shutdown and how article after article is saying that this brings out the importance of transformers and grids to the fore. Does it enhance the export opportunity out of Hitachi India?
Yeah. So I think coming back to your first question is that, I think it's important that we need to understand how energy transition is moving into that, right? So energy transition is playing a huge thing, huge tailwinds, creating not only from the grid standpoint, but also on the renewable standpoint, but also electrifying. So the grids are becoming more and more suitable for electrifying anything and everything. That's how it's going on that. And the Heathrow thing is a eye opener for everywhere around the world, that we need to create the robust systems. It's not only from N-1 but N-2, so that if something going wrong, then your systems, which are mission critical appliances, applications, etc., will run without anything in that. And that is exactly what is happening in India. Now we see, as part of the Central Electricity Authority's plan of 2032, creating a very robust networks. Not only interstate, but also intrastate networks are going to come in that. So those are all the things are creating a lot of opportunities, not only for the transformers, but also the rest of the portfolio of Hitachi Energy, whether it is HVDC, STATCOMs. How do you ensure that the grids are more stable, more reliable, and more secure, more safe under any given circumstances in that? Because future is going to be electrifying anything and everything, and that should be the hallmark of the design of this power system going forward. And that's exactly Hitachi Energy is playing a major role in creating those technology, bringing those technologies to our customers in India.
Got it. Well, this is really good to know, Mr. Venu, and I wish you all the best for the business, because we need the business confidence out there for the sentiment on the equity markets also to be buoyant, because right now it is carnage out here. But thank you so much for taking the time out, and we appreciate you are in a silent period. Maybe we get to talk to you post your earnings to get a clearer picture.
Absolutely, thank you.
But congratulations on the order wins for sure.
Thank you.
That's Hitachi Energy, and in the limited things that they can tell us, I think we kind of got to know quite a bit. Okay, like we said, we're getting you big voices through the day today. One more in that list is White Oak Capital's Prashant Khemka, who believes that leading consumer companies have barely gained compared to 5 years ago. And he adds that the MNC basket is less volatile and also shares some of the key sectoral things that he would want to keep at the top of his mind in a scenario like this.
I would say the pockets that were, the market is, as you said, barely, it's not like a bear market or anything. We are probably, depending on which index you're talking about, the smaller caps have done worse. Nifty year to date is like flattish to down 0.5% or something. So within small caps as well, there's certain pockets which are down 30, 40, 50%, but they were the ones where they had got overstretched. And now they've come back to maybe closer to what are more normal levels. As a basket I'm talking about, within that some more, some less. Yeah, certain sectors like consumer, the last several years, haven't seen any. Yeah, so in the power sector, in the manufacturing sector, in the defense sector, there was that extra euphoric assumptions that were built in. that froth has been taken out. Otherwise, see, anyways, all the time there are names that become very attractively valued even in the absence of massive correction. And with the correction, you're right, there are some segments, particularly I'm thinking about stock specific. So let's say capital market intermediaries, some of them believe have been beaten up as if, capital markets aren't going to grow again. So when on the team also we discuss, people have become more skeptical. Okay, let's assume a flat market from year to next year, 2 years. How can you assume a flat market? From today, you cannot assume a flat market. Yes, from 3 months ago, okay, you can assume a flat market, the markets are down 10%. So some of these companies where the assumptions have turned very cautious, yeah, there are opportunities, no doubt. Some of the industrial companies where because of a little bit of lull in the capex, the assumptions have become very cautious. Yeah. So there we do find opportunities on a specific basis in some of these sectors.
The MNC ones would never be cheap, right? So they have become cheaper than what they were, but they're not technically cheap.
Yeah. So MNC ones in the industrial sector, some of them have pulled back quite a bit.
Okay.
Obviously, they had gone up like that as well. And there are, again, select opportunities there as well. Whereas on the consumer side, they had never participated. Some of these leading consumer names are barely up compared to 5 years ago.
Agree.
And massively trailed the market.
Yeah.
So MNCs as a basket tends to be less volatile or a lower beta. So they haven't pulled back as much, but they'd also not gone up as much other than the industrial sector.
Got it. Yeah. Actually, so before I come to capital markets, since you brought this up, staple companies, and we speak to a lot of homegrown, India-grown, small food companies, staple companies, who are innovative marketing, specific pockets, catering to urban class, higher margin, etc. maybe, or rural specific pockets, and are eating away the market share of the long-established distribution chains of the pan-India players. Can more and more of this continue, and therefore would large staple companies consistently see their margins and profitability metrics getting eroded and therefore multiples coming off? So they may grow earnings 6, 7, 8% every year, but multiple नीचे आ रहा है, इसलिए भाव नहीं बढ़ रहा है. Could that be the template for the next few years as well?
No, could be. Their multiples have come off quite a bit over the last 5 years. If you look back during the period of 2003 to 2008 time frame, when you had this infra real estate commodity boom, they had seen quite substantial multiple compression at that time as well. And for the entire bull run, they missed that bull run out. Again, they missed this bull run out. So what you're saying is possible that there could be further multiple correction. Impossible to know, but it is possible. What you're saying as a phenomenon is happening, though it was happening back then as well.
पर मैं आपका hypothesis पूछ रहा हूँ, मैं बोल रहा हूँ ठीक है. What is your thought? You understand this far better than most people.
So see, again, as a sector, I would not make that call that consumer staple companies, it is fair to say at this time, our team is finding less opportunities in consumer staple segment, meaning that the allocation is somewhat lower than the market averages. Yet within that, we will search for whatever is the best within that and invest. And then some are doing better job at innovating. Some have a longer tail of products that are yet to, gain the market penetration. Some are more penetrated. Others are just taking off. And then compare that to valuation, you still find some opportunities in staples as well.
Prashant, you manage large pools of money. Surely capital markets and industrials can't accommodate everything. So where is the highest overweight and where is the highest allocation, the top 2 or 3?
Certain. So see, structurally, we have not from a top-down view that this sector would do better or the other, but because of the construct of the sectors, we tend to have higher allocation in certain sectors and lesser in others. So first of all, we have 2 key biases in our portfolio. One is size. So we'll have greater allocation to small and mid, because they're inefficient segments of the market. We do not believe ever that small caps would outperform large caps as a benchmark or index. But because they're more inefficient segments of the market, we can extract more alpha. So benchmark return is the same for large and small. If we can extract more alpha, we can generate higher return in small and mid caps. So that remains the case. We have overall higher allocation to small and mid, which we've always had. Second, so first of all, if I take this small and mid, there are certain sectors which are more small and mid cap heavy.
Right.
Like consumer discretionary, industrials, healthcare, as against, let's say, energy, banking, which are skewed more towards. So that aspect would tend to favor certain sectors. Second, what skew we have is that of governance. Tend to have, I'm not saying we are looking only for AAA governance or anything, but on balance, our portfolio tends to have better governance than weaker governance. Now, there are certain sectors which tend, and there's no such sector where every company is,
Of course.
good governance. So 80-20 rule does apply. Not to name any particular sector, but I think one sector one can comfortably, or worldwide investors tend to agree, is real estate as a sector, where, governance leaves a lot to be desired. Again, at the risk of generalizing, and a lot has improved over the last decade or
But
two.
still, yeah.
But I think nobody takes offense. Real estate managements are the last to take offense because they believe other than them, everyone else is a crook. So let's say real estate as a sector. So we'll tend to have the 80-20 rule. There'll be only 20% of the real estate basket may be eligible for us to invest.
Got it.
On the other hand, let's say IT services, with some exceptions, and they've happened in the past as well. You can say 80% of the IT services companies or more, governance-wise, there isn't a problem. So we'll tend to have a little bit more skew towards
Got
it.
it, okay.
So on those basis, we have large allocations in the portfolio across, would be fair to say, in larger cap lending institutions, financials, banks, and NBFCs and all. Mid cap technology, IT services companies, I was talking about strong execution. In healthcare, not just across market cap, I would say in healthcare, but more particular in the small and mid cap area in healthcare. Healthcare is a very rich small and mid cap segment. Then consumer discretionary, so not staples as much, but in consumer discretionary, there's the largest variety of business models.
True.
It's a very heterogeneous sector. So these four, and some selectively then industrials as well. So large cap financials, mid cap IT, small and mid cap healthcare, industrials again, small and mid caps, and fifth one was, I forgot, consumer discretionary. That again is a lot of small and mid caps are there in that space as well. And
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
Maybe real estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day. Welcome back to India Market Open. The pressure does continue, but what to buy is going to be the question from here on. And for that, we'll have Nilesha who will be joining us as well shortly. But before that, let's understand what is on the table with regards to the pharma pack, because Trump is talking about tariffs on the pharma space in the near future, not in the distant future. What would this actually mean, and what is the outlook for the sector? Joining us on the show now, we have Habil Khorakiwala, founder chairman at Wockhardt. Good morning and welcome to the show, Mr. Khorakiwala. We did speak to you at the NDTV conclave as well, where you categorically indicated as to how resilient or how the impact could come in terms of pharma. The supply chain probably could be under pressure as well. Your first comments with regards to what Trump has said in terms of pharma exports?
Currently, there are no duties on pharma, but what will happen in future only Trump will know. I could mention that the impact, it's not easier for anyone to switch manufacturing from India or anywhere else to US. So in the short term, certainly there would be a price pressure on US consumer and healthcare provider in the US. As far as Wockhardt is concerned, we hardly have a significant presence, less than 5%. And we have planned to exit the US generic business. But many other pharma companies have a very large exposure to US business, somewhere between 30 to 50% of their revenue. And they will have to adjust themselves by maybe a little squeeze in margin, little impact also on the sales, because it may affect, but it will be very, very difficult for pharma industry to manufacture all the products in the US, because it will take several years to do that. And it is a multi-product industry, because we have so many products, so many API suppliers, and many of them are from India and China. US hardly manufacture much of the active substance. So it's going to be a fairly complicated affair, but the end result would be the US consumer and healthcare provider will have to accept a significant part of a burden. And the future of pharma industry from India, who have a very large exposure, they would certainly rethink their future strategy. And probably they would diversify the business a little more away from the US.
This is big, Mr. Khorakiwala, what you're saying. Good morning, Neeraj here, because US has been that mother market for a clutch of generic companies, right? You are saying that will undergo a change, even if there are tariff agreements being reached. Let's say in the next 7 days, if there are some agreements reached, you reckon there will still be a shift out of US into other markets for generic companies?
Yeah, certainly, if you have a 30, 40, 50% of your business in the US, and with so much uncertainty for the future, and pharma is investing in research, and even for generic, and it takes roughly 2-3 years before one sees the benefit of this research. So in the pipeline, whatever is there, it will continue for a while. But certainly companies would revisit their fundamental strategy to diversify much more and maybe look at Europe and other Western markets.
Mr. Khorakiwala, just one more follow-up on this. And, nothing is cast in stone, but I would love your perspective, sir, because you started off this conversation saying it's not very easy to get up supply chains that quickly and easily, particularly in the US with the US FDA issues, etc. Do you reckon, the tariff issue from the US on pharmaceuticals is not quite there. Will it be a very high set of tariffs that could come in, because it will eventually impact inflation as well, and Donald Trump's pet theme seems to be to get interest rates down. If there is inflationary pressures because of medicine as well, that will only add to the woes.
To predict what happens.
I know it's difficult.
It's literally impossible.
But because you understand this industry, sir.
Yeah, from an industry perspective, we currently have about 40% prescription in US coming from many products manufactured in India. So it is a very, very significant impact it has on the healthcare. Secondly, it is not possible to switch from one drug to another drug for the treatment. And as I mentioned earlier, that for a significant part, it is the American consumers and healthcare provider have to rework out the insurance and other things. And anyway, US government takes care of about 50% of the coverage in the United States. So it will cost them also partly.
Mr. Korakiwala, I mean, you've been in the business during the first term administration of Trump as well. And at that point in time, there were tariff threats, which led to, probably promises of US manufacturing. However, everything was again rolled back. From what happened in Trump's first term to now, has anything changed? Because people were talking about capex, facility shifts, nothing materialized. The costs are almost 5 to 10 times higher as well. And this was something that could be impacting businesses. How would you differentiate between these two episodes?
They are entirely different. What happened in the Trump 1 and Trump 2 that everyone knows. This is a very fundamental shift. And it's not only manufacturing in US. Our competitiveness arises because of India manufacturing and overall low-cost manufacturing. Now, once you shift your production to the US, your competitiveness as an Indian company no longer is valid because your cost structure would be identical to anybody else manufacturing in US or Europe. So it asks for a very fundamental review of a business model for our industry, those who have a very significant stake in the US. So what to do in future kind of a stuff, basically.
Got it. Okay, sir, one question on Wockhardt itself. You must be in a silent period. I appreciate you can't talk much, but is business looking like being as usual and in an uptrend, or is the uncertainty currently caused by tariffs impacting you in any fashion whatsoever?
I must say we have been fortunate that we hardly have any US business, and we have already taken a position to exit it over a period of short time. So what happens in the US and the tariff, we are totally not affected. So in other words, our fundamental business model of focusing on new drug and biologicals in the emerging market is sound, and it is not going to be affected by this US-led tariff war, which is happening worldwide. However, as far as the new molecules are concerned, I don't think the business would be affected, and we would see as our products comes nearer approval.
Right. Very lastly, Mr. Korakiwala, as you mentioned, I mean, around 5 to 6% is the kind of exposure that you have in the US. You're looking to exit that. Overall, what's the kind of P&L impact that you will see overall on the back of the exit in terms of the US business?
It will be positive because we are losing money in the US today.
Okay. And to what quantum? Anything that you could tell us?
It's a little too early to tell you that, basically, but it is not profitable business, and we are losing significant amount of money in our US operation.
Right. So that's overall with regards to where exposure to US goes as well. But thank you, Mr. Korakiwala, so much for joining us on the show and sharing your views. Clearly, Neeraj, if you see in terms of Wockhardt, again, interesting point where US, which is loss-making, 5% exposure that they will be exiting. So again, it will be earnings accretive as well in terms of where business goes. But few of the other companies that we need to keep our eyes on is a Gland Pharma, Aurobindo. Both of these have nearly 50% kind of exposure to US. You have Dr. Reddy's, Zydus, both of these around 45% is the kind of exposure in terms of the US markets. Lupin, Glenmark, Sun Pharma, Cipla, these are the ones who are in double digits. So I think that this is the pack that we should be focusing on now.
Yeah, most certainly. But interesting that the two corporates which have come in this morning, Hitachi and Pharma, of course we've called those kind of companies, have said that there is no impact there. The question only is, will it be the same when TCS takes the stage this week and talks about their earnings? I'm looking forward to the conversation that Sajid will have with Krithivasan.
And I think what's going to be important is, I think all of these companies are now not going to be able to give guidance, and that guidance is going to be crucial because of the uncertainty. If they do give, whether they'll be able to meet or not, but I think they will refrain from giving a guidance this time around.
Yeah, let's see. There is uncertainty for sure. But I'll tell you what we are getting in terms of views is what large brokerages are saying. We told you about what Goldman's view was. Now let's hear out let's get in Somit, in fact, to talk about what is it that Bernstein is saying when it comes to their India strategy. Somit, good morning. Is it a note which is sounding a lot more cautious, or is it a note which is sounding a lot more optimistic?
Well, it's a note where they have actually given their portfolio ideas, in fact made some changes as well. Now in their India strategy note, Bernstein is saying that recession-proof portfolios are quite challenging to create given the current scenarios, and they're also saying that all equities have either direct or indirect risk, so one should not be influenced by any risk-free portfolio, because in equity markets there's always risk that is involved, and if one wants to invest in a risk-free portfolio, then they should prefer fixed income over equity going forward, is what the brokerage is saying. Now when it comes to domestic sector wise, they're saying one should avoid exposure to IT and healthcare at this moment of time, given the fact that there is overseas exposure to both these sectors and the risk that is attached to them, and hence they have also reduced their weightage when it comes to IT and healthcare to equal weight from overweight rating that they had earlier. When it comes to sectors like financials, telecoms, parts of consumer discretionaries and utilities, these sectors are a safe bet as per Bernstein, because they show or exhibit growth and defensive characteristics. Now their portfolio of 12 stocks. Now these stocks provide healthy balance of growth, defensive characteristics and significant return potential during an economic recovery, is what the brokerage is saying. And in these 12 stocks, they have made some changes. They have added Power Grid and M&M because they believe that both these stocks will show some macro recovery as and when consumption growth comes in, and they have reduced or trimmed their exposure towards IT stocks and removed Coforge from their 12 stocks. So which are those 12 stocks that are part of Bernstein's model portfolio? Firstly, it's Infosys. Second is NTPC, followed by Power Grid and Adani Ports, L&T, ICICI Bank, SBI Life, IndusInd Bank, M&M, Avenue Supermarts, Jubilant Food and Bharti Airtel. And as for the brokerage, these stocks not only have a healthy balance sheet but could also see a strong growth as and when consumption of the macroeconomic economy recovers going forward.
Right. Thank you for getting us the details, Somit. So that's an interesting note coming in from Bernstein. If we can also have the other note that even Neeraj was talking about with regards to CLSA, because that was an interesting aspect that Lawrence also indicated. Let's just quickly pull up that one on the screens. Overall, if you see in terms of Lawrence, what he has indicated so far is that after testing the February highs, which sits just below the 200 DMA, the Nifty's advance has stalled and the price action is now below its 50 DMA as of Friday's close. We don't have the details yet, but interestingly, Neeraj, if you see in terms of the support, what he's indicating is 22,676 is where he was seeing the support, and this was followed by the early March low, which was 21,964. So these were the two levels that we were watching out for. Now, in addition to this, what he's indicated is there remains risk of further short-term weakness with pressure on the risk assets globally, and the breadth thrust is buy signal coupled with the daily momentum indicator, suggest a pullback should be limited. So that's an interesting one coming in from Lawrence.
Yeah, it is. That's the CLSA view, by the way. It's not the Bernstein view, but interesting view from Lawrence Balanco of CLSA. But time to get in a big market voice. Nilesh Shah, MD of Kotak Mahindra Asset Management, with us on the show as well. Nilesh bhai, great having you on a day like this. Thank you so much for joining in. You and I can afford a smile, but I'm telling you, a lot of people out there are really licking their chops this morning. How bad is this uncertainty, Nilesh bhai, for risk assets pricing?
Undoubtedly, Neeraj, right? Today, we don't know what President Trump will do. His actions have been fairly unpredictable. We would have never guessed on political side he'll say Canada should become 51st state of US or Greenland should be given to us. On the commerce side, we would have never assumed that he'll be levying tariff as trade deficit with America divided by exports to America. But this is the world in which we are living in. Do remember that the objective of President Trump is appropriate. Even mighty US, the world's biggest, most strongest nation, cannot afford fiscal deficit at 6 to 7% year after year. It cannot afford current account deficit at 3.5% of GDP year after year, despite having reserve currency. The debt to GDP ratio at 125% with unfunded pension liability, clearly they needed to tackle. The objectives are right. The process has been fairly difficult to understand, and which is why this uncertainty is likely to persist. The process which they are following, it will create lose-lose situation for US as well as the globe. And hence there is little hope that it might get reversed before it is too late. In the order itself, there is a clause 4 which says that America is open to negotiation. Vietnam, which allowed China to use their base for manufacturing or actually assembling and exporting to US, has already announced that will make zero tariff. So there will be negotiation, and that's the hope. But clearly that uncertainty is likely to persist as President Trump remains fairly unpredictable.
Right. So can it happen that because of this uncertainty prevailing, and who knows, it could last for a better part of 2025, can we see illogical prices on the downside in asset classes as well? Because everybody's saying that Indian economy doesn't get impacted, but the uncertainty may still bring market valuations much lower than maybe long-term averages too, right? Can it happen?
Undoubtedly, Neeraj, but markets can remain irrational more than you can remain solvent. While this phrase is used mainly for shorting side, it can be true even on long side. If you are taking leveraged position, you may think today X is the fair value, but with a policy change, X minus something can become fair value, and hence markets will have to make adjustment. Anyway, markets are always trying to forecast future. As of today, we don't know what kind of tariff will be there on pharma products. Who will bear the burden, manufacturer or the distributor, which has disproportionate margin? But yet market is going to take pharma stocks down, assuming that tariffs will be levied as irrationally as it has been levied on other products.
Nilesh bhai, good morning. Hiral on this side. Let's talk about history as well. I mean, tariffs have been levied by the US in the past. We did see that resulting into a recession. How are you looking at 2025 then? Do you think it'll just be a major impact in terms of lower growth and higher inflation, or it could be much more leading to recession or something like a Great Depression that we saw? I mean, is it a good comparison?
So Great Depression is unlikely to occur because today both political class as well as central bank are far more cognizant about learnings of Great Depression. To a great extent, Great Depression can be blamed on very, very tight monetary policy of central banks around the world. I'm sure they have learned from the same, and unlikely that they will allow recession to go into Great Depression without taking appropriate action. At the same time, there are equally opposite cases where levying tariff has resulted into recession in US in 1828 as well as 1930. Now, there may be people who may see that this levying tariff is appropriate from the America's point of view because of fiscal deficit, current account deficit, and debt to GDP ratio. Will it create stagflation in US where growth is lower, inflation is higher? Quite likely. That is a possibility. That will lower the global growth. If engine stops off the train, the whole train has to stop. And US is the engine of global GDP along with China and India.
So Nilesh bhai, one aspect that I'm picking up from your conversation right now is how strategically we position ourselves as a country to take advantage of it. So from an investment perspective, which are the sectors that could take advantage of this kind of a tariff war to take business from other countries into us and in turn be buying opportunities for investors?
So one, there is so much of uncertainty that there is no need to hurry to invest. In the hindsight, we may feel, oh, this was a great level to buy. But when there is a storm brewing outside, it's far better to secure yourself and then think of opportunity. Number two, clearly domestic focused sectors will stand out in this storm. Undoubtedly, India's growth can take a hit if global growth slows down, but we will still be a positive growth. We will still be one of the fastest growing major economy. So your portfolio should tilt towards domestic focused sectors rather than international focused sector. Within these sectors which could take advantage of opportunity, as India has been levied little less tariff compared to others, there could be opportunities in textiles and garment. There could be opportunities in footwear. There could be opportunities in some of the pharmaceuticals and chemical sectors and so on and so forth. But please remember, if the American demand itself comes down, then these opportunities will be back-ended, not front-ended. It's not that American buyers will straightway shift from China, Vietnam, Thailand to India. One, their demand should remain consistent. And second, we should have capacity to service them. It's all going to take time. Market does discount future, but it's likely to be more back-ended than front-ended.
Got it. Nilesh bhai, just pure domestic plays. So, I mean, you maybe put in cement out there. And I wonder if steel, for example, while it's a global play, but because of the duties having been added, that does it kind of qualify as a quasi-domestic play now versus it being a global play? I'm just trying to think, what do you think of pure domestic assets like cement, steel, and some of those commodities? Not steel, but cement for sure.
So cement undoubtedly is pure domestic sector. You can't export much of a cement. You can't import much of a cement because of bulk nature. On the steel side, undoubtedly, there is little bit of exports, little bit of imports as well. And largely, it's a domestic-driven sector. But the most important thing for us is that steel or any other commodity is a sector where tail wakes the dog. There will be excess capacity in China. Their free access to US is getting curtailed. Their free access via using countries like Vietnam to export is also getting curtailed. And that extra capacity could be used to dump in rest of the world. We are one of the largest market and also nearest to China. We'll have to be very, very proactive in levying tariffs on Chinese imports. Otherwise, it can hit a sector like steel. So in steel sector, apart from domestic growth, domestic demand, we'll have to also see how proactive our government is in levying tariff on Chinese imports.
Okay, Nilesh bhai, difficult days, but thank you so much for your wisdom. Really appreciate, and I'm sure viewers benefit from it as well. Thank you.
Thank you.
Right, that's an important market voice and some sane words of advice as well on a day which is looking rather insane because the Nifty 50 is now look like the VIX is at the highest point, by the way, and then the Nifty 50 after recovering a little bit of lost ground is still down below 22,000, so it's not looking all that great. But if you have queries, Hiral, the next show is perfect for that.
Absolutely. I mean, that's where you will be able to ask our guests and experts in terms of whether what you should be doing with the stocks that you're holding at this hour. But with that, it's a wrap on this edition of India Markets Open. Lots more lined up on NDTV Profit. Please stay tuned. And throughout the day, we will get you coverage from good and expert market voices as well.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Hi, thanks so much for joining in. You're watching Ask Profit on NDTV Profit. My name is Alex Matthew. With me is Mahima Vajrajani. And what can you say about the equity markets as they stand right now? I guess to a certain extent this was expected, but the degree of the fall, we're finally, I guess, playing catch up with the rest of the world, where last week you saw the benchmark Nifty 50 drop only about 2.5% or thereabouts. Today, the catch-up is playing out. So you have cuts of about 4%, and we are trading below 22,000. Technical analysts are pointing to that 22,000 mark that is very crucial to close above. And if it does, they would take that, is the point. Let's see what our experts today have to say. But very briefly, let's take you through how the broader markets are also doing. Down about 5% for the mid-cap index, down 6% for the small-cap index, and it's carnage across the board. Even positive developments are being sold into. There's nothing really that is standing out as a winner today. In fact, some of the losers must be highlighted. And take a look at the sectoral heat map, because there is going to be red across the screen. There, of course, you have the contributors. Reliance Industries losing the most ground, but you have on the losing end the metal index that's down about 7.6% or so, the worst hit. Understandably so, because if you think about it, if global economic growth is going to get impacted, this is a pack that is going to see the worst of the brunt, bear the worst of the brunt, right? So you have oil that is under pressure today, and over the weekend you have defense that is down about 6.5%. IT is down 5.4%. And think about it, already as of Friday, this is a group of stocks as an index that had lost about 27% from the high from December, and it has lost another 5% today. So that takes the fall quite considerably beyond that mark. What should you do? This is a question that you're probably asking. Of course, through the day today, we've been talking about how perhaps the best approach for you to take is to weather the storm. I wonder what our experts have to say. Mr. G. Chokalingam, founder and managing director of economics research, joining us. Brijesh Ail, head of technical and derivatives retail research at IDBI Cap, joining in. I'm going to get your views initially, both of you all. Brijesh, first on the technicals. It's gapped down. Of course, this was expected, but on the lower levels, do you deploy or do you wait for the dust to settle? Do you not be brave in this kind of a market?
Morning, Alex. So yeah, one should not be brave, but one should be reasonably buying skew the long-term perspective, because I understand that we have broken the March low, and now today we made a new low. So most probably this is again to follow up with the event which is happening globally. So my understanding is that there was a pretty good buying which we saw in the month of March, and then today, because of the panic scenario, we are again back to the demand zone. So technically, yes, 22,000 may be the level, but then I would suggest 30-40% of that capital can be employed, that too in a blue chip kind of a counters, because I understand that the Q4 numbers are going to be pretty good as compared to Q3. That is one. And secondly, the Bank Nifty in today's session, irrespective of the market, it was still holding up. It may be below 50,000 mark, but then still somehow this level of 50,000 is look quite promising for the Bank Nifty. So if Bank Nifty has to rally, eventually the Nifty will also support it. So technically, I do expect a bounce. Today, I believe it's the second day. On Friday, we saw a day one. Today is a day two. Most probably follow-through selling might come, or maybe some sideways momentum will be there in day three. So this is the normal cycle, how we see for the market. So maybe it's too early to comment, but then yes, very stock-specific approach should be taken, and maybe the bounce will not be sharp, but then the low will be protected. Maybe 21,800 maximum. That is what I can say as of now from the current level.
22,000 key to monitor, right?
Yeah.
Yeah, okay. So closing above 22,000, short answer is positive, right?
Yeah, very much positive.
Okay. Mr. Chokalingam, I know we've spoken over the last 6 months consistently about the fact that valuations may have been a little bit elevated 6 months back, but now we're seeing a situation where it's corrected very sharply across the board. So if you are a long-term investor, your portfolio is bleeding at this juncture, what would you do? Do you reinforce some of the investments that you're making for the long term? Where are you advising people to deploy money?
Yeah. Before I say where I would deploy, I would tell you why I would deploy. I'm not going to say that the trade war is not a big issue and it's going to go away soon. It is going to stay here for long. But the biggest point is that America cannot afford to have this kind of aggressive tariff war for very long. It's somewhere soon, some compromise to solution will be found out. The US market is already down 18 to 22%. Today, probably it may fall another 5%. And US economy is going to be affected very badly. The deflationary conditions are unavoidable. And, China is the maximum loser because highest tariff is on China. Where does India stand? India is in between. And India is not an export-oriented economy like South Korea, Japan. Our exports are only 10% of the total GDP. And our IT services are not governed under tariff issues. And that is much more than the goods export to US. So it is basically domestic demand driven. It will be affected. The GDP may fall 30-50 basis points, but not the way the market is panicking today. It's largely on account of panic. And as you also rightly mentioned, many stocks were overvalued for the last 1 year. That is also contributing. So now the valuations are emerging very attractive. More than 100 lakh crore is wiped out, which is 1/3 of India's nominal GDP for the current year. Now, lastly, what factor gives me a lot of confidence for the recovery, significant recovery, is that the oil price. just look back last 20 years, whenever this kind of a major problem was there, oil price rescued Indian economy to a large extent. Now, as of now, oil price is down 30% from the 52-week high. And this is going to have a multiple effect in terms of saving your import bill, shoring up your foreign reserves, improving exchange rate, reducing the inflationary condition, and thereby forcing the RBI to do reversal of interest rate cycle aggressively. So I believe this is a good day to invest. Where to invest? Look for domestic demand-driven segments like telecom, banks, which have nothing to do with America or export business. And then you have some of the rental-based real estate businesses. So domestic pharmaceutical company, there is no point in punishing the domestic pharmaceutical company by 50%. They are not going to be affected at all. But this is a purely out of fear. Even the domestic pharmaceutical companies are getting, losing heavily. So if you look back, every block of 3 to 5 years, whenever this kind of major episode happened, Indian market always proven to be a well-creating market. So it is in your hand. Choose the right stock. Don't go after momentum stocks where the valuation company is not there.
Right, Mr. Choklingam, what would those right stocks be right now? Which pockets will you enter into right now?
See, I would strongly recommend stocks like FDC Limited, and oil crash will directly benefit companies like Indigo, and there are many companies which use oil derivatives like tire companies. So I would strongly recommend MRF. And in the banking space, one can consider SBI Bank, Bank of Maharashtra, Canara Bank. Bank of Maharashtra, now, it has fallen almost to 45% from the peak. It is one of the finest two banks in the country. Net NPA is just 0.2%. And it is beating the industry growth by big margin in terms of business and deposits and CASA ratio. So Canara Bank, it is available below discount to the adjusted book value. And two of its subsidiaries are going to be listed and they will unlock Canara Bank. So these are the, Canara Bank, PSU Bank, Bank of Maharashtra, SBI, so telecom companies, domestic pharma companies like FDC and PNB Housing. So these are some of the stocks, I can consider which are purely driven by domestic demand.
Mr. Choklingam, in the telecom space, would you say Bharti Airtel? And the reason I'm asking is because Reliance Industries, if I look at SOTP, is still, one would argue, much below what it has traditionally had. It's down another 5% today. It was one of the worst Nifty 50 companies on Friday. What would you do with this?
I would hold. I would, suggest a little accumulate also because, yes, petroleum business might be affected by the tariff. But then oil and gas pack itself is going down in share in the total business substantially. And yes, I agree with you. The Bharti Telecom is a pure telecom play that looks very robust at this point in time.
Okay, so that's the holistic view of what's happening in the markets and which pockets can you enter right now, seeing the significant correction in markets today. Let's move on to our first caller for the day. Anand from Andhra Pradesh is calling in. Anand, a very good morning to you. How can we help you?
A very good morning to you. Thanks for having me this opportunity.
Our pleasure, Anand.
I just want to know the stock like Sandur Manganese.
Okay.
I'm having the stocks around 440 and quantity of around 117.
Okay.
So I'm in loss of around 6,000. So I just want to know do I need to add some more or I need to exit from this? Because few days back it was around 480 and 500 it came. I thought of at least clearing the partial amount, booking the partial amount, but I did not done that. So just want to know do I need to hold or exit?
Right. What's your time horizon like, Anand, quickly?
I have been I am into 1 year short term.
1 year, short term. Okay. Brijesh, I'll take your view on this one. Sandur Manganese is the counter. What are the charts indicating? Should he hold or exit?
Yeah, if it's prospective from the 1 year point of view, then the 350 is a very decent support. So I think you need to hold on to after once today's panic thing is over. You need to understand whether it sustains above 400 or not. And eventually, I believe it may go above 400 level. So I think it should be a hold.
Tata Motors is the counter that we're talking about. And remember, there's a significant update that the company sent out, JLR specifically, Jaguar Land Rover. And you will understand, let me very quickly tell you the context. Of course, you have auto tariffs that have kicked in. But Jaguar Land Rover's said that it's going to pause exports to the US. to see how this is going to pan out. And we've got a question from Srinivasan, who's writing in from Indonesia. He's got 450 shares of Tata Motors at a price of 800. And there are a lot of people like that, Mr. Chockalingam, who bought into this counter for the long term, but it's gotten beaten down, and very significantly so. At this juncture, would you say that it makes sense to add to your portfolio? Would you book the loss, or would you hold on?
I would give a hold recommendation. Of course, the problems will be there, as you rightly said. It's going to be impacted. And on domestic front also, the commercial vehicles are not going to grow in double digit. And domestic front also, this PV business is not growing enough to beat the competitor. And however, to be fair to the stock, it has crashed a lot. And I would say that it's a long-term hold, because in 1 to 2 years, it can definitely has a potential to come back. The tariff war also would settle down in a year or so. So therefore, it's a long-term hold. I would not recommend a buy. Maybe by any chance it falls another 5-10%, then one can consider buying the stock for long term.
And this is a stock that I will remind you fell to double digit at one point of time within the last 5 years. And at that point, when it did recover, it ended up being, in that particular year, I think it was 2023, if I'm not mistaken, the best performing Nifty 50 stock. You look at that rally, right? So from 2023 start to 2024, the kind of run that it had was very significant. The low point in the last 5 years was 67 or thereabouts. All right, Srini is calling us from Chennai, asking about a stock that is down 10%, if I'm not mistaken, Wockhardt. There you go. Srini, good morning. How can we help you today?
Good morning, Alex. This is the first time I am going for stock without analyzing that, because I was trying some technical things. And but unfortunately, I don't have any information about this particular stock, Wockhardt Pharma, WOCK Pharma.
Yes.
That's what I mean. And I think I'm close to like 43,000 loss, but I can hold for 6 months also. But do you think it is worth holding it or adding something after it goes down further, something like that? Can you guide me on the company aspect, please? Because I seriously couldn't find anything online.
Okay, so what you're trying to look for, no, that's perfectly fine, I understand it, but Srini, you've gotten into what, let me understand your question. You've gotten into a trading situation, but you want to know about the fundamentals because you have now pushed your holding period down the line. You want to hold for longer, right?
Exactly.
Okay. So I will invite you to have a look at the conversation that we had with Mr. Habil Korakhiwala. It's going to be available on the YouTube channel. We spoke with him earlier today, and he was speaking about the fact that the US consumer is going to have to bear the brunt of higher tariffs if they do come through on pharmaceuticals. At this juncture, there is no such announcement. But I'm sure that Mr. Chockalingam tracks this stock. Mr. Chockalingam, would you hold on to Wockhardt? Would you double down on your investment? The holding period that Srini has is relatively short term, I understand, but this is a situation where he's not in a hurry to sell and he's willing to extend his time horizon if he has to. Is this the right stock to hold on to?
For last 3 years, it at a consolidated level, it is making losses. On trailing basis also, it is making losses. And again, Mr. Trump said he will come back on, the pharmaceutical industry. We don't know at this point in time what kind of pain will be there. I believe there will be little compromise because US market also crashed and, world markets are crashing. However, if a given option, I would prefer a domestic demand-driven pharmaceutical stock like FDC Limited. So if I'm holding Wockhardt, I would sell and buy FDC. Just a compliance disclosure, we have already invested in FDC. This company draws 82% of the total business from the domestic market, and stock also crashed, and it has got a very good balance sheet, a lot of free cash, and excellent management. So I would prefer a stock like this to Wockhardt.
Okay, Mr. Chockalingam got your point there. Sell Wockhardt and buy FTC is what he's saying right now, and he prefers domestic play where pharmaceuticals is concerned. Moving on to our next caller, Geeta is calling in from Tamil Nadu. Geeta, a very good morning to you. How can we help you?
Yeah, very good morning to all of you.
Good morning. Go ahead with your query.
I am a very big fan of Mr. Chockalingam.
Okay, Geeta, I hope Mr. Chockalingam is hearing that.
Okay, my question is about Infosys.
Okay.
Actually, I bought Infosys around 1,350
Okay.
3 to 4 years back during the COVID downfall.
Right.
I still hold it. It's a long-term question. At this current today's market price, is it advisable to put a few portion of my investment in Infi? And another thing is it Infi or TCS today?
Okay, got your query, Geeta. Mr. Chokalingam, I'll come to you. There's also a query on Wipro that I have on WhatsApp. The person has purchased at 288 per share, and he is holding 140 shares and wants to know, should he accumulate or buy at the current level? So you have 3 stocks right now: Infosys, TCS, as well as Wipro. What's the view like, and what's the overall holistic view on the Nifty IT as well?
First of all, thanks for to your viewer for kind words. Large cap stocks I was a little negative, but after a recent massive fall, I would say that one should hold on to stocks like Wipro, Infi, TCS. And if one has to buy, I would recommend strongly Infosys today. Why? Yes, for the current fiscal, the large cap stocks are not going to post any meaningful growth. But what Mr. Trump is doing is going to strengthen the US economy enormously in 1 to 2 years. There is no doubt. It would streamline, restructure the economy and improve its economic prospects. And that is ultimately going to be recognized, and that is ultimately going to help IT services companies, because US economy will come back to strong growth and discretionary spend will increase. So the medium to long-term prospects for large IT stocks look very good. And stock also Infi fallen us by about 31%, and it's a very good price to enter. And tactically also, Infosys, whenever it crashed like this in the last 10 years, it bounced back. Management also rewarded the shareholders enormously. So considering all that, I would give a buy call on Infi today.
Okay. Incidentally, Mr. Chokalingam, we have another question on persistent systems. Since it's in the IT pack itself and we just spoke about IT, let's complete the circle, because we've got Dasarathi, who's writing in from Vijayawada, who's holding persistent 20 shares at a price of 4126. He's still making profit right now. Should he hold or exit is a question. He says that he's a long-term investor.
One can hold. Valuation is stretched, persistent, but after such a steep fall, it looks a little attractive for medium to long term, and its performance has been far excellent. So steep correction makes it a little attractive for medium to long term.
Okay, all right. We've got a caller from Hyderabad. Raj is calling us. Good morning, Raj. How can we help you today?
Yeah. Good morning to the panel members there. I've been recently seeing your program, and it's very interesting and very informative for people like me.
I'm glad to hear that.
I have a small query.
Yes, please.
I have a small query. I have some money to invest.
Okay.
I'm a senior citizen, and I'm looking at 1 to 2 years. BPCL is what I have targeted. So can you help me at what price I can buy BPCL for a 1 to 2 years perspective or for a long term?
Okay. Raj, while I will take your question, I just want to understand, you say that you're a senior citizen. Do you own any other equity, any other shares?
I have BPCL some shares.
Okay. And anything else in your portfolio?
No, I don't have any other thing in my portfolio.
Okay. And just very quickly, if I were to understand, out of your entire portfolio that you've kept aside for your long term, do you have a certain amount in equity that you've invested, either, I'm guessing, through mutual funds, if that is an option?
No mutual funds. I have fixed deposits and PPF.
Okay.
And this equity will be around 20-25% of my total investment portfolio.
And that's only BPCL?
I'm looking at dividends also, where it will help me for regular income and appreciation also over a long term.
Understood. Okay. So with
and
that,
the safety of the product also, it being a government-owned company, the risk being slightly medium or less.
Okay. Having said that, it's always a good idea to have a portfolio of stocks so that you can reduce the concentration risk, especially in a market that can see across the board cuts, right? But Mr. Chokalingam, BPCL specifically, is this the right time to add? And what else would you add? You've already given your pockets where you would prefer deployment over the long term. But BPCL, the question mark is whether or not the benefits of lower crude will translate into gains for BPCL. It hasn't in the past entirely, right? That's the question. So would you buy right now?
Yeah, you are absolutely right. Most of these companies, they don't gain much when oil price crashes, and they don't, gain anything when oil price goes up. And the profits also very inconsistent for all these companies. So tactically, yes, 15-20% upside is possible because it has already beaten down a lot. But for conservative investments, I would prefer stocks like State Bank of India, because as I mentioned earlier, there are very few sectors which have double-digit growth prospects, and banking is one of them. Now SBI is trading around 1x book value, and the second stock from the dividend point of view, one can consider Coal India better than the oil and gas stocks, because Coal India gives you excellent dividend, and in FY25 they missed the growth in coal dispatches, but there is a lot of pressure for Coal India to increase the coal output in FY26. Not only that, non-coal based minerals, they are trying their best to diversify in a big way. So all these would augur well for Coal India. Third growth stock would be CDSL. So I would prefer CDSL and SBI as a growth stock, and the Coal India from the dividend perspective.
Okay, the next query is from Telangana. Yelluri is writing in. She's holding 800 odd shares of Larsen and Toubro, bought at 3,500 a piece, and she's sitting on a significant loss of around 3.6 lakh rupees right now, and wants to know whether to hold or exit the counter right now. Brijesh, I'll come to you. What are the charts indicating? Should the person hold to see some recovery in the losses, or should exit at this given point of time?
I think the hold should be the view, because the capital goods space is looking good, and with the recent correction, I think they are coming back to the demand zone. So for the specifically this L&T 3,000 close to 3,100 level, I think this is the demand zone. So that is, maybe today it is broken, but then I believe once it sustains about 3,100, it will be back in action. So it's a pretty good level to make a re-entry, and if everything goes right, the bounce back will be close to 3,450, 3,500. So it's a buying opportunity. I think one should hold, and if possible, one should also look for to do the averaging.
So either hold or average out is the view coming in on Larsen and Toubro. Our next caller, Kunal, is calling in from Mumbai. Kunal, a very good morning to you. I believe you have a query on Bajaj Finserv.
That's right. Good morning. I hold 10 shares worth, I bought it at 15.33. I just want to know whether to buy more or shall I hold it?
Okay, I'll take your query up with Brijesh. Brijesh, what's the chart indicating for something like a Bajaj Finserv? Should he continue to hold, add more?
Hold and buy. Even the buying is suggested, because we have a view of 2,200 plus. So maybe in next couple of weeks, we should be seeing Bajaj Finserv back to 2,200, close to 2,200 level. So that's a new level which we are talking about. So it's definitely a buy kind of a trigger. Even in today's market, it's marginally down. So I think it's an opportunity, and he can definitely hold on to the long trades.
So you said hold and not add, right? Or did you say add?
Yeah, we can add also, because 22, another 400 points we are talking from the current level. So definitely somebody wants to take the fresh bet is also advisable.
Okay, all right. Hudco, I'm coming to Mr. Choklingam on this one. Rohit is a long-term investor. He's got 1,000 shares of Hudco at a price of 280. He's wondering whether to average his holding right now, because stock is down 5% in trade today, and he's incurring a loss as well. What would you say?
One can hold it, but I would not recommend a buy, because even at this price, in terms of price to book value, it is slightly stretched in terms of valuation.
All right. Well, Brijesh, we're told that you have to go now. So thank you so much for joining us and taking out the time and speaking with us at NDTV Profit. With that, it's time to slip into a very short break. We'll be right back answering all your queries on the other side. Stay tuned.
That's huge. That is a biggie. It's out of it.
Gold Plus Clear Glass. कार हो या नियर, सब कुछ दिखे क्लियर.
be real estate, might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
Hi, welcome back. You're watching Ask Profit. It's a tough day, no doubt about it, and the markets are bearing the brunt of everything that's happening globally. The tariff storm has caught up with the Indian equity markets. Of course, to a certain extent, some might say that we're playing catch up. Joining us on this side of the show is Ajit Mishra, who's a Senior Vice President Research at Reliance Broking. Ajit, thanks so much for joining us this morning. Just a quick view from you as well. We were speaking with Brijesh, and earlier today we were speaking with Kush as well, and they were both talking about 21,800 on the Nifty level to look at in terms of support, and 22,000 above closing would be taken as a big positive today. Would you concur?
Good morning, Alex. So, Alex, we have retested this, last month low, around 21,964 was the low which Nifty had made. On the closing basis, definitely is going to be critical where we close today. Let's say if we manage to hold 22,000 mark, then probably we can see some, recovery, or I would say that attempt to fill this gap which we have experienced in the market. But having said that, the way we have retested this level, we need to watch out for decisive sign of recovery before going aggressive longs in the index or otherwise also. So for a time being now, I would rather suggest maintaining a cautious approach, means trading through option strategies instead of like looking for long trades, naked long trades in the index, be it on long side or short side.
All right, so that's the view coming in with respect to where markets are concerned. But Ajit, the next question is also for you. Session is writing in, he's saying he had 5 to 6 lakhs amount waiting to buy some stocks since Jan market is falling. Can you suggest some stocks? But right now he's saying for 6 months perspective, he wants to deploy around 1 lakh rupees. Mr. Chokalingam has already given his picks already in the start of the show, saying that these are the picks that he finds attractive. But what are your picks according to you in the next 6 months that are looking attractive on the charts right now?
Right, Mahima. So see, the best thing which one can do is to focus on sectors which are showing resilience or relatively higher strength. So banking and financial one is definitely a pack wherein we are seeing noticeable outperformance throughout this correction. So ICICI, HDFC, Kotak from the private banking basket is something that definitely one can look at. Then after like this underperformance, FMCG selectively we are seeing some sign of reversal. So here also one can start accumulating stocks like Colgate and Marico. And apart from that, from the cement space, Ultratech looks very strong on charts. So these are a few names which one can look to accumulate in the current market scenario.
Okay. Kushal is calling us from Bengaluru. Hi Kushal, good morning. How can we help you today?
Yeah, sir. Good morning. So I'm planning to purchase Genus Power share.
Okay.
So is it the right time to enter into the stock?
What is the time frame that you have in mind, Kushal?
As their order book is excellent for about 3 years. So my plan is up until 3 to 5 years. It's a long term.
3 to 5 years. Okay. Mr. Chokalingam, have you studied this company? One, how do you look at, and what are the parameters that you would look at here? Would you buy into this?
Yeah, I have studied for very long this smart meter business. After the price crash, yes, for 3 to 5 year time frame, one can buy. But I would not go very aggressive on this because a lot of big players are also proposing to get into this smart meter business after seeing the great potential. But yes, valuation is slightly stretched after fall, but still it's a good buy for a period of minimum 2 to 3 years.
Okay, so good buy for the next 2 to 3 years is the view coming in on Genus Powers. All right, the next counter that we're talking about is HG Infra. Do we have the name of the person? Okay, Sudhanshu is writing in. He wants to know whether from a longer term perspective, is HG Infra something that is looking attractive right now or not? Mr. Chokalingam, I'll stick with you. What's the view like?
Yeah, I have studied it. For long term at current price, it looks a good stock to buy.
Okay, so that's the view coming in on HT Infra. We don't have the next caller. Okay.
Actually, there were a couple of others as well. Mr. Chokalingam, he is also considering data patterns and Titagar Rail. So between HG Infra, data patterns and Titagar Rail, based on current valuations, which one would you pick?
Data pattern, I have not updated myself recently.
Okay.
But the railway stock I would avoid, because as I have been saying, FY26 budget outlays already proposed and which is not favorable to the railway stocks. So only in FY27 one can go for increase in the capex from the government. So therefore I would avoid railway stocks even now and go for growth oriented sectors like banking.
Okay, so that's the view coming in. So but between the three, HG Infra is your preferred pick, right?
Yes, one can buy HG Infra.
All right, okay. All right, our next caller, Shailja, is calling in from Hyderabad. A very good morning to you, Shailja. How can we help you?
Yeah, hi, Mahima. Good morning.
Good morning.
To you and Alex.
Good morning.
I have a query on Bharat Forge. I have 10 shares at 1160.
Right.
So I want to know fundamental view and whether I can add more to this stock.
All right, Shailja, I can feel the pain of markets falling in your voice.
Yeah, it's 8% fall.
Yeah, I can understand. All right, I'll take your query up with Mr. Chokalingam. Mr. Chokalingam, what's the view like for something like a Bharat Forge?
I would say hold. Definitely it is going to be impacted by the tariff war. So as I said earlier, I will have a bias for domestic demand-driven sectors and companies. So therefore, I would not buy now, but definitely it's a great company. It has done extremely well over the last 2 decades. It will definitely bounce back, but it might take time. So therefore, I would give just a hold call on Bharat Forge.
Okay, so that's the view coming in on Bharat Forge. Ashish is writing in from Telangana and he wants to have a view on Elecon Engineering. And he wants to know whether he should enter the counter right now or not. Ajit, I'll come to you on this one. What are the charts indicating for something like an Elecon Engineering?
So Elecon, Mahima, we have seen decent correction. The stock has retraced to its major averages, long-term averages on the weekly chart. And today also, after the initial downtick, we are seeing an attempt of recovery. So it seems like that probably we can see some consolidation before any meaningful, respite. But if the view is, let's say, from medium to long term, definitely we can start accumulating at current levels. And I believe that 350 is the base, basically, where we have multiple supports. So that should be a stop loss in considering the current market volatility, and upside around 500, 520. That should be his positional target.
On Elecon Engineering, Trent. Okay, now it's not every day, of course, that you see a stock like this drop the way that it has, and I'm pretty sure that Mahima, while she thought that the update that they had on the quarterly basis was negative, she did not anticipate, and neither did a lot of investors anticipate, a 17% downtick on the stock.
In fact, it did touch an intraday low of almost 19%.
Well, there you go.
Which is not normal for a Nifty 50 stock to fall like that.
Not at all. But we've seen a few instances of that this year, not least of which was IndusInd Bank, but for very different reasons.
Absolutely.
Trent, if you're talking about a 28% uptick, Mr. Chokalingam, on revenues, where the expectation was for a 35% plus increase in revenues in the fourth quarter, take that on one end, and on the other end you have a very significant store count addition in the fourth quarter, particularly on the Zudio stores. They have added double of, or rather more than half of the store additions in the full year have been in the fourth quarter. So specifically on this, we've got Jinsen who's asking, considering the kind of downtick that you've seen in the stock, is this the right time to buy the stock?
I would suggest one can still hold on. In case market weakness corrects, it can even fall further. It's a great company, no doubt, but the valuation was also great. So that is the reason the stock has corrected day like this quite badly. And second, many of our analysts know that the physical store business, there is a potential threat, and some of the companies, they started losing the growth momentum. So I don't know when trend will get impacted by this structural change happening, the business shifting away from the physical store to online. So therefore, I would suggest a hold on in case market weakness continues and the stock falls another 5-10%, then one can consider a trend.
Right. But do you think valuations are now looking attractive? Because even after a 16% fall right now, I don't think the valuations still look cheap.
You are absolutely right. So that is the reason I am saying that if at least falls 5-10%, one can consider. Of course, we also go wrong on trend because historically last 5-10 years it has been commanding huge premium. So even after 5-10%, it will not be very cheap, but then one can consider considering the historical premium it has been enjoying. So I would wait for 5-10% correction.
All right, okay, that's the view coming in on trend. Our next caller, Suman, is calling in from Bengaluru. Suman, a very good morning to you. How can we help you?
Yeah, hi, Maima. Good morning. So my check is on the Ashoka Buildcon. I wanted to buy. So is it good time to buy or not?
All right, got your query, Suman. All right, I'll take this up with Ajit. Ajit, what are the charts indicating for something like an Ashoka Buildcon?
So Mahima, almost 50% of the correction from the record highs, and if you see the last 2-3 months of price action, it seems like that there's a base formation going on around 160 area. So she can start accumulating at current levels, and if the view is, let's say, for short term, considering the market volatility, the stop should be at 155. In the next leg of the up move, let's say once we complete this base formation, then probably around 240 is something that the stock might attempt. So the risk reward is favorable with 2 to 3 years at least of time horizon. She can start accumulating.
All right. Another stock that is a retail investor favorite, and that has dropped from peak levels of over 80. I'm talking about Suzlon. And we've got Sagar HR, who's bought at levels of 64. The stock is currently trading at 51, 52, and it has lost significant ground today as well. And so, Mr. Chockalingam is not bought at elevated levels, at least not where the stock was about 6 months back. But it's still something that has given up from his level. So would you say he's wondering whether to buy the dip or to hold? What's the view?
I would give hold. Even after the such a major fall, the stock valuation is highly stretched. And let us not forget the fact that in the renewable energy space, tremendous structural change is happening. How it happened in the microfinance, small finance. Similar thing is happening in the renewable space. A lot of big players have entered and they have become very active. So valuation-wise, it is stretched. But I would go wrong on my call only if it becomes a target of any possible takeover. Otherwise, based on the valuation per se, I would say that somewhere around 35-40 would be the fair price for the stock.
All right, so that's the view coming in on Suzlon.
Wow, 35-40 is the fair price.
Yeah.
Okay, there you go. If you thought that there has been a correction in the valuations, well,
so I think book your profits then right now. Well, whosoever is bought it at the correct levels.
So, just want to clarify that, Mr. Chockalingam, before we go forward, because if you say that the fair value is 35-40, does that mean that somebody is holding at 64 should book?
See, what happens, I'm not trying to escape, but we also learned from these last 2 years, a lot of tactical upside happens because about 21 crore new investors, out of which 10 crore young investors have come. And sorry to say that many people do not look at the funda just because, stock is in low double digit, there's an entire group to chase and buy. So therefore, if somebody is losing, one can wait. As I said, the consolidation can happen. I'm not forecasting that Suzlon will be taken over, but such things happen, it would be positive. Otherwise, if you look at the earning per share on a consolidated basis, valuation is stretched. And let us not forget the history that the stock was trading up to 440 about 10 years ago. And from there, all the way, it has come down to even 7 rupees. So anything is possible. Ultimately, the market is smart. The fundamentals only will drive the market ultimately. But to short term, to medium term, fundamentals do fail. So it may happen. That is a risk to my view for Suzlon.
All right, so that's the view coming in on Suzlon, and a very comprehensive view. So thanks for that, Mr. Chokalingam. Our next caller, Venkat, is calling in from Hyderabad. A very good morning to you, Venkat. How can we help you? Okay, I think we've lost him. All right, we have his query though. He's holding Electra Green Tech 500 shares at 1500 a piece. He's sitting on a significant loss right now for around 2 lakh rupees. Ajit, I'll take this up with you. What should he do next? Should he continue to hold, wait for the stock to recover, or should he book the losses?
So Mahima, here also we have seen decent retracement from the record highs level, and this zone close to around 950, 970 is the area basically where the stock made a previous swing low. We have retested that mark off late, and again we are seeing attempt of recovery. So in my suggestion, he can stay put with 950 as a closing stop loss, and around 1250, 1300 zone, he should try to reduce his position. Was highly volatile, and for any stability in the counter, we need decisive close above 1400 mark for a week or two. Then only we can see the reversal in the trend.
Okay, so Darshan has got a question. He's writing in from Karnataka, and he's shared his entire portfolio. Darshan, unfortunately, we can't discuss portfolios because we'll end up taking only a few questions. But from the list of shares that you've shared with me, Tata Power is what I'll focus on. You've got 150 shares bought at levels of 230. On the fundamentals, Mr. Chokalingam, would you hold on to this as part of a portfolio?
Definitely. I mean, still valuation is a little stretch, but then stock has fallen a lot, and management background is too good, and the company is also planning a lot of expansion into renewable energy. So therefore, I would give a hold, and in case it stock falls 5-10%, then it can become attractive buy as well.
Okay, so that's the view coming in on Tata Power. Our next query is on BSC. The person, okay, Shanmukha is asking whether these are the right levels to enter into something like a BSC or wait for this week to end. Ajit, I'll come to you again. What's the view like on something like a BSC? What are the charts indicating?
So Mahima, still we are seeing relatively high strength because the way the stock rebounded after making a low around 3600 mark, we almost tested the record high areas. Today with the market correction, again we are seeing a dip, but still it's maintaining above its all the major averages, including the short one. So basis that one can continue to hold the longs with 4800 as a closing stop loss. Obviously there could be some consolidation after this recent recovery. But broadly, the tone looks positive, and upside around 5800, 6000, the record high area, can be the zone where one can look to book at least partial profits.
Okay. We've got our next caller, Anish from Hyderabad. Anish, good morning. How can we help you today?
Yeah, hi. I'm actually having a stocks of IRFC around 1200, which I bought it around at 180. So should I hold or should I invest more in a couple of different stocks or anything?
Okay, help me understand what the thesis was. Did you buy it for the long term?
Yes, I bought it for long term for at least 5 years.
For 5 years. So, all right. Mr. Chokalingam, I know that you said that you're not favoring railway companies, but here we're talking about a railway financier. Do you have a different view? Would you hold on to something like this?
Yeah, it's a lending business. Even now it is slightly stretched, but then for 3 to 5 years, definitely it will come back to solid growth mode. Since because the capex is not happening from the government, it may remain laggard for 1 year. But then if somebody is having a week for 1 to 3 years, definitely it can come back to solid growth mode. So therefore, I would give hold, but I would recommend a buy in case it falls around 100 rupees.
Okay, Chris is holding around 5,600 shares of Geo Finance, bought at 252 a piece, and he wants to know whether he should average or hold at the current rate. Ajit, what are the charts indicating?
So Mahima, it's a very volatile stock. We all know that because almost, it made a new record low. And again, we are seeing that during this market correction, it's almost, hovering around that area. I would rather suggest him to hold, not to add at present. In fact, he can add once the stock crosses 240 mark. Because in that case, there will be a clarity that yes, the stock has started forming higher lows. And then around 265 to 280 is something that the stock might test. So as of now, it's a hold with 200 as a closing stop loss.
So that's a specific view on Jio Financial Services. So today is an important day, of course, to get views from the who's who in the markets. And all of this should give you some perspective. And joining me now is Nischal Maheshwari, and we were looking forward to speaking to him so that we can get his perspective on how to approach the current scenario. Nischal, thanks so much for taking the time on what I'm sure is a very busy day for you as well. But I think my viewers will benefit from your insight. At this juncture, how would you approach this? Because would you agree that to a certain extent we've caught the flu finally, the Indian equity markets? And from a long-term perspective though, do we still have the confidence that you continue to hold? Now is not the moment to sell, but would you double down and invest more in the stocks that you hold?
Thanks, Alex, for having me. Yes, it's been a turbulent morning, basically. Yes. At the moment, I think the best thing to do is just stay away from the market. There is no point on catching a falling knife because you really don't know how the other countries are going to react. China has already done it. Most countries, smaller ones, basically have all come to the table to negotiate. So let's see how all this pans out. I think it's best to avoid for next 1.5 weeks. See how all these things pan out. Maybe the Nifty will go to whatever levels. Nobody can predict that. So best to avoid. There is no hurry to buy in this market.
To buy, but then would you avoid selling as well, Nischal? Because the point is that, and here I'm talking about something like a trend. Okay, so there was a business update that perhaps was not as rosy as some would have liked. But 28% growth in the revenue for the fourth quarter was expected of over 35%. It's a stock that is down 17%. It's a Nifty 50 stock. Do you avoid selling as well is a question.
So it depends upon basically whether it's been selling because there has been some margin calls. If there is no margin call, I don't think so at this point, basically not only trend, but anything. There is no point in selling in this kind of a market. The markets are very low. I think some sane sense is going to come back to this market and maybe you will get better rates basically to sell. So I totally agree with you basically that there is no point on actually going out and panicking and selling at these levels. Yes, you may still see lower levels than this. That's what I'm saying. I'm not sure basically how low it can go, but there is no need to panic at the moment because I'm saying, yes, conditions are bad. And but what my thought remains to be that cooler heads will come to the table and things are going to work out not at pre-tariff levels, but definitely somewhere in between the pre-tariff and the level of tariffs which the Trump administration has put. So across the world, I see maybe there is going to be some giveaway, mostly a 10%, which was the base level of tariff, and some percentage above that. But then it is much better than what we are today. So that's why I'm saying basically just cool off and see for the next 2 weeks how this market comes, and then only whether you want to buy or sell, then only take a call.
Okay, and Mr. Maheshwari, if you wait for 2 weeks and we see a significant dip in the next 2 weeks as well, any counters that you would want to enter into and see that these counters are now looking attractive where valuations are concerned? And will those bets be domestic play bets?
Surely, I think last week itself, basically, I think it has become clear that you have to focus on the domestic companies for the at least next 2 quarters. And beyond the next 2 quarters also, I believe the Indian economy is going to revive. I think the government is taking enough measures, whether it is the rate cuts. I expect another rate cut to happen in another couple of days. Then there has been an income tax cut. So I think all those things, measures which the government is doing basically will show up in the second half of the current financial year. So that's why you are saying basically that at least for the next 2 quarters, wait out, and thereafter basically we are going to see earnings coming back, maybe some amount of earning upgrades also happen in the second half. So better economic sense will prevail.
Nischal, if we're talking about, and your point is well made, right? Because if you're talking about announcements that the Chinese government is already making to focus on domestic growth. You'll have European leaders that are talking about, hey, don't invest in the US, questioning whether or not it makes sense and saying double down on investments in Europe. So if all of these geographies, and I take your point to say that perhaps a common ground will be found on trade, but once bitten, twice shy. If you're dealing with the US administration, you'll have a lot of administrations around the world that will double down on domestic growth. And so from that perspective, for the Indian investor, what areas do you see? For example, financials have been relatively resilient, and in order for domestic to grow, you need financials. Similarly, you would talk about cap goods, you would talk about power. What are the places that you would look at and say there is value here?
So I think financials definitely as a sector basically has got good value, and it's not performed for the last 3-4 years. So I think the outlook seems to be good for the financials. If we have another rate cut happening, which is most likely to happen, I think it is going to be favorable for the whole financial sector. So financials is one. I would for the moment still wait out to see whether the consumption is coming back or not. Because there, I think with these kind of numbers, there are question marks. FMCG, it's a very mixed bag. There are a couple of companies saying yes, others are saying no. So really, I think one should wait out for the consumption sector. Government spending is another definite thing happening. Government spent around 12 lakh crores last year. I think similar number is happening this year also. So I think there you should be looking at industries like cement. Steel is a global commodity, so avoid it for the moment because you don't know if there is a tariff war between China and US, so China has to find newer markets to dump their steel. So India could be one of them. So avoid steel or metals for the moment, but cement is one basically definitely you should look at. The other ones basically capital goods to an extent. But capital good one has to be very clear saying that it's not the companies which are exporting because India has a large capital good export to the US also. So one should be very careful where we are investing. Power, capital goods, these are the other sectors basically which I look at it. And then there is consumer tourism. I think domestic consumer tourism, whether it is hotels, airlines, I think these are the sectors basically one should focus on.
Nishal, and I understand that talking about individual names is tough, but I would still encourage you not to give recommendations, but within the packs that you've looked at on a relative basis, stocks that are already looking much more attractive, and also just to follow up on the spots that you've seen that could emerge as pockets of value. I just want to understand your own assessment of the earnings scenario going forward. What is your base case assumption, though it's very difficult to make that assumption right now?
So I think 25, as we have seen, basically would end up with a low single-digit earnings growth. I think in this kind of a background, you will first see earnings cut happening for 26. Because still, I think the earnings growth, which is being projected is, I think, 15 to 16% by most analysts. So I think that would come down to a high single-digit number for FY26, and in the second half of the year, as I was telling you, once more earnings visibility improves, basically it may go up to low double-digit number basically. So that's the way basically which I expect. So a 10 to 12% kind of a growth in 26. 8 to 9% for 25. That is the way basically I see earnings happening. But earnings will get cut first and thereafter get revived. So I'm saying that kind of pain we have to still go through as far as the domestic market is concerned.
Okay. Nishal, thanks so much as always for taking the time and really appreciate the time that you've spent with us today.
Welcome.
All right. We're completely out of time in this edition of Ask Profit. Hopefully this conversation over the last 1 hour has helped you and given you some perspective. We've got Know Your Company up next, so do stay tuned. And this is NDTV Profit.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का।
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
Maybe real estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
Hello and welcome. You're seeing pressure in markets, and what we've therefore tried to do on Know Your Company today is something which is more inward facing, more looking at India and the possible growth with regard to power, because that may not change significantly, even though there are risks, but may not change significantly due to tariffs. And therefore we're looking at a Nifty 50 company, Power Grid Corporation, and we're going to quickly try to break this one down. Power Grid, what does it do? It's India's largest electric power transmission company. It has a 70+% market share in power transmission. And what is power transmission? I'll probably try to break that one down as well. One is the power generation, which say happens in a particular place. Thereafter, the power consumption is happening in quite another place, whether that's a manufacturing facility on the outskirts of a particular city or a metro, or it's within a city where you and me consume power, right? So therefore, transporting that power over grid lines from the place in which it is generated to the place in which it is utilized is essentially what Power Grid does. And there are various places along the way where power transmission will happen and go through these power grid lines, thereafter landing up with the final consumer. So that's what Power Grid Corporation does. What they also have is they command an 80+% of grid capacity of India. So the entire grid capacity, 80% of that is run by Power Grid, and then 20% are by some of the smaller players. In fact, less than 20%, 84% absolutely precisely is the power grid capacity that Power Grid has. And therefore, this is a large chunk of India in terms of coverage as well as in terms of grid lines, and therefore very difficult to get power from one place to another without involving a company like Power Grid. That's essentially what I'm trying to underline. 70% of India's power goes through the Power Grid Corporation grid, and 84% of India's interstate lines are run by Power Grid. Now, in terms of the capex plans, because grid capacity needs continuous expansion as well as needs upgradation. So you have 23,000 crore of capex in FY25, and this is important and relevant, and we'll come to why it is important and relevant as well. But for the moment, this is the kind of capex plan that's being put up. FY26, there is a 28,000 crore capex plan, and FY27, there's a 35,000 crore capex plan. Combined, the capex plan is closer to 90,000 crore. And we're talking about a company with a sub 3 lakh crore market cap, doing a 90,000 crore capex over the next 3 years. This is why it becomes extremely relevant to know this particular metric. Now, in terms of funding its capex, it does it in two fashion. Of course, internal cash flows and resources is what it uses to push capex out, but also debt financing in a big fashion. And debt financing, you will see in terms of the balance sheet debt, is sizable in that sense. So something you may want to keep in mind, because these are large capex plans, right? Now, in terms of how it runs its business, the returns for Power Grid are regulated, because you have there's a framework that is in place, and regulatory authorities determine the rate at which power transport or transmission actually happens. This is largely done on the basis of a cost structure which they keep in mind. They also consider debt, and they look at the debt raise, and they consider the ROE, the final ROE to Power Grid, which in some form or shape they try to cap. So based on the texture of the market as well as the industry, they look at anything between 14.5% to 15.5% in terms of ROEs when they determine tariffs, and thereafter they lease these lines, and a tariff is actually paid out to Power Grid. So they follow this framework to ensure that Power Grid earns fair returns, and at the same time there's no cost burden or disproportionate cost burden saddled on the final consumer. So that kind of blend is what regulators keep in mind when they determine tariffs. Now, that's essentially how the business is run and the structure works. We have spoken with Rupesh Sankhe of Elara Capital, who tracks cap goods and power, and he's given us his views with regard to Power Grid in particular, and we've discussed some risks with him, which we will, or rather we'll speak with him and we'll highlight some of those risks to you, and we'll try and ask him and quiz him on some of the risks. But let's quickly talk about the metrics that we need to look for in terms of a company like Power Grid. First off, we'll look at the income statement, how well that is growing and how that has done over the last 3 to 4 years. We'll look at the balance sheet. This will be key because large capex plans, mind you, just want to quick refresh that as well. The order backlog, how large in terms of orders and capex is like, and how much is the work in hand, and what is the execution looking like. In terms of cash flows then, how does cash flow stack up? We'll also look at how return ratios are playing out. We're looking at shareholding, and we'll look at street cred and street coverage, and thereafter derive a rating. So over the next maybe 10 minutes, we'll try to break this down. Mihika Barve joining me for this one. Mihika, it's been a while since we had you on KYC, but why don't you help us with the income statement?
Yeah. Let's start off with the income statements. Now, in terms of your 9-month FY25 numbers, your revenues stood around 33,000 crores, EBITDA around 28,800 odd crores, margins stand at 86.1%, and net profit stands around 11,300 crores. Now, in the 9 months FY25, and the kind of growth you've seen on a year-on-year basis, we have seen a slight degrowth. Revenues down 1%, EBITDA down 3%, margins have come off by 190 basis points, and net profit has remained flat, biased to the negative side. However, it's key to note that the company, the way it recognizes revenues is how much of its order backlog it's recognizing and how much of its capex it's capitalizing. So we could see more of the capitalization done in Q4. But when you look at the 3-year CAGR, it's done pretty well. Revenue and EBITDA 5 to 6% of CAGR. We've seen margins grow almost 500 basis points, 460 basis points of growth, and net profit has seen almost a 14% CAGR. And because of the kind of growth it's seen on a long-term period, we've given it a neutral rating, and it's key to note that Power Grid is a regulated entity, and that's why its returns are usually capped because of the kind of bidding process it goes through when it's getting a certain order. So Harsh, how does the balance sheet look though?
Yeah, I want to quickly also highlight that those return ratios are capped, and therefore you might not see the kind of growth that you're seeing till significant capex is done. Once significant capex is done, it starts to work out. Also, the real-time market, which was RTM as part of our graphics, is also one of the factors that takes care of the return ratio as well. So something that we'll want to keep in mind. But quickly on to the balance sheet. The balance sheet, let me just pull out the total equities, which is around 92,000 crore. It's trading at nearly 3 times price to book at this point. Cash and cash equivalents, not a surprise that it's something a shade lower than 4,000 crore, not a surprise because it's got large free cash flow coming in quarter after quarter. The total debt is 1.23 lakh crore at this point, and the financing cost annualized is roughly 9,000 crore. So your interest burden is around 9,000 crore annualized on a debt burden of 1.23 lakh crore, which goes on to show that your interest expense is not very high, or rather your interest rate on debt is not very high, because this is largely a government-backed company, and therefore it enjoys sovereign rating, and it enjoys its debt enjoys the sovereign related debt cost. So therefore you're largely seeing that debt cost is not very, very expensive for this company, despite it having a very, very large debt. So when you're looking at debt to equity, debt exceeds equity. But at the same time, we've given this a neutral, because one, it's sovereign backed, interest cost is not very high. And when you're looking at its EBITDA is roughly 30,000 crore. It does a PAT of roughly 17 to 18,000 crore, which is 2x of the interest cost. So it covers interest cost by at least 3 to 4 times if you consider the EBITDA number. And therefore, there is that margin of comfort in terms of it being able to service interest cost. The other piece is that it does service its debt as well on a recurring basis, also based on the depreciation it claims, and it's a large component. It claims around 12 to 13,000 crore of depreciation every single year, and that helps the free cash flow to continue to pour in, because it's a non-cash expense essentially, and that helps also to some extent to service debt, and therefore are neutral on the balance sheet. But Mika, on the order.
Yeah, the order backlog or work in hand is how Power Grid puts it. It's looking really good. They have, as of Q3 FY25, it stands at 1.43 lakh crore. On a quarter-on-quarter basis, there's no growth. But if you compare it to the first half of FY25, which is your Q2 FY25 number, you've seen a 26% growth in the work in hand. Even if you look at how it looked in Q3 of FY24, it stood at 77,000, and that marks an 85% growth in the work in hand for Power Grid. The work in hand, in terms of 65% of the order backlog or work in hand is currently from new tariff-based competitive bidding projects. Now, this is something where companies bid at the lowest tariff that they can put up the project and win. So Power Grid is even winning this the projects in this process method where competition tends to be high. And 27 of their order book are from new interstate transmission systems. From the work in hand and the kind of revenue visibility it provides for the company, it's looking a thumbs up on this one, Harsh.
Interesting. Let's talk therefore about how the return ratios are stacking up on this one, Mika. You're seeing anything between 18 to 23% in terms of ROE number over the last 3 years. The ROA number also very, very healthy at around 6 to 7%. The ROC number may be lower, but mind you, this also has a very, very low debt payout, and therefore the debt earning on this would be maybe 7% odd, which kind of caps ROCE, but ROE is very, very healthy in that sense. And that's the real number that shareholders should essentially look for in a company like this, the ROE number. For a PSU company to be at 18 to 23% ROE and having that sustainable, having that firing sustainably for itself is obviously impressive, and therefore it's a good number. Thumbs up on that one.
Yeah, and Harsh, before, what about cash flows? How are cash flows looking like? Because you've seen them kind of turn negative in FY24, but it all depends on their capex cycle as well.
Yeah, correct. Absolutely. So cash flow will always be healthy on this one, Mihika, because as you well know, your profit after tax number is around 16 to 17,000 crore. They have around 12,000 crore of depreciation, which they book nearly every year, and that is also a sustainable number because the capital cost is continuously going up, and therefore you have a healthy cash flow. Why the net cash flow is negative? Because they continue to invest very, very heavily in their infrastructure. What they also do is they have a very healthy dividend payout. In fact, till maybe a year or two back, the dividend payout was nearly 6%. Of course, the stock has gone higher after that.
It actually increased in FY24.
Correct. So it was nearly 6% at that time, and therefore it has very, very high dividends or a very high dividend payout, which is why you're seeing the net cash flow being negative. But otherwise, there is a fairly healthy clip on which the operating cash flow is growing at. If you look at that operating cash flow metric again, there you go. The growth is fairly healthy on this count. So neutral on the overall context of things, but it's a healthy number where
we do see moderation in cash flows, especially when it comes to something like a Power Grid.
Yeah, and one thing you may want to keep in mind where cash flows is concerned is how the execution with regard to capex happens. If that were to happen, you'll see this shoot up, and which is what I'll be looking for actually, and that's one of the reasons we've given this a neutral. Mika.
Yeah, let's go up to your shareholding.
Yeah.
Next, you've seen strong promoter and promoter group holding. It stands at 51%, even if you compare December 2024 to March 2022.
This is government.
Yeah, this is government.
Sorry.
It's fully government.
Kind of,
So when you talk about DIIs, as of March 2022, you had strong domestic ownership, but your foreign ownership stood low, but you've seen a clear growth. There is still some strong domestic institutional holding at 17%, FIIs at 28%, and you also have some retail participation at 3.5%. So from a shareholding pattern picture, it's a thumbs up on this one. And then let's move off to street cred. Year to date, the stock is down 6.4%, but there are a lot of other factors that are also coming into consideration. But even if you look at a broader timeline of 1 year, it's not done much. It's 3.2%, which you've seen other power transmission companies do better than that. And in the 5-year period, you've seen growth 214%. And Power Grid has always been talked about. You have longer term projects, so it's going to take longer term to get return. So we've given a neutral in the street cred because you have seen year to date and 1 year performance not do as well.
Yeah, and it's a 3-bagger otherwise.
Yeah.
So your 5-year performance has been fairly healthy. You'll want to wait for execution on this one. Let's look at street coverage very quickly. 17 buy calls, 1 hold call, and 6 sell calls. Overall, you have an upside potential of roughly 12%. Of course, you may have to adjust that for today's numbers, and because it's such a volatile day, you might just get a higher return on this one. But broadly, 12% basis yesterday's close is the way we look at this one. Quickly on to how we look at this from a KYC rating perspective. And we'll just quickly sum it up. Income statement neutral, balance sheet neutral, order backlog positive, cash flow neutral. You're seeing return ratios a healthy thumbs up, shareholding a thumbs up, street cred a neutral, and street coverage a thumbs up, and therefore gives it a 6 out of 8 on our KYC ratings. But let's quickly go across. We have our guest to talk to us about Power Grid. We have Rupesh Sankhe, Vice President of Research at Elara Capital, tracks both power as well as cap goods. Welcome, Rupesh. Good morning. Good chatting. First off, I want to understand power demand. And because there's just so much happening around tariffs, I want to understand what the impact could be on something like a Power Grid, especially on the industrial and commercial demand side of things. What is your view on this entire play which is happening in global markets, and what is the impact likely on something like a Power Grid?
We don't see a major impact in terms of power demand is concerned, because in the last 3 years, we have seen the power demand to GDP growth has close to 1.1 times. Historically, the same ratio was around 0.8, 0.9. So we have seen a lot of traction there on the residential side. So residential is close to 25% of the overall power consumption. And in the last decade, we have seen that segment where the demand was slightly slow. But that demand is now catching up. I think the load shedding has gone out completely. So that demand is there. And in terms of the manufacturing or the commercial demand, industrial and commercial demand, we don't see that much impact on the power system demand, because it's largely driven by the domestic production. No doubt, I think there is a market, people are saying that GDP impact will be around 40-60 basis points because of a global trade war, but that will not have major impact as far as the power demand is concerned.
Point taken. Understood.
Investment theme on the green transition is there for next 10 to 12 years.
Okay, so yeah, got it. Understood. Point taken. And how should one view the business, sir, in terms of return ratios? They are capped. There's a large transmission requirement, of course, that's there. But how do you view the business with capped return ratios?
Yeah, definitely. See, if you look at the last capex phase, high growth capex phase, was during 2012 to 2018. That time, we have seen the power transmission capex in India has grown significantly because of integration of all the grids. So Power Grid that time doing close to 35,000 crore kind of a capex capitalization. And in the last 3-4 years, we have seen the same capitalization growth has come down to around 15,000, 17,000 crore. And now because of this renewable energy integration, then green corridor phase, I think again, the next 3-4 years, we'll see around 30,000 crore kind of annual capex for Power Grid Corporation. Now, the Power Grid has 1.4 trillion of work in hand. That is based on FY27, the transmission opportunities. From 27 to 32, close to 4.9 trillion capex opportunities there. And out of that, close to 3 lakhs is for interstate, where Power Grid has significant market share. Almost 55% market share is there. So if they maintain the similar kind of market share, another we can see around 1.5 trillion kind of work in hand opportunity. So close to 3 lakh crore kind of opportunities there for next 10 years. So on a today's regulated equity, because this is largely TBCB projects, so their ROE will be, as you are rightly pointed out, ROE is slightly lower than the regulated ROE, but the overall equity base will double in the next 10 years. So that is close to 7.58% kind of growth in the equity that we can see. So that kind of opportunity is there. So we are overall positive on the transmission space, because without that integration of 500 gigawatt capacity, or maybe upcoming green hydrogen data center, that is going to be challenging. So this kind of capex has to be there to meet a 400 gigawatt kind of a peak demand by 2032 that we are expecting.
And Rupesh, what should one make of competition? Of course, tailwinds are strong, but how is competition shaping up for a power grid? Can it maintain its monopoly?
So definitely, the power grid has a strong execution capability in the transmission space. So they have that technical capabilities in place. Secondly, if you look at their balance sheet, every year they are generating close to 17,000-18,000 crore kind of profits. So that cash flow is there. Okay. Third, in terms of cost of debt, they are better as compared to other players. So managing better capital allocation, better capital structure, and execution capabilities they have, because a lot of issues are there in terms of right of way, land acquisition. There they are better as compared to other players. And that is what we have seen in the last 3 years when they started entering into TBCB projects. Earlier, their market share was hardly 15-20%. That has gone to 60-70%. That kind of capabilities they have. So execution, the technical capabilities they have, the financial leverage they have in terms of managing cost of debt, I think they are ahead as compared to other peer companies. So they are well placed in terms of to grab this opportunity.
And Rupesh, how should one look at cash flow? How much capex are you building in, and how is that expected to be funded? Just give us the way in which cash flow will go about.
Yeah, it's a good point. See, this year we are expecting close to 18,000 crore kind of a capex. Next year it will be around 30,000 crore capex. Even next 3 years we can say a run rate around 30,000 crore kind of a capex. Now, in terms of capitalization, because it takes 3 years to get commission, so capitalization will be slightly lower than the capex. So it will be around 20,000 crore. But if you look at their equity contribution, will be in the range of 75-25, or they might go 80-20 kind of a debt equity ratio. So if you look at the after dividend, they will have significant cash flow for the equity contribution. So we don't see any risk there. Now, in terms of a dividend, we are expecting they will maintain around 8 to 9 rupees per share kind of a dividend. That comes to around 3% at the current market price. So we don't see that risk because of a huge capex there that will have, because they have got a strong cash flow in hand. So they will maintain the current dividend payout ratio. At the same time, they will have sufficient equity for their under construction projects and upcoming projects.
Okay, and your view, what's the largest risk factor to be kept in mind here from an investor perspective?
The risk factor only in case of high penetration of battery storage, because batteries will get installed in the existing transmission assets. So they might not have to go for incurring extra transmission assets. So that is a risk, but we don't see that this is a near-term risk for the battery to get deployed in such a high pace as of now. Second is delays in getting right-of-way issues or land acquisition, or any delays on the renewable energy, because largely capex is coming for the integration of renewable energy with the main grid. So that will have some risk in terms of delay in RE tendering.
Right, Rupesh. And Rupesh, how should you value this? Contextualize the valuation for us. Not easy to value.
Yeah. So definitely, if you look at their valuation band in the last 15 years, they get premium when the capex capitalization trend is on the positive side. So during 2007, 2011, 12, when mostly generation capex was there. That time, this transmission were getting slightly lower multiple. From 2012 to 2018, the multiple has gone up significantly. Now we are also seeing the similar kind of high capex growth in the next 10, 12 years. So definitely they will get a better multiple. So logically, if you look at the returns they are getting from the regulated assets and their TBCB projects, like slightly close to 15-16% ROE is there. And your debt is fixed over a period of 10-12 years. So you have steady cash flows there, and return is there, and you also have a growth associated there. So normally it's better to value based on price to book value, considering the cost of equity, the growth which is there, and the ROEs they are generating from these assets. So best valuation tool for power grid with steady cash flows, one-time capex, and you get revenue for next 25-30 years. Best way to value them is based on price to book value.
Point taken. And what's the multiple you ascribe to this, Rupesh? What's the upside?
See, we have positive view on the stock. Upside from the current level is close to 25%. We have given a price to book value multiple at around 2.8x based on FY27, the regulated equity, and overall equity they will get from the TBC. So now their regulated equity as of now is close to 92,000 crores. And based on the 1 lakh crore kind of capitalization they are doing in the next 3 years, we can see around 30,000 crore kind of addition in their existing regulated equity. Over that, we are giving 2.8 times market cap to equity, considering they will maintain 15.5% kind of ROE on a consolidated basis. And the growth will be around, earning growth will be around 9.5%. And the capex growth is, they will maintain 55% kind of a market share in the upcoming transmission opportunity from 27 to 32. So that way, we have arrived at value of around 350 rupees currently. Our fair value is 355.
Okay, point taken. Thank you so much, Rupesh, for coming in and speaking with us with regard to this one. It's a well-tracked counter, and it's a Nifty 50 stock, so wide interest in that sense, and also slightly insulated from tariffs. Interesting one, but hope this has been helpful. From Mihika, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action right up on the other side.
That's huge. That is a biggie. It's on.
Gold Plus Clear Glass. Far ho ya near, sab kuch dikhe clear.
AB Real Estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
SEBI is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Thanks for tuning into this special conversation, and I call it special because we are trying to not just gauge at what the equity impact is, and it is looking very bad because the markets are roughshod today across the world, and in India no exception. But we're trying to kind of take a look at what lies ahead, and to do that, Sonal Verma, Managing Director and Chief Economist, India and Asia ex-Japan at Nomura, joins in right now on the show. Sonal, thanks so much for agreeing to talk to us. It's a pleasure talking to you today.
Thanks, Neeraj.
Sonal, just starting off with, how have you gauged the economic impact of this tariff war on India? If I can start off with that. I'm not calling just the economic impact of the tariffs, because everybody's saying that India is not as impacted by tariffs, but there could be an indirect impact due to supply chains, due to currencies, and a lot more.
That's right. So I think the direct impact is probably easier to estimate, given India exports about 2.2% of its GDP to the US. So we know that there's probably a 20 to 30 basis point kind of a direct impact. But I think this is much, much bigger than that, and that is where the concern really is. It's really the weaker global demand, uncertainty weighing on investments, tighter financial conditions, which basically feed back into weaker business investment, and also hurting consumer demand because of the negative wealth effect. And actually, the second round effects are extremely difficult to quantify and are still playing out as we speak. So our growth projection for FY26 is at the low end of consensus. We think growth will be softer the ongoing financial year at 6% on a year-over-year basis. But we do see downside risk even to this projection. And globally, Neeraj, we've cut our numbers more significantly for other open economies in Asia, and for the US as well. We've downgraded our growth numbers for 2025.
That was going to be my next question. That would you reckon that global growth at large, as it stands, takes a significant cut on current scenario, and does that, Sonal, change meaningfully? Let's say growth for the ASEAN region. Does it change meaningfully if economies are able to strike some kind of a deal with Donald Trump? Because everybody from, at least in Asia and Australasia, maybe, Australia, Japan, Vietnam, all of them are on record saying that they want to go to the US, talk to Donald Trump, and try and reach a deal.
That's right. I think outside of China and EU, at least most of Asian countries are looking to negotiate with the US rather than retaliate. And this negotiation is either in the form of lower tariffs, more investment in the US, buying more of US goods. So a lot of countries are offering that. The question is, the reciprocal tariff is actually not just about lowering tariffs. And for instance, the VAT or the GST that countries charge this is an important source of fiscal revenue for these countries. and therefore it'll be very difficult to negotiate on the GST rate, for instance. Similarly, the tariff on politically sensitive sectors like agriculture is potentially non-negotiable in a number of countries. So I think it is possible that some countries do manage to negotiate their tariffs slightly lower going forward. But even countries that actually have basically an FTA with the US have been slapped with a 10% tariff. So the extent of rollback on tariff is possible, but may not be very substantial. And therefore, our assumption for the US is that US effective tariff rate on its import will be above 20% this year. And if the US wants companies to invest in the US, then they will likely keep tariffs high for some time. So the tariff rates will also be sticky. So some rollback is possible, but I mean, I think, it may not be very substantial is what I'm saying. Now, I mean, what it means in terms of global growth, nevertheless, is that the tariff shock is quite significant, both directly as well as indirectly through the various channels that we discussed. Particularly for the US, it is a stagflationary shock, and we have cut our growth projections for 2025 for the US. So on a Q4 over Q4 basis, we've cut our numbers to 0.5% up, down from about 1.4%, so nearly a percentage points drop. For rest of the world, it's more of a negative growth shock as well. So for Europe, Euro area and Japan, we've cut our numbers by 0.2 percentage points. And Asia, we think, will be hit the hardest because this is basically home to the open economies in the region. And the tariff rates on Southeast Asia are quite elevated at between 35 to 50%. So the growth impact will be quite substantial for countries like, Vietnam, Thailand, Singapore, Korea, Taiwan. So we've made cuts anywhere between 0.3 to 0.6 percentage points across countries.
Okay. Do you anticipate, Sonal, this to become a global trade war? And the reason being that maybe China's share of exports which were going to the US, if they don't go in the same velocity, do they get dumped in other countries? Do we see other countries erect those trade barriers in order to protect their domestic economies? And therefore, does this have the probability of escalating into a full-blown trade war? Even if countries don't want it, they might have to do it.
I think that's the risk everyone is quite worried about. In the first phase, it's really the friction between US and rest of the world. We have seen a more aggressive retaliation from China this time around with the 34% tariff on all US imports. This is more aggressive than what we had anticipated. And we know that the EU is working on some kind of a retaliation package as well. And President Trump has threatened to retaliate against any retaliation. So, how this itself plays out between US and rest of the world, and particularly China and Europe, is something we basically need to monitor right now. And second, and sort of the phase two is what you're referring to, which is that with the higher tariffs on China and a number of other countries, there is this excess supply of products that is now available, and which will look for newer markets outside the US. And so we could see more influx of goods coming through into different countries, which could be a disinflationary force, particularly for goods prices going forward. And countries ultimately may end up wanting to protect their own local boundaries in terms of protecting local factories, protecting local MSMEs, the jobs in these countries. So we could see more anti-dumping duties and safeguard duties getting imposed by some of the other countries as a result of this redirection of trade. So I think no one wants a trade war. But right now, that's basically a risk that we're all watching.
The hypothesis that you may have built, either in your mind or in your notes, Sonal, does it have a parallel in history?
I mean, the 20+%. So actually, let me take that back. So we have actually had one of the more hawkish assumptions on US tariff. Our view was that President Trump would follow through on his threats, and we had assumed that the effective US tariff rates would go up from low single digits to 14%, which was one of the highest on the streets. What we've got is above 20%. So it's actually worse than what we had anticipated. So this is the highest tariff rates we've seen in basically 100 years. When we look at either the Smoot-Hawley period in 100 years back, I think that's basically the environment that we are looking at, where countries are becoming more protectionist, and that typically leads to material slowdown in global trade and breeds more protectionism, more inefficiency across countries. And given particularly the role of supply chains in the last 50 years in boosting efficiency and lowering the cost of production across countries, this is actually more inflationary over the medium term, even though near term we are talking about the disinflationary force because of these trade frictions. So we really need to go back 100 years to look at what this new world order means.
Well, one certainly hopes it is not akin to the Great Depression 100 years back. Incidentally, viewers, if the S&P 500 were to correct by 4% today, then it will be the first time since then that it will have 3 days of such a steep correction as well. Sonal, I'll come to central banks in just a moment, but before that, one quick word on the currency. Somebody expressed this opinion that there is, we know that China is trying to defend the yuan in a meaningful way because they want to avoid the capital flight, gain investor confidence, etc. But what if due to compulsive factors, including competitiveness, they devalue the yuan? What happens then? One, in terms of, it's an act of kind of an economic act, and what happens to, let's say, economies like India in the result of that, or for the currency of India, for that matter?
I mean, our view is China is not going to go down the devaluation route purely because the cost of the devaluation domestically to China in terms of aggravating capital outflows, hitting the property market, worsening confidence within China. The costs are much, much higher than any benefit to China on the export front. So we don't think a devaluation is likely. What can happen is, some drift higher in the renminbi. But that'll be modest depreciation, not a sudden devaluation. Now, in the scenario, and just to put this in perspective, during the first Trump war, we did see China actually adjust its currency a lot more steeply, and that offset some of the higher tariff impact on US consumers. This time around, because we don't think there will be such a massive currency offset, and because Trump has basically put a tariff on most of the other countries, the ability for US to actually substitute its imports from other countries is actually lesser than was the case during the first Trump administration, which is why we think the inflationary impact on US economy this time around will be much, much higher. Now, in the hypothetical scenario where China does devalue the currency, then essentially that will put pressure on rest of Asia as well, because there are product segments in which a number of Asian countries compete with China, and that will trigger some sort of a competitive devaluation or depreciation within Asia. But as I said, we're not expecting that in our base case.
Some relief. I mean, we're shuddering what could happen if indeed China does that, and what music unfolds after that. Okay. Now, Sonal, two other questions around central banks. Firstly, while Donald Trump urged Jerome Powell to quit playing politics and cut rates, Powell has come out and said that they are still wait and watch. But I'm asking you that in the event that the chances of a recessionary feeling, if not an actual recession in the US were to go up. Some statistics suggested some 67% number overnight. Will the Fed cut rates, or will inflation in the US because of the tariffs force Fed's hand to not cut rates even if growth were to come off the way you are saying it would?
Yeah, so, if you look at Nomura's base case, we have growth, as I said, coming down to 0.5% by Q4 this year, which is a fairly steep slowdown, but we're not forecasting a recession. Meanwhile, the inflationary impact is also important. So we think core PCE by the end of this year will be close to 4.6%. So growth is below target and below trend, rather. But inflation is also 2 times the 2% target that the Fed has. So if we have this combination where growth slows but does not actually slip into a recession, then we think the Fed is going to focus more on the inflation part of the mandate, particularly because we're coming from a period where inflation has actually been significantly higher than target for a long period of time. And it's taken a lot of policy effort to actually bring inflation expectations back down. So if you see another significant price shock, the spillover of that on inflation expectations can lead to more material unanchoring of expectations over the medium term. And that part of the mandate is what we think the Fed is going to focus on. So our base case is that the Fed is going to stay on hold both in the second and the third quarter of this year, when the peak of the inflationary impact of the tariff is playing out. We only have the Fed beginning to ease policy towards the end of this year, when the peak inflation, the peak price effects have played out. That is when we think the Fed will start focusing on the growth or the unemployment part of the mandate. So despite our view of weaker growth, we actually have the Fed on hold for now. Now, obviously, things are extremely fluid, Neeraj, and I think the non-linear effects that we are talking about in terms of uncertainty, business investment, confidence, financial conditions, wealth effect, consumer demand feeding back to the labor market, feeding into investment, jobs. So these non-linear effects, if they were to trigger a more significant recession in the US, which is not our base case, I think in that scenario, probably the confidence around the pass-through of higher prices into second-round effects, that risk would be much lower because of a significant demand-side effect, and probably the businesses will take more of a hit on their profit margins rather than pass it through to consumers. In that environment, we could see the Fed step in and deliver rate cuts. But again, it depends on how big of a growth shock we see as a result of these tariff increases.
No, completely understand, Sonal. I mean, for all you know, the view may be different tomorrow. I mean, 24 hours can't be too long in such a scenario. So completely agree. Don't envy your job at all right now. Sonal, while that is your view on the Fed, and assuming that's how it plays out, does it force the RBI's hands to do something different? Or does the stability in rupee, inflation, growth, etc., lead you to believe that the RBI will cut now and ahead?
I think RBI will cut now and ahead. And, the macro backdrop is very, very different for central banks like the RBI. So unlike the Fed, which is facing, this dilemma of higher inflation, lower growth, I think it's a pretty clear-cut low growth, low inflation environment for countries like India. And the drop in oil prices, Brent, between $60-65 per barrel is fairly significant disinflationary force, the impact of which we will see in the coming months. So, relative to whatever we thought 2 months back when the RBI met in February, there are downside risks to both growth and inflation. And inflation was already tracking close to the RBI's 4% target. So that is one. Second, I think the currency side as well. I mean, what we've seen is actually dollar weaken, in the last few days. vis-a-vis the typical strong dollar during a risk-off move we have seen. And when you have weak exports and you have low inflation, then some sort of a rupee depreciation is par for the course because it becomes a shock absorber. And in India's case, we have very limited fiscal room to actually support growth. So when you have such a major external development playing out, you basically need domestic demand. You need policies to basically support domestic demand. And given the limitations on fiscal, I think monetary policy, liquidity policy, macroprudential policies, a combination of all three will need to be used to basically, try to support domestic demand and offset the negative spillovers we are seeing and we are going to see on exports, which will spill into investments as well. So I think the room is clearly there, and we don't see any hurdle for the RBI. They've been extremely proactive on liquidity, which is a very positive move. It will help in policy transmission. It will help compress some of the spread widening we had seen in the last 3 months as well. And the policy transmission of the upcoming rate cuts should also get accelerated. So we are still expecting 5.5 as a terminal rate, which is another 75 basis point more to go.
Sorry, but just take one last question out here. We've been trying to talk to foreign institutional investors about their view on India after the corrective move that happened all through November, December, Jan and Feb. Just trying to understand, as you talk to your clients on the back of all the action that the government took in the budget, but more importantly, as you said, the proactiveness of the Reserve Bank of India, are clients sounding a lot more confident in India's ability to, support growth in the country, both the RBI and the government?
I think right now everyone's just trying to figure out what these Trump tariffs mean for the world. But I think on a relative basis, it is fair to say that India is seen as less vulnerable because we are less exposed to exports. We have been very proactive in terms of negotiating with the US on the bilateral trade agreement. So actually the reciprocal tariff, while high, is not as high as what some of our competitor countries have seen. The lower oil price is a positive for India. And India is still seen as a relative beneficiary of the supply chain shift. So our view is the 46% tariff on Vietnam, for instance, vis-a-vis the 26% on India, plus the fact that India is a strategic ally of the US, does mean that over the medium term, India is going to be a relative beneficiary of the supply chains that are moving in the low to mid-tech manufacturing sector. And as you said, I think we are seeing a lot more proactive policy easing kick in. So there is downside risk to growth, but there are also some offsets and compared to some of the more open economies. Therefore, India does look relatively better off in an otherwise what looks like a very, very difficult external environment.
Yeah, I mean, to say the least. But Sonal Verma, understand this completely. Thank you for a complete lowdown. Really appreciate you taking this time and talking to us today.
Thank you very much.
Well, so helpful to talk to somebody who just crystallized everything for us. I hope this was beneficial, viewers, for you. And actually, let's take that point a bit further to understand the impact of tariff on autos. My colleague Puneet spoke to Jonathan Starks, CEO at FTR. Listen into what FTR is making out of the rattled global supply chains.
The very first impact is more limited than what could have been in place. The fact that Canada and Mexico were not implicated in the initial set of reciprocal tariffs meant that some of the impacts that could have been most severe for the sort of the domestic North American Class 8 marketplace were less severe. But there are still some pretty significant impacts related to steel, iron, aluminum that are definitely going to be a negative overall when we're talking about the equipment marketplace, and the fact that we're going through so many disruptive events, whether it's the reciprocal tariffs or what's happening within the North American space with US, Canada, and Mexico that is going to disrupt the freight transportation markets, which is really what drives the demand for equipment. And if we are losing the ability to grow in the freight transportation space, doesn't matter what the cost implications are going to be for new equipment, we're going to lose demand for building that equipment.
Well, that's definitely going to be stuck, sir. But I just want to understand and take this point forward for tariffs, essentially, that now that we've seen not any kind of additional tariffs come in for Canada as well as Mexico, but we see a lot of Indian forging companies essentially have more than 30 to 35% of their standalone revenues to the Class 8 truck market. So apart from these countries of Canada and Mexico, how are you seeing the kind of impact currently from these players across India as well as Europe to the US Class 8 truck market?
The hardest part about all this is that we really don't know, because even though everything has been stated now, we sort of have a baseline we're working from on what the reciprocal tariffs are. Now we're down to a negotiation phase. And so that means that what we see right now could be radically different from what's actually going to be implemented in place here over the next few weeks or few months. So it makes for a very disjointed picture. It's very hard to give a good concrete answer on what this is going to do for the marketplace, which is unfortunate because we would love to be able to give more clarity. But I think what it does highlight is the fact that we're in this period of uncertainty that is going to dampen demand overall. So whatever good positive benefit any country might get from having a better tariff environment relative to China is probably going to be mitigated to some extent just because we're going to be reducing demand in the marketplace.
Now, Mr. Starks, I just wanted to ask you, over the last 6 to 8 months, starting somewhere around September till March, the preliminary figures, of course, it's been a high single-digit drop in sales essentially over the last 6 to 8 months in Class 8 truck market. Could you, just quantify some of the factors that might be impacting due to this? Because we've seen that, fleet utilization have also been lower in this particular time frame, and that's not leading to incremental sales, of course. So what are some of the key factors that, according to you, have been impacting the market over the last 6 to 7 months?
Well, we've been in an extended freight weakness for nearly 2.5 years in the U.S. market. And it's always freight that drives the fundamental demand for equipment. And so the fact that we've been in this weak environment for so long, we knew that we were coming to a spot where we were going to get a weaker environment for new equipment demand. And we're finally getting to that point. The negative downsides of what we're seeing right now is that that weakness could be persistent for a much longer period of time than we would have anticipated that we would have seen going into the start of 2025.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
AB Real Estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
He sold most of his stock, 80%.
coming on US tariff wars. What does this mean? Because stock markets across the world are falling on the back of Trump's tariffs and increased fears that the world's largest economy, the US, could go into recession. In fact, some experts say invest in the markets now since the valuations are cheap. Others say sit tight on the sidelines and wait for this to play out. Yet others say that you should move your money out of equities. Now, in this confusing situation, it is natural for investors in India to be worried about what they need to do to safeguard their money. Uncertainty is perhaps the most difficult scenario to tackle, and because no one really knows what's going to happen, there are estimates and guesstimates galore. At NDTV Profit, we're asking the questions that many of you have and provide you with sound, recent advice from the best of the experts. For many of you, this is probably the first market fall you're witnessing. Panic will not help you in any way, so we urge you to keep calm and weather the storm and keep watching NDTV Profit to get the best advice on how to be resilient in these trying times. In fact, we will get you market voices who tell you what to buy, what to hold tight, and what you should be doing. First up, we have the focus that's coming in terms of domestic consumption theme for the next 2 quarters. And this is what market expert Nischal Maheshwari said on the current market situation. He added that there's no point in selling in the kind of market that we are in. Let's listen into a bite of that conversation.
Yes, it's been a turbulent morning, basically. Yes. At the moment, I think the best thing to do is just stay away from the market. There is no point on catching a falling knife because you really don't know how the other countries are going to react. China has already done it. Most countries, smaller ones, basically have all come to the table to negotiate. So let's see how all this pans out. I think it's best to avoid for next 1.5 weeks. See how all these things pan out. Maybe the Nifty will go to whatever levels. Nobody can predict that. So best to avoid. There is no hurry to buy in this market.
To buy, but then would you avoid selling as well, Nischal? Because the point is that, and here I'm talking about something like a trend. Okay, so there was a business update that perhaps was not as rosy as some would have liked, but 28% growth in the revenue for the fourth quarter. It was expected of over 35%. It's a stock that is down 17%. It's a Nifty 50 stock. Do you avoid selling as well is a question.
So it depends upon basically whether it's been selling because there has been some margin calls. If there is no margin call, I don't think so. At this point, basically, not only trend, but anything. There is no point in selling in this kind of a market. The markets are very low. I think some sane sense is going to come back to this market and maybe you will get better rates basically to sell. So I totally agree with you basically that there is no point on actually going out and panicking and selling at these levels. Yes, you may still see lower levels than this. That's what I'm saying. I'm not sure basically how low it can go, but there is no need to panic at the moment because I'm saying, yes, conditions are bad. And but what my thought remains to be that cooler heads will come to the table and things are going to work out, not at pre-tariff levels, but definitely somewhere in between the pre-tariff and the level of tariffs which the Trump administration has put. So across the world, I see maybe there is going to be some giveaway, mostly a 10%, which was the base level of tariff, and some percentage above that. But then it is much better than what we are today. So that's why I'm saying basically just cool off and see for the next 2 weeks how this market comes, and then only whether you want to buy or sell, then only take a call.
Okay, and Mr. Maheshwari, if you wait for 2 weeks and we see a significant dip in the next 2 weeks as well, any counters that you would want to enter into and see that these counters are now looking attractive where valuations are concerned? And will those bets be domestic play bets?
Surely, I think last week itself, basically, I think it has become clear that you have to focus on the domestic companies for the at least next 2 quarters. And beyond the next 2 quarters also, I believe the Indian economy is going to revive. I think the government is taking enough measures, whether it is the rate cuts. I expect another rate cut to happen in another couple of days. Then there has been an income tax cut. So I think all those things, measures which the government is doing basically will show up in the second half of the current financial year. So that's why you are saying basically that at least for the next 2 quarters, wait out, and thereafter basically we are going to see earnings coming back. Maybe some amount of earning upgrades also happen in the second half. So better economic sense will prevail.
Nishal, if we're talking about, and your point is well made, right? Because if you're talking about announcements that the Chinese government is already making to focus on domestic growth, you'll have European leaders that are talking about, hey, don't invest in the US, questioning whether or not it makes sense and saying double down on investments in Europe. So if all of these geographies, and I take your point to say that perhaps a common ground will be found on trade, but once bitten, twice shy. If you're dealing with the US administration, you'll have a lot of administrations around the world that will double down on domestic growth. And so from that perspective, for the Indian investor, what areas do you see? For example, financials have been relatively resilient. And in order for domestic to grow, you need financials. Similarly, you would talk about cap goods, you would talk about power. What are the places that you would look at and say there is value here?
So I think financials definitely as a sector basically has got good value, and it's not performed for the last 3-4 years. So I think the outlook seems to be good for the financials. If we have another rate cut happening, which is most likely to happen, I think it is going to be favorable for the whole financial sector. So financials is one. I would for the moment still wait out to see whether the consumption is coming back or not. Because there I think with these kind of numbers, there are question marks. FMCG, it's a very mixed bag. There are a couple of companies saying yes, others are saying no. So really, I think one should wait out for the consumption sector. Government spending is another definite thing happening. Government spent around 12 lakh crores last year. I think similar number is happening this year also. So I think there you should be looking at industries like cement. Steel is a global commodity, so avoid it for the moment because you don't know if there is a tariff war between China and US, so China has to find newer markets to dump their steel. So India could be one of them. So avoid steel or metals for the moment, but cement is one basically definitely you should look at. The other ones basically capital goods to an extent, but capital good one has to be very clear saying that it's not the companies which are exporting because India has a large capital good export to the US also. So one should be very careful where we are investing.
In fact, Kotak AMC's Nilesh Shah also echoed Nishal Maheshwari's opinion and said that domestic-focused companies will stand out in this storm. Let's listen into that conversation.
Time to get in a big market voice. Nilesh Shah, MD of Kotak Mahindra Asset Management, with us on the show as well. Nilesh bhai, great having you on a day like this. Thank you so much for joining in. You and I can afford a smile, but I'm telling you, a lot of people out there are really licking their chops this morning. How bad is this uncertainty, Nilesh bhai, for risk assets pricing?
Undoubtedly, Neeraj bhai. Today, we don't know what President Trump will do. His actions have been fairly unpredictable. We would have never guessed on political side he'll say Canada should become 51st state of US or Greenland should be given to us. On the commerce side, we would have never assumed that he'll be levying tariff as trade deficit with America divided by exports to America. But this is the world in which we are living in. Do remember that the objective of President Trump is appropriate. Even mighty US, the world's biggest, most strongest nation, cannot afford fiscal deficit at 6 to 7% year after year. It cannot afford current account deficit at 3.5% of GDP year after year, despite having reserve currency. The debt to GDP ratio at 125% with unfunded pension liability. Clearly, they needed to tackle. The objectives are right. The process has been fairly difficult to understand, and which is why this uncertainty is likely to persist. The process which they are following, it will create lose-lose situation for US as well as the globe, and hence there is little hope that it might get reversed before it is too late. In the order itself, there is a clause 4 which says that America is open to negotiation. Vietnam, which allowed China to use their base for manufacturing or actually assembling and exporting to US, has already announced that will make zero tariff. So there will be negotiation, and that's the hope. But clearly that uncertainty is likely to persist as President Trump remains fairly unpredictable.
Nilesh bhai, so can it happen that because of this uncertainty prevailing, and who knows, it could last for a better part of 2025, can we see illogical prices on the downside in asset classes as well? Because everybody's saying that Indian economy doesn't get impacted, but the uncertainty may still bring market valuations much lower than maybe long-term averages too, right?
Undoubtedly,
can it happen?
Markets can remain irrational more than you can remain solvent. While this phrase is used mainly for shorting side, it can be true even on long side. If you are taking leveraged position, you may think today X is the fair value, but with a policy change, X minus something can become fair value, and hence markets will have to make adjustment. Anyway, markets are always trying to forecast future. As of today, we don't know what kind of tariff will be there on pharma products. Who will bear the burden, manufacturer or the distributor, which has disproportionate margin? But yet market is going to take pharma stocks down, assuming that tariffs will be levied as irrationally as it has been levied on other products.
Got it. Nilesh bhai, just pure domestic plays. So I mean, you maybe put in cement out there, and I wonder if steel, for example, while it's a global play, but because of the duties having been added, that does it kind of qualify as a quasi-domestic play now versus it being a global play? I'm just trying to think, what do you think of pure domestic assets like cement, steel, and some of those commodities? Not steel,
So
but
cement
sure.
undoubtedly is pure domestic sector. You can't export much of a cement, you can't import much of a cement because of bulk nature. On the steel side, undoubtedly, there is little bit of exports, little bit of imports as well, and largely it's a domestic driven sector. But the most important thing for us is that steel or any other commodity is a sector where tail wakes the dog. There will be excess capacity in China. Their free access to US is getting curtailed. Their free access via using countries like Vietnam to export is also getting curtailed. And that extra capacity could be used to dump in rest of the world. We are one of the largest market and also nearest to China. We'll have to be very, very proactive in levying tariffs on Chinese imports. Otherwise, it can hit a sector like steel. So in steel sector, apart from domestic growth, domestic demand, we'll have to also see how proactive our government is in levying tariff on Chinese imports.
Got it. Okay, Nilesh bhai, difficult days, but thank you so much for your wisdom. Really appreciate, and I'm sure viewers benefit from it as well. Thank you.
Meanwhile, Robert Sokin, senior global economist at Citi Research, talks about the approach of countries amidst global tariff outbreak. He also emphasizes on how is the US economy going to pan out from here on. Let's quickly listen in.
Right now, we're assessing many channels through which the tariffs will impact the US economy and the global economy and economies that are directly hit with these tariffs. And there's kind of the math of the direct effect of what these tariffs will do. But then there's all sorts of channels through which those effects could be worsened and magnified. In particular, if consumers and businesses really get concerned about this environment and they start to pull back spending even more, investment even more than they would otherwise with these tariffs, you can get kind of magnified negative effects. And I think with the way this first couple months have moved, with a lot of uncertainty and a lot of surprises from the Trump administration. I do think uncertainty is here to stay. Even if you end up with some negotiations on these tariffs, you could get more tariffs coming on and off. It's a very hard environment to plan. And so I think, at least for the foreseeable future, uncertainty is going to be high. And that really runs the risk of weighing on economic activity and also weighing on financial markets.
In fact, we also caught up with Nomura Sonal Verma, Managing Director and Chief Economist, India and Asia ex-Japan. Here's what she had to say about the tariff war that is likely to play out.
So I think the direct impact is probably easier to estimate, given India exports about 2.2% of its GDP to the US. So we know that there's probably a 20 to 30 basis point kind of a direct impact. But I think this is much bigger than that, and that is where the concern really is. It's really the weaker global demand, uncertainty weighing on investments, tighter financial conditions, which basically feed back into weaker business investment, and also hurting consumer demand because of the negative wealth effect. And actually, the second round effects are extremely difficult to quantify and are still playing out as we speak. So our growth projection for FY26 is at the low end of consensus. We think growth will be softer the ongoing financial year at 6% on a year-over-year basis. But we do see downside risk even to this projection. And, globally, Neeraj, we've cut our numbers more significantly for other open economies in Asia, and for the US as well. We've downgraded our growth numbers for 2025.
That was going to be my next question, that would you reckon that global growth at large, as it stands, takes a significant cut on current scenario, and does that, Sonal, change meaningfully? Let's say growth for the ASEAN region, does it change meaningfully if economies are able to strike some kind of a deal with Donald Trump? Because everybody at least in Asia and Australasia, maybe Australia, Japan, Vietnam, all of them are on record saying that they want to go to the US, talk to Donald Trump and try and reach a deal.
That's right. I think outside of China and EU, at least most of Asian countries are looking to negotiate with the US rather than retaliate. And this negotiation is either in the form of lower tariffs, more investment in the US, buying more of US goods. So a lot of countries are offering that. The question is, the reciprocal tariff is actually not just about lowering tariffs. And for instance, the VAT or the GST that countries charge this is an important source of fiscal revenue for these countries. And therefore, it'll be very difficult to negotiate on the GST rate, for instance. Similarly, the tariff on politically sensitive sectors like agriculture is potentially non-negotiable in a number of countries. So I think it is possible that some countries do manage to negotiate their tariffs slightly lower going forward. But even countries that actually have basically an FTA with the US have been slapped with a 10% tariff. So the extent of rollback on tariff is possible, but may not be very substantial. And therefore, our assumption for the US is that US effective tariff rate on its import will be above 20% this year. And if the US wants companies to invest in the US, then they will likely keep tariffs high for some time. So the tariff rates will also be sticky. So some rollback is possible, but I think, it may not be very substantial is what I'm saying. Now, what it means in terms of global growth, nevertheless, is that the tariff shock is quite significant, both directly as well as indirectly through the various channels that we discussed. Particularly for the US, it is a stagflationary shock, and we have cut our growth projections for 2025 for the US. So on a Q4 over Q4 basis, we've cut our numbers to 0.5% up, down from about 1.4%, so nearly a percentage points drop. For rest of the world, it's more of a negative growth shock as well. So for Europe, Euro area and Japan, we've cut our numbers by 0.2 percentage points. And Asia, we think, will be hit the hardest because this is basically home to the open economies in the region, and the tariff rates on Southeast Asia are quite elevated at between 35 to 50%. So the growth impact will be quite substantial for countries like Vietnam, Thailand, Singapore, Korea, Taiwan. So we've made cuts anywhere between 0.3 to 0.6 percentage points across countries.
Moving on, the other commodity which is impacted right now is crude. Actually, it hit a low of almost $60 per barrel. We also spoke with Vandana Hari, expert in the oil and gas space, about how deep the crude fall could be from here on. And she believes that the levels absolutely depend on what US President decides to do. He is the only one who can put a lid on the pricing right now. Let's listen in.
That's probably, those are the most important questions and probably the hardest to answer. With regards to how much lower we could see prices go, I think it depends on what we see in the coming hours. And I'm saying hours rather than days, because I am expecting Trump to put out some kind of messaging, some signal that things are not going to be as bad as the markets are fearing, that what he's doing, he's talked about short-term pain, right? But I'm not sure that pain, that recession qualifies as the pain in his statement. So watch out for what Trump does and says. If he signals that it's not going to be as bad, I would expect crude first to find a bottom and second to start moving up. Your question also was, how quickly it will move up? I think it will be very, very cautious because it will take time for the markets, for the dust to settle. This is a huge shock. There's going to be aftershocks and ripple effects. So the market will be cautious. But at the very least, I think Trump is the only person who can put a floor under prices right now. And as we've seen last week, OPEC Plus has left the stage. So there's really nothing else that can come in to rescue. And I don't think the Fed either. I noticed you were talking about that earlier. I think they are in a wait and watch mode as well.
So what is the upside at this point? And is it too early to call?
Yes, I mean, look, you start thinking of all the supportive factors, one of them being, for instance, that, you just mentioned that TI slipped below 60. Even in the low 60s WTI, it is a bad environment for the U.S. shale sector. So you can assume that instead of the 200 to 300,000 barrels per day increment in U.S. oil output that we were factoring in for this year, at low 60s, below 65 WTI, it's going to be closer to zero. The other argument typically that comes into play is that as prices fall, that will ease inflationary pressures. There will be a little bit of a fillip in demand as a result to low prices. But see, the thing to keep in mind is all of these are very slow-acting factors. So as of now, again, they are not ones that can quickly step in or will quickly step in to steady market sentiment. So we, as I said again, I'll repeat that I think it's watch out for what Trump says and does in the coming hours.
So inventory losses with regards to OMCs, and if you talk about marketing margins, that could improve. So it's a double whammy with regards to, which direction OMCs go from here on, but an interesting aspect that we should be considering as well. But moving on, we also spoke to Walkart founder Habil Karakiwala, who said that Indian pharma companies that export to the US could face some pricing pressure as well as a temporary drop in sales. This was in connection with what impact the tariffs could have on the sector. Let's listen in.
Currently, there are no duties on pharma. But what will happen in future, only Trump will know. I could mention that the impact, it's not easier for anyone to switch manufacturing from India or anywhere else to US. So in the short term, certainly there would be a price pressure on US consumer and healthcare provider in the US. As far as Wockhardt is concerned, we hardly have a significant presence, hardly less than 5%. And we have planned to exit the US generic business. But many other pharma companies have a very large exposure to US business, somewhere between 30 to 50% of their revenue. And they will have to adjust themselves by maybe a little squeeze in margin, little impact also on the sales, because it may affect, but it will be very, very difficult for pharma industry to manufacture all the products in the US, because it will take several years to do that. And it is a multi-product industry, because we have so many products, so many API suppliers, and many of them are from India and China. US hardly manufacture much of the active substance. So it's going to be a fairly complicated affair, but the end result would be the US consumer and healthcare provider will have to accept a significant part of a burden. And the future of pharma industry from India, who have a very large exposure, they would certainly rethink their future strategy. And probably they would diversify the business a little more away from the US.
So that's the overall roundup of what is happening in the markets currently. Completely out of time. With that, it's a wrap on this edition of at NDTV Profit. Please stay tuned to lots more.
तू ही तो है जिसकी सच्चाई वाली क्लैरिटी की वजह से मैं आज यहाँ हूँ।
गोल्ड प्लस सिल्वॉक्सी मिरर्स, ऐसी क्लैरिटी कि आपको सिर्फ सच नजर आए, चाहे कितने भी साल बीत जाएं।
AB Real Estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
He sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank.
welcome you. Watching Profit Buzzers on NDTV Profit, but let's quickly take a look at what's happening with the markets. First up, the pressure does continue in terms of the domestic markets, but what's interesting is what's happening in the global markets. Right now, we're down almost 4.5%. We hit a low of around 21,743. Currently, we're slightly trading, just probably 100 points above that lows level of today. So the pressure continues. Let's quickly look at what's happening in terms of several indices, indices as well, sectors. Because Bank Nifty has been crucial, but it was IT that was taking a beating. Metals pack was taking a beating. So if we can get a heat map in terms of the overall sectoral picture, 4.5% downtick in terms of Nifty Bank as well in today's day of trade. All the sectors continue to trade in the red, with metal being the top loser, defense taking a beating, real estate 5 to 6% is the kind of cuts that we're seeing. In fact, a couple of notes that are doing the rounds currently as well, that the volumes in terms of sales, residential part of the business, is what is expected to take a beating, and that is on the back of the price increases that are happening. Now, how big a concern is this going to be for the real estate pack is something that NDTV Profit will be getting you as well in the coming days. But apart from that, media under pressure, auto under pressure. The least losing sector right now is FMCG, so it's the consumption pack, which is there. Pharma is also down around 2.9 to 3% in terms of the healthcare space. Let's pull up the broader markets, the Nifty mid-cap and the small-cap index, and see what's happening on that front. There you go. Similar are the kind of cuts, around 4.5 to 5% is the kind of cuts that we're seeing. Small-cap, in fact, is down nearly 6% in trade as we speak. In terms of individual names, let's have the heat map of overall Nifty 50 and see what are the stocks doing at that end. There you go. Trend 15 to 16% is the kind of cuts, and this is on the back of the Q4 business update that has come in. But apart from that, the least losing is HUL, Apollo Hospitals, Asian Paints. Again, the reason Asian Paints is the least loser is on the back of the beneficiary benefits that it could get on the back of lower crude prices, but the beating continues. There's no stock that we should be mentioning because everything is in the red as well. One quick update in terms of global markets. If you talk about the Dow futures, they are down nearly 1,500 points at this current point in time. So that is something that we need to make a note of. And with that, if you talk about the European markets, from a FTSE to a DAX to a CAC, all down in that range of almost around 6 to 7.5%. So the pressure has continued, and there is no respite that we are also expected to see taking that handover into consideration on a closing basis. So recovery is something probably which could be out of question. In terms of broader markets, let's just pull up Godrej Consumer Products, because that was one of the stocks which was absolutely resilient in this falling market as well. There you go. It's still in the positive with minor gains of around 0.1% coming in there. And this is again on the back of a strong business update that was given out in terms of the fourth quarter. Apart from that, Siemens is interesting to watch out for in today's session. And the reason why this is important is on the back of the demerger, which comes into effect today. So I think this is the rate that needs to be adjusted. I think this is a wrong rate that we're getting, 43%. The adjusted rate should be around 7.5%. So I would request the director to get that off the screens. Delivery is another one which is, again in the positive on the back of the acquisition that they have made, around 1,400 to 1,500 odd crores, 1.5% up move coming in with regards to where delivery goes. GMR Airports is another one which has been trading in the positive. But apart from that, Lloyds Metals, Car Trade, Sunflag, Trent, all of these are down in that range of almost around 10 to 16% as we speak. So that's with regards to where markets are concerned. But moving from there on, the other thing that we need to consider so far is with regards to the March auto data. Now, what's happening over there? The retail numbers that have come in from FADA are indicating that the overall growth has come in at around 6.46%. That's the number that we're tracking. Now, let's break it down between PVs, two-wheelers, as well as the commercial vehicles. Passenger vehicles has grown by around 4.9% versus what FADA was estimating at around 5%. So a minor miss coming in as compared to FADA's expectations. The two-wheeler industry has ended the year by a growth of around 7.7%. In fact, it's falling short of the 2x digit increase that they were estimating. And the CVs have come in nearly flat in this time around. Now, what has impacted the CV business? What they've indicated is it's the weather. Secondly is the constrained financing. And thirdly, the shifting consumer sentiment. These are the three aspects that have impacted the CV business as a whole. And if you talk about the two-wheelers in the rural market, that has grown faster and higher versus the urban. Three-wheelers, in fact, has seen a growth of around 9% versus outpacing that 0.3% growth in the cities. And PVs have also performed better in the rural belts versus urban India. So that's an interesting aspect that we're looking at so far. We've already taken you through the segmental performance as well. In fact, the March auto data also tells you that there have been dealer concerns, which is in terms of inventory pressures, as well as the targets have been high. And there has been financial and cost hurdles that they have been facing as well. So that's with regards to where the auto pack was. But now let's shift focus and look at few of the consumption companies who've actually recently come up with their quarterly business updates, starting with a Godrej Consumer, Jubilant Foodworks, Trent et al. Mahima standing by to get us more. Mahima, what are the numbers indicating in terms of trend for the entire consumption pack? Because except a Godrej Consumer Products, all of them under pressure.
Right, absolutely. So I'll start with Godrej Consumer because that is something that is, in green today and, has upheld the kind of, and that too in the other direction as to how the markets are doing right now. And this is because overall Q4 business updates are slightly ahead of what the analysts were estimating. In terms of bounce back also, there is a bounce back in home care and there is a strong acceleration overall in the international business as well. In standalone term basis, volume growth to be in mid-single digits, revenue growth will be in high single digits, and EBITDA margins will be in the same range as Q3. So despite of the inflationary pressure also, they've said that EBITDA margin levels will be maintained. In terms of consolidated numbers, there will be high single digit INR sales and mid-single digit volume growth. In terms of segments, mid-teens underlying volume growth in home care is something that they're expecting. And overall personal care will continue to go through the price volume rebalancing. This is because of raw material inflation playing its role plus the price hikes being taken. In terms of international business, Indonesia will see mid-single digit volume growth, and overall the Guam, that is Godrej Africa, Middle East, America is set to see double-digit growth overall. In terms of what the brokerages are penciling in, well, Morgan Stanley has maintained equal weight with a target price of 1231 and MK has retained buy with a target price of 1325. What they're saying is that earnings will rebound in FY26 going ahead. In terms of trend, it's not been a good quarter. Analysts were estimating a growth of roughly 35%, but the revenue growth has come in at around 28%, which is why the stock is seeing a significant pressure in trade today. In terms of stores, it opened 39 new Westside stores and 132 new Zudio stores. They've also said in the last con call that they will be going through store upgradation in terms of format as well, which will put pressure on the margins going ahead as well. And if we see the retailers in tier 2 and tier 3 cities, they have grown significantly in the past 2 quarters. That might also put competition pressure on something like a trend, and Shein entering India is also one of the factors that needs to be watched out for as to how that will play in terms of competition. In terms of brokerage view, Morgan Stanley has still maintained an overweight with a target price of 7184. They were expecting a 35% growth, but the revenue growth is coming at 28%. In terms of Jubilant Foodworks, Q4 again a strong quarter followed by Q3. In terms of like-for-like growth, the momentum has continued from Q3. Overall revenue growth at 34%. Standalone revenue growth at 19%, and like-for-like growth for India came at 12%. In terms of Domino's India, it opened 40 net new stores and Turkey opened around 8 new stores. Morgan Stanley has maintained overweight with a target price of 781. Lastly, Nykaa. So these are some of the consumption names, that are in focus on the back of business update as well.
Thank you, Mika. To cut you short as well, Mahima, I beg your pardon. I mean, Nykaa is something we will revisit as well shortly. But let me very quickly take a view from Amit Bhuptani from Nirmal Bang. Amit, in terms of the FMCG names that Mahima was talking about, any top picks or any sell calls coming in there?
There's also issues regarding two-wheelers have been doing quite well in the last year and a half. A lot of it also is to do with urban rural growth. However, we've been finding that this has been, the growth has been coming down in the last 3 months. And
our prediction for the year 2026 would be that urban again would have to catch up. Rural will be doing really well. We are predicting about 7-8% growth in terms of two-wheelers, and we're also predicting about 1 or 2% growth in terms of passenger cars. Even SIAM released their numbers a couple of months ago, saying that 1 to 3% would be the growth in passenger vehicles. So passenger vehicles remains as a concern, and we as an industry can actually work together to make sure that we are better than what it seems right now at the end of 2026 FY.
Okay. Vignesh, the other aspect I want to clarify with you is in terms of the inventory. You've mentioned, I mean, FADA has said that there is, PB stock levels have risen to almost 50 to 55 days. What would that culminate into if you have to look at an absolute number?
So when you look at it, let me take you about 6 months before, and we were at about 90 days of stock, 90 to 95 days of stock. So it's just been consistently coming down by about a week or 10 days every month. But unfortunately, we have seen that there's a growth of 4 or 5 days of stock compared to 1 month previous. This isn't good because this puts unreasonable pressure on the dealership in terms of inventory funding and the finances. From FADA, we probably say that 21 days of stock would be ideal. We as an industry need to get ourselves to 21 days. Otherwise, it's wastage. There's no point in producing vehicles and keeping them at dealerships without customers coming and picking them up. And we are quite sure from FADA and a lot of industry experts also agree that there's no point in keeping more stock of the same vehicle. And with 21 days stock, there's enough stocking in terms of variety, colors for the customer to come and choose from.
So Vignesh, would it be right to say around 5 to 6 lakh is the kind of number that we should be working with in terms of inventory?
Right now, that's how it is, yes.
Okay. And apart from that, when you talk about any commentary that FADA is picking up, FADA is picking up from the OEMs with regards to the tariff war, because clearly, I mean, no major hit that's coming in terms of OEMs except Tata Motors with the JLR exposure that they have. But what is your comment on the same?
Even the JLR exposure they have is from Europe, is not from India. From India, we hardly export any vehicles over to the US. It's very small and minuscule, and I don't think it's going to affect much. But when it comes to component manufacturers, of course, they do export a sizable portion over. But when it comes to sales, in terms of import, export, I don't think there's going to be an effect. But we need to see how it affects our domestic sales. Because India as an economy is our largest trading partner is the US, and we do export substantially there. So it could be an exporter. It could, and there's a trickle-down effect if our exporters don't do well. So they don't, they or their any dependent industries wouldn't buy from us. So it's very important that in our segment that the economy does well, that people around us do well for us to sell more vehicles. So it would affect us for sure. But I'm sure that the government also would be liaising and having diplomatic calls with the US authorities. It's also good that India has taken a call that we're not going to have any retaliatory tariffs. So which makes sense because it doesn't go anywhere if we retaliate. Let's sit down, talk about it, and solve this as fast as possible.
So absolutely, an indirect impact in terms of the components segment is something we should be watching out for, but that will have to be quantified as well as in things, unveiled. But thank you so much, Vignesh, for joining us on the show and sharing the view. So that's the, commentary coming in from FADA as well with regards to the retail numbers that have trickled in. But one stock that we're focusing on is Tata Motors. One aspect is with the kind of impact that it will see on the back of the shipments that they have halted in the month of April, and secondly, they've also come out with their update as well. Puneet is with us to get us more. Puneet, what are you picking up?
Well, thanks for that. So definitely the tariff impact having a material impact as well on the stock prices today, Hiral. And we've seen that while some impact was seen on Friday, I think today we're seeing a larger impact in terms of stock price, and that is of course led by retaliatory tariff by China, which is essentially triggering a global trade war going forward. Now, Tata Motors has informed the exchanges, or essentially, we wrote to them, and they've come back with a response that they are going to be pausing export of volumes of Jaguar and Land Rover brand cars from UK as well as its Europe manufacturing facility to the US. Now, this was subject to a 25% foreign tariff on the foreign autos by the US government, and essentially that is the stance that they're taking until further updates come on this particular aspect. So that is the first key update that they've mentioned, and this will have an impact in terms of revenue going forward. Earlier, it was expected to have a margin impact because of higher tariffs and passing on a potential delay in passing on those costs to its customers. But now that the company has stopped exports completely, we should expect a revenue impact in first quarter. Now, the other one thing to note is that the Tata Motors already has some inventory maintained for JLR brand in the USA, so that will get liquidated quickly. But overall, until there is any kind of resolution on this, the stock price might be under pressure. And the second key aspect is, of course, exchange filing that came out with. So they mentioned the wholesale volumes for the year was flat year on year at 4 lakh units. And this has been consistent for the last 6 years. So from 2019 onwards, they've just sold about 4 lakh volumes. What's interesting is that the EBITDA margin has almost doubled in this time. So the Q4 results for Tata Motors, as well as the commentary on the company's strategy going forward, will be something to watch out for. They mentioned that currently they have achieved the target of being net cash positive for the year. So we'll look for that kind of quantification. But going forward, brokerages are anticipating EPS cuts in FY26 because of delay of essentially, the sales to the US market from the UK for Jaguar and Land Rover, and hence, we've seen the sharp cut in terms of prices of Tata Motors today.
And thank you for getting us the details, Puneet. Clearly, I mean, this is going to be an interesting aspect that we need to consider, but they becoming debt-free is, a positive as well from a company perspective. Amit, what are charts indicating with the Tata Motors and any other stocks that come to your radar?
If you look at the Tata Motors, the stock has been continuously into the selling zone, and the downturn has been continuously being witnessed while going ahead. As per the current outlook, the major supports are also getting broken out in this counter, and I'm expecting more sell-off in this counter towards the 510 to 515 level. Till the time counter is not getting stable above 600 level, till that point of time, we will witness a sell-on strategy in this counter.
So that's Tata Motors. Another stock that is in focus, that is in the positive, is a Delivery. And this is again on the back of the recent acquisition of Ecom Express. Let me get in Mihika to tell us more in terms of how this acquisition will help Delivery's market position and growth going forward. Mihika, over to you.
Yeah. Well, Delivery over the weekend did announce they're going to acquire Ecom Express in a 1,407 crore deal. Now, it's key to note that Ecom Express last valuations was over 8,000 crores. They will be acquiring 99.4% share capital, and post-acquisition, Ecom will become a subsidiary of the company, and the acquisition is expected to be completed within 6 months. Now, a little bit about the target company. It's an end-to-end technology-enabled logistics solution providers in terms of services that it provides. One is first mile pickup, processing, and network operations, as well as the last mile delivery, reverse logistics, and returns management. Now, in terms of how the acquisition will help Delivery, well, the Ecom Express is the second largest third-party B2C operator. The combined entity holds 55 to 60% market share in the third-party logistics B2C express market, and they improve service quality via network expansion. And there are significant cost synergies realizations over the next 12 to 18 months. In terms of the deal value, the Ecom EV to sales was fairly valued around 0.6 times based on its FY24 numbers. However, the company does not expect the acquisition to be earnings accretive in the near term. In FY24, Ecom Express actually reported a net loss of 260 crores, and this is likely to widen in FY25. Lastly, a quick look to the financial performance of the target company. FY22, Ecom had a sales top line of around 2,000 crores. This has only increased to 2,600 crores in FY24. Margins have remained in the 0 to 4% range, and you've seen their net losses widen from 91 crores in FY22 to around 260 crores in FY24.
Right. So that's with regards to Delivery. Amit, what are charts indicating with the Delivery?
In this counter, if you look at the overall setup from the last 2 months, the counter is trading at the same range, and it has taken a double bottom support on the downside towards the 235 level. So till the time 235 level is not getting broken out till that point of time, we will not witness any fresh selling in this counter. The breakout for this counter on the upside is at 265 level. Once the counter gives breakout of 265 level, then we will witness some buying opportunity in this counter towards the 290-300 levels.
Right. So Amit, that's with regards to delivery. Amit, two sectors that I want to touch with you is with regards to metals as well as OMCs. What are charts indicating? Because major selling pressure on that front. Any sell calls that you have?
If you look at the overall sell-off from any of these counters, then BPCL looks negative currently. If you look at the overall setup, the counter has taken a 200 DMA, 50 DMA support on the downside at 260 level. Once again, if that level gets broken out, then we will witness second leg of selling in BPCL. If you look in the metal front, in metal, Hinzing looks negative and Hindalco looks negative. As per the Hindalco, we are seeing that the counter has been continuously into the selling zone from last 2 weeks of a trading session, and in today's session also we are seeing that it has been broken out with the volumes, so more pressure can be indicated while going ahead on the downside towards the 535, 530 levels on Hindalco.
With regards to Hindalco as well. So these are a few of the stocks we are watching out for. Thank you, Amit, so much for joining us on the show and sharing your views. But very quickly, let's quickly take a look at what brokerages have to say in terms of the tariff war and what is their India strategy. Bernstein is cautious on India. What they are saying is avoid exposure to IT as well as the healthcare sector. In fact, the recession-proof portfolios are something that will be hard to build from here on. They are preferring fixed income over equities, and this is mainly for risk aversion. And they've added Power Grid and M&M for their macro recovery and the consumption growth. And they've cut their exposure with regards to IT by dropping their coverage with regards to Coforge. In fact, Infosys, NTPC, Power Grid and Adani Ports, these are few of the stocks that they have in terms of their model portfolio. IndusInd Bank, M&M Avenue Supermart, Jubilant Food as well as Bharti Airtel. After that, if you see in terms of Goldman Sachs as well, what they have indicated is that the tariffs may cut India's earnings growth by around 2 to 3% over the next 2 to 3 years. Clearly, they are projecting 11% and 14% earnings per share growth for 25 and 26 respectively. And very lastly, if you talk about their 12-month target in terms of Nifty 50, that has been lowered to 25,000 from a 25,500 earlier. Lastly, you have CLSA. Now, what they are saying is that there is risk in terms of further short-term weakness, and with pressure building in on risk assets globally, the breadth thrust buy signal coupled with the daily momentum indicator suggests that the pullback should be limited. That's coming in from a CLSA as well. So that's the overall strategy that the brokerage houses are indicating so far. Completely out of time. With that, it's a wrap on this edition of Profit Buzzers. Lots more lined up on the other side. Please stay tuned to NDTV Profit.
That's huge. That is a biggie. It's on.
Gold Plus Clear Glass. पार हो या नियर, सब कुछ दिखे clear.
Can we see illogical prices on the downside in asset classes as well? Because everybody's saying that Indian economy doesn't get impacted, but the uncertainty may still bring market valuations much lower than maybe long-term averages too, right? Can it happen?
Undoubtedly, Neeraj, but markets can remain irrational more than you can remain solvent. While this phrase is used mainly for shorting side, it can be true even on long side. If you are taking leveraged position, you may think today X is the fair value, but with a policy change, X minus something can become fair value, and hence markets will have to make adjustment. Anyway, markets are always trying to forecast future. As of today, we don't know what kind of tariff will be there on pharma products. Who will bear the burden, manufacturer or the distributor, which has disproportionate margin? but yet market is going to take pharma stocks down, assuming that tariffs will be levied as irrationally as it has been levied on other products.
Nilesh bhai, good morning. Hiral on this side. Let's talk about history as well. I mean, tariffs have been levied by the US in the past. We did see that resulting in inflation, or it could be much more leading to recession or something like a Great Depression that we saw. I mean, is it a good comparison?
Hello and welcome. You're watching Top Trades on NDTV Profit with me, Somit Sarkar, and my co-anchor Mika. Well, Mika, we opened lower, but we managed to gain in the day. But at 12:33, we did hit the intraday low of 21,796. Right now, we are just 4.5% down.
Yeah, we opened straight 5% lower, and even right now we're over 1,000 points, in the red. In terms of, the counters on the Nifty 50, all of them are in the red. So, your top loser is a trend. One, you have, the weakness in the market that's affecting the stock, but also there are operational numbers were not as great as what the street had expected, down about 15%, followed by JSW Steel and Tata Steel, both the counters over 8.5% lower. Shriram Finance, Hindalco, L&T, all of these stocks are on the losing end on the higher side. Something that's doing fairly well compared to the other Nifty 50 counters is an HUL and Apollo Hospital, seeing cuts of just less than 1%. If you look at the sectoral gainers, well, all your sectoral indices are in the red. The top losing sector is the Nifty Metal, down about 8%. When you talk about the fears around US and a global recession or a slowdown, it does have an impact on demand, supply, and thereby the commodities, especially in the metal space. You've seen all the non-ferrous counters actually lose over 3% in prices since April 3rd. Nalco, JSW Steel, Hindalco Copper, your top losers in the Nifty Metal today. They're seeing cuts of 8 to almost 10%. Something that is also not doing well is the Nifty Realty. The Nifty Realty is down 5.7%. All of the counters are in the red yet again. Something like a Soba is your top loser. It's down about 9%, followed by a Suntec Realty. And lastly, when you talk about the broader indices, they're seeing cuts fairly the same levels. The mid cap 150 down about 4.4%. The small cap 250 down about 5%, and is the worst performer among the major indices. When you look at what's actually, you do have two counters gaining on the small cap, and that's Asahi India and CCL Products. Small gains of just less than 0.5%, but they're in the green nonetheless. And something that's on the losing end of your small cap 250, you have a Godavari Power 11.5% lower, Jindal Saw, Swan Energy, Anupam Rasaya. All of these stocks is down over 8% in trade today, Samit.
Yes, with that, let's also welcome in Probal Sen, the senior research analyst on India oil and gas sector, institutional equities, ICICI Securities. Sir, firstly, to start off with such kind of volatility in the crude oil prices, given the fact that there is now Trump-fueled recession fears, OPEC Plus is also looking to increase their output. How are you, or what is your now base estimate for crude oil prices for the remaining part of 2025?
I think, it is very fluid in terms of, what crude is expected to do. Very clearly, the kind of upheaval that the markets have seen in the last couple of weeks, and in addition, the decision by OPEC to also sort of start to wind down production cuts probably earlier than what everybody expected, means that I think there is a lot more bearishness that is there than what was there maybe about a month ago. We would expect that crude would probably operate in a narrower range of between $60 to $65 at this point of time. There is a case to be made that it could decline even further if the economic pain probably persists, or there is even more of let's say the intensity of the tariff war probably picks up. Let me put it this way. That can cause even more pain. But the reason why we believe 60 can be a useful floor for if you look at a 6 to 9 month period is because the US shale gas producers or shale oil producers have consistently said that below 60, a lot of their marginal fields start to become uneconomic, and therefore there could be production outages or supply related issues in the US below $60. And that reaction tends to be fairly swift from the US producers. Their decision making tends to be very, very efficient when it comes to deciding between economics and volumes. So, in that sense, I think earlier our base case was basically building in somewhere between $70 to $75. That is certainly coming down, but we would like to wait and watch probably for the next couple of weeks as to where it sort of normalizes or where the sort of volatility reduces a bit before taking a final call, on our base case estimates. But clearly, at this point of time, 60 to 65 seems like a workable range for crude.
No, Robert, to add to that, the advancing of, putting more oil in the market was something that was unexpected. Do you expect that, given the kind of decline that we've seen in just the week itself, down about 15% in terms of Brent crude, do you think OPEC has chances to go back on this decision? Because, historically, their strategy has always been higher prices.
No, absolutely. I think nothing stops them from reevaluating the decision, but I would believe that, this tariff thing, I think to a certain extent was being advertised well before their decision came through. Obviously, the extent of tariff increases that the US has put has caught everybody by surprise. But you have to also look at the economic realities of a lot of these OPEC countries. I think it was coming to a point where they have to start looking at absolute earnings rather than per unit revenue in terms of the oil that they're producing. Maybe that is what sort of precipitated the decision to release these barrels quicker than imagined. But yeah, absolutely, you're right. I mean, depending on the market reality, nothing stops them from again sort of tempering this output release in the next meeting as and when it's held. So it's something that we can only wait and watch at this point of time in terms of how this plays out.
Right. Right. Usually, oil marketing companies like HPCL, IOCL, and BPCL are termed or assumed to be one of the biggest beneficiaries of a drop in crude oil prices because their marketing margins usually tend to go up with stable fuel prices, that is petrol and diesel prices. But in this case, given the sharp drop that we have seen, there could be higher inventory losses also for them. So, is there even a case to go into and buy an oil marketing company at the current juncture, or should one just wait and watch at this moment?
Again, I think you hit the nail on the head. There is a possibility of an inventory loss. There is a real possibility that GRMs could actually struggle even more from here. So while there is a clear positive that emerges in terms of retail fuel margins, specifically in the current environment where price changes are not really that frequent and the benefits are not being really passed on, there's been a $7-8 decline just in the last few days alone, which adds maybe about 4 rupees to the blended margins if the same price decrease is seen in product prices as well. But inventory loss, I think, will become clearer closer to, let's say, June in terms of what the pricing is, number one. Secondly, there is also LPG losses that continue to pile up without any compensation from the government. And third, there is an expansive capex plan that these companies have, which might act as a small buffer against very aggressive price cuts being pushed through by the government in its capacity as a promoter of these companies. So there's a whole lot of moving parts at this point of time. My sense is that, and our call remains positive structurally on the OMCs. We do believe that even with price cuts, even with what's happening, integrated margins for the three companies probably will remain slightly above historical levels. And therefore, earnings growth will probably continue to be a little bit of a positive surprise at this point of time from a 12 to 18 month perspective. But within that, there is a whole lot that can actually go on in the next 2 to 3 months. So this is something that, like you, we'll have to wait and watch in terms of, how the crude movement is and what kind of margins play out over the next couple of months.
Right, sir. So with crude now averaging around $65 per barrel level, what is the possibility of how high has the possibility of a fuel price cut increased to? Because few days back we also had the minister saying that they will look to pass on the benefits to consumer, and now crude at least trending below the $70 per barrel mark. Do you think that anytime soon we can hear a fuel price cut coming in from the government side?
I think the oil minister is best placed to answer that question. But one would, yes, I think one would believe that if they have stated very clearly, I think to their credit, that they would monitor it and they would want a prolonged sort of softness in crude prices to emerge before taking a call on how much to pass on. So I think the real question really is not whether a price cut will happen. I think that given the environment today, there is a fair possibility that that will happen. The real monitorable would be how much is passed on and how much is allowed to be retained by the OMCs, given the realities of capex and LPG losses, which I mentioned earlier. I think that is what will be a key monitorable. But yes, the probability of price cuts obviously goes up the longer the softness in this crude remains below $65. That is for sure.
Okay, and Prabal, what about your oil exploration companies, ONGC, Oil India? I mean, first you had the windfall taxes capping their realizations, then the need for that was not there anymore. Now you have crude trading around $63 per barrel. Does the outlook or positive outlook change for the companies?
Absolutely. I think you mentioned windfall taxes, which basically prevented the gains of above $75 coming in. But having said that, as long as it remained above 75, there was a fair amount of comfort that net realizations would remain at $74 to $75, which was a fairly comfortable level, given that operationally things are looking up now for both companies and are likely to remain so for the next couple of years. But with the steep decline that we are seeing now, the very simple math is every dollar decline, in crude generally affects standalone earnings by about 1.3 to 1.4%. So if you look at the fact that crude is now down more than $10 below the $74 level, which is what has been the realization over the last several quarters, that's a straight 13% hit, give or take, on an annualized basis on standalone earnings. So again, as I said, this is a clear negative. And if it persists at these levels, obviously, I think earnings, including ours and the streets, will get downgrades. There's no two ways about it.
Right. Well, shifting focus from OMCs to IGL now, a few days back, the company announced the much-needed price hike in the Delhi region, which contributes nearly 70% to the volume. What would be the impact on the margins of this, and how much more of a price hike is needed for IGL to get back to the Q2 margin levels?
I think, given the levels of spot LNG prices and term LNG prices, obviously we always have to make a guess estimate in terms of what the proportion is of each source in their portfolio. But our sense is that probably another 3 to 4 rupee, hike in Delhi might be needed to restore margins completely to the Q2 levels. But the broader point is, I don't think the CGDs are actually looking at restoring margins to those levels. I think the strategy very clearly is probably to increase it to the extent that it doesn't impact volume growth, and basically look at a balancing between reasonable margins and continue to support volume growth, rather than chase after the high margins that they saw over later FY24, early FY25. I think that seems to be very clearly what excuse me. I think that is something that will be the strategy. So, of course, the companies might have their own say on the matter, but what we really are building in is slightly lower margins, but steady volume growth for these three companies, specifically IGL and MGL, going forward.
Got it, Prabal. Thank you so much for joining us and giving us your insight on how the oil and gas space looks like amid these things. But viewers, it's time for a quick break. Would you stay tuned? Lots more lined up on the other side.
गोल्ड प्लस ऑप्टिमिस्टिक रिफ्लेक्टिव ग्लास लगाओ, धूप की गर्मी को दूर भगाओ और बिजली का बिल भी बचाओ।
AB Real Estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
he sold most of his stock, 80%, as on that date.
We have requested the management to come and speak to us. They asked us, what questions will you ask? We've sent it to them. They don't want to answer it, so then let's put it to our viewers as well.
7 key questions, right? How is it that 2,000 crore goes unnoticed by all of these auditors?
Is seeking more information on the trades and the all the transaction which has happened from the exchanges, both NSE and BSE.
The Reserve Bank of India's supervisory officers, they are seeking compliance reports on their foreign currency borrowings by these banks.
The DSS is actively engaging with the Reserve Bank of India to sort of ensure the thorough examination of the matter. And
IndusInd Bank, as part of its internal review, had found that certain aspects of its derivatives portfolio was not meeting the standard that was set by the Reserve Bank of India.
Well, thanks so much for tuning into India Market Close. I'm Neeraj Shah, and a very special guest to try and make sense of all that's happening around us. Jim O'Neill, ex-chair of Chatham House, ex-chief economist Goldman Sachs, ex-commercial secretary to the UK Treasury, and probably one of the finest voices to try and explain what's happening around us on the show today. Jim, thank you so much for taking the time out and speaking to us. This is Neeraj here. What do you make of the first order and the second order impact of the tariff war, as we call it now, post China's retaliation?
It's pretty scary. You have the two economies that have contributed more than 50% of global GDP since the start of the millennium, throwing very large bricks at each other. It is not very good, to put it mildly. And the stance of the leader of the free world appears to be literally trying to throw an even bigger brick in the core operating system of how the world economy and business and financial system has operated since I've been born. So, not surprisingly, financial markets around the world are reacting accordingly.
Most certainly. Now, Jim, the extent of tariffs that US imposed were a surprise, but the way China has reacted as well, it almost seems as if China believes that it spent years fortifying itself against US pressure and now can last longer in an economic war. What does this imply, or what are the implications of this move for world economy? Because other nations, particularly in the EU, may follow suit, even if some of the Asian nations might go out and do a deal with the US.
So obviously, it is all very, very unpredictable as to what each day and week now follows. But first of all, it's important to not get carried away with any sophisticated approach the US has used here. As a number of people have commented, I strongly agree with this. There has not been a lot of thought put into the true meaning of reciprocal tariffs, effectively influenced by his extreme anti-trade supporters. Trump has come up with a system where anybody that runs a trade surplus faces the biggest tariffs, irrelevant of whether they actually had tariffs on the US or not. And so, not surprisingly, the temptation for any other country, particularly those that are the biggest exporters to the US, is to reply accordingly and to do it in a way which hurts the things which have benefited most from this US-led global trade system the past 60 to 70 years. Now, that said, I personally think the Chinese should have waited a little bit, as the Europeans are trying to do, and not least because there could be some scope for negotiation. I think, or I used to think, the current US Trade Secretary, Scott Bessent, is a pretty sensible person that understands markets. And I say that because how many days that we have this kind of huge drop in global stock markets going on, which, as we've seen during the 40 years of my adult professional life, the more they go on each day, the more negative feedback loops they can have into things that were not anticipated. And it's very interesting and worrying that so far in the European morning, and from what I can see from Asian trading, major banks are suffering particularly badly. And if we start to get into that issue, then there's a knock-on effect for bank lending and for real estate stocks, something which might really personally upset the US president. So another reason to wait is at some point, you would imagine even President Trump might decide to change his mind and try and persuade other countries to offer him some kind of way out by a sort of token of some kind of deal. But if he carries on with the tone that he gave in interviews overnight or early this morning, then I can't see any respite in the near term. And you probably will get other countries following some kind of response the way that China did. The most sensible thing to do for the rest of the world, as I tried to say on Friday here in the UK, is whilst the US is the biggest economy in the world, it's not as dominant as the US financial system and the US security support. So in that example, the G6, which is the rest of the G7 minus the US, collectively is the same size as the United States. And the G20 minus the US is obviously dramatically bigger if it includes China and India. And so what I would really encourage, and I think this is already happening, is leaders of the rest of the world that believe in free trade should get together and actually pursue lower tariffs between themselves and actually significant ideas about boosting cross-border trade in services. And if they manage to do that, it would diminish the global importance of what Trump is doing here, and end up just really harming US multinationals and the US's remarkably successful role in post-war economic and global governance leadership. It's kind of bonkers what Trump is doing, in my opinion.
Point taken, Jim, and therefore begs the question, and Harsh also joining in, begs the question as to whether a pullback is likely in your view. Will he flip on the current position he's taken, and if so, how quickly, and will he be forced to, not only from a market perspective but even from a US consumption perspective and inflation perspective?
Well, he has, I think Wednesday is the day that the reciprocal tariffs are supposed to come into existence. So obviously 48 hours isn't normally a long time, but in these current markets, as we saw in 2008, as we saw in 2001, and for people like me who were around this business then, as far back as 1987, 2 days when you have this kind of financial market turmoil is a very long time. So I would be surprised if there was not some kind of hint of a shift. I mean, cumulative, we're looking at something like, I think Japan has already entered bear market territory, and many other markets must be pretty close to it, including the United States, which of course opens in a few hours' time. And if you look at what was said by key cabinet members, particularly again Scott Bessent, since Friday's close, there's a hint that if other countries really do offer some kind of alternative concession, which could range from deliberately allowing their currencies to rise sharply against the dollar, or some kind of commitment to boosting their own domestic demand and importing more from the US, I would imagine at some point, Scott Bessent would certainly be trying to tell the president, let's call it a day and claim victory. Because if we carry on like this, there could be exceptionally strong lasting damage, which will make it very hard to recover from, including for things that are important to Trump's own domestic agenda. And I think, as your question implies, if Trump is really, really, really intent on going this way, then the biggest damage is going to be to the US consumer, because the US consumer has been the single biggest beneficiary of all this mayhem, of all this system that we've had for the past many decades.
And Jim, what should one make of crude and metals at this point? This uncertainty with regard to crude and the global uncertainty creating what it has on in terms of an impact on crude. You feel that justified in a certain sense, or do you feel that you could start to see this wane quickly?
Well, you know, markets are markets, and I would imagine the one thing we're guaranteed for just this trading week is extreme volatility. And the first hint of any kind of backing off from Trump or his advisors, then you will get a big reversal in what's happened since Thursday morning European time or Thursday morning Asian time. And of course, commodities and crude oil have been part of it, because in essence, the markets are very quickly pricing for some kind of recession. And as we've seen, I think in 2020, during the worst of the COVID days, I think the near-term oil contract actually went negative briefly. So, you know, if Trump repeats what he said last night US time or early morning our time again during the day, then if anything, the market declines and the price of crude will accelerate downwards, because we are literally witnessing, if it's left to how it is, of a dismantling of all major global multinationals that have so painstakingly built up to the global relevance they have been for many decades, and they will not be able to cope with this kind of savage shift in the rules of engagement that Trump is effectively trying to impose. What I don't understand is this sort of naive assumption that it's only going to affect corporations outside the US. I mean, a lot of US multinationals are responsible in their own sophisticated roles of causing the US trade deficit. So why they haven't realized that is quite remarkable, in my opinion.
Jim, such an important point actually from a global, sorry. I'm saying such an
I can't hear you.
Yeah, maybe you can hear me now, but I was saying that such an important point from a global corporate perspective. We're worrying about markets, but from a global corporate perspective, this is such an important point. One more follow-up to that, please, and final question from my end, is that if indeed the uncertainty lingers, and even if there are some concessions, with an assumption that China's exports to the US do not continue in the same vein, and they get redirected to the rest of the world, and therefore the rest of the world, particularly the Asian region, erects its own tariff barriers to protect their own industries from the China supplies, does this morph into a global trade war, unintended as it may be for some of the other nations?
I mean, I think it's quite, that again is of course part of why markets are doing what they're doing. Because whilst the intention of any one country might well be to stand for free trade, if they now see the first evidence that very large exporters like China, or for that matter Germany or many others, start to try and dump their excess stocks, which would normally go into the US to other countries, then you will get that kind of response, because obviously governments will try to support their own economies, and they have to try and react pretty quickly to try and demonstrate to their people that they're not just going to stand there and do nothing. But as I said earlier, a much more constructive, albeit very, very difficult way for countries to respond, including China, is for the rest of the world's leading nations to try and get together. And we have a small template that's ironically been already discussing things in the past 2 or 3 weeks on the Ukraine war, or what our own Prime Minister in the UK calls the coalition of the willing. There should be intense efforts going on between, let's call it a trade partner coalition of the willing, to try and make sure what was the world's global trading system can still survive for everybody else. And I suspect that if they were so determined and successful, which of course couldn't happen in 24 hours, but the intention could be, and that in itself will cause many, many influential people in the United States to actually think, hang on a minute, should we be either allowing or within the constitutional system in the US actually supporting constitutionally our elected president to take us out of this system, which despite all the issues it's raised for the left behind in many countries, despite all of that, has contributed to this dramatic improvement in the health and wealth of, hundreds of millions and billions of people around the world, including in India and much of Asia.
Fair point. Jim, last couple of thoughts. Any viewpoint with regard to what the impact on US trade deficit could be of some of these measures, and any view with regard to what the revenue side impact to the exchequer in the US could be as a result of these tariffs and measures? Any visibility on those? Your view would really help.
I mean, on the first question, the only way this is going to all impact the US trade deficit if it forces the US into a recession. At the end of the day, the biggest drivers of trade imbalances are the relative levels of domestic demand in a cyclical sense. And so if there's a sharp decline in US domestic demand because of the relative price shock to the US consumer, that will cut US consumption, the US will go into recession, and imports will fall sharply. Underlying demand can only be affected by the balance between US domestic savings and US spending needs. And if this is a reflection of a more genuine desire of the US to rebalance its consumer and its spending and its investments, then they're going to have to undertake policies that deliberately raise the domestic savings rate, which, by the way, would mean a net reduction in net capital inflow to the United States, which would have consequences for the value of the dollar, and possibly, and this is one of the many, many indirect consequences that could follow, is actually start to introduce the beginning of the end of the degree of dominance of the dollar in the global monetary system. Because, again, other important countries in the world will now start to really realize, do we want to be dependent on this erratic leadership from the United States as it's struggling to deal with the complex challenges which go with these kind of responsibilities and privileges of being the dominant player in the world system. Analytically, of course, it's absolutely fascinating, but for people running any kind of global business, this is a nightmare.
Right.
This is so true, and this is just so many insights that have come in, and couldn't thank you enough, Jim O'Neill, for joining us today and giving us all of those. Maybe we'll get a chance to talk to you in about a month and a half from now if this trade war worsens.
Okay, look forward to that.
Thank you so much.
Actually, I look forward to it speaking to you again, but not in the context of the circumstances.
Cross fingers. Thank you. Right, that's Jim O'Neill. But this is so important because I didn't give a thought to this, but just the crisis management that corporates would have to do.
Correct.
Especially ones which are spread across the world. I mean, there's a note, I think, from SocGen or one of the brokerages on Apple, wherein 100% of the iPhones made in America are imported from China.
Correct.
And as a result of this, what happens to their supply chains as well? So quite crazy, really, for a global corporation as well. And a lot of Western corporations are truly global in nature.
And how will they hedge against this? Who bears the ultimate cost? I believe all of that will unfold, and that uncertainty is probably playing out in markets at the moment. So
yeah, looking iffy. But Harsh, we haven't done a market check, so why don't you give it a shot?
Yeah, so okay, let's pull up the Nifty 50, please, very, very quickly. We're around 4% odd lower. And I myself am also going to quickly pull it up.
Holding on to 22,000, by the way.
Yes,
so,
we've held on.
I mean, we went up, went below, closer to close right now, and still 1.5 hour away, so never know. But 22,015.
Correct. So, yeah, so we're at the 22,000 mark, roughly about 4% or so lower. Banks also down around 3.6 odd percent. That's the Nifty Bank. When we're looking at sectors, well, pretty much all sectors lower, but Nifty Metal down 7%. Want to quickly mark out the ones which are really standing out in trade. IT down 4% plus. Realty down 6%, near 6% fall on the Realty Index in a single day. Now from 1100, the Realty Index looking at 750. So real fall there. FMCG relatively okay, 1.3 odd percent lower, but auto largely driven by Tata Motors as well on the impact, down 4% odd. So some pockets which are seeing pain, the metal index especially, pronounced pain there, 7.5% nearly lower. So that's how it's playing out. Let's look at the advanced decline as well, if we can. And I'm sure that it's extremely shallow. There you go. Very, very tough to find any stocks advancing in trade. And within the Nifty small cap, the index is down nearly 5%. And the gainers are just 6 out of the 250 stocks on the Nifty small cap index. Delivery being one of them. Interesting update, interesting acquisition, and that's why that one is perked up in trade. The other one is Vedant Fashions, a CCL, an Asahi India, Crompton, and a Rainbow Medical. So there are only 6 stocks within the Nifty small cap 250 which are in the green at this point. The Nifty mid cap as well, seeing 4% plus lower. So some bit of pain. The India VIX, if we can quickly pull that up, now at 22. So spike there, a very, very strong spike seen. Yeah, so that's how it's playing out. Plenty of pain across sectors. Neeraj, you want to probably mark out a few stocks outside of...
Pick up anything except for maybe a Godrej Consumer or a few others which are actually doing okay. It's just looking very, very wobbly, Harsh. So that is the main problem, that there are hardly any pockets which have withstood the pressure in the session today. FMCG too is down about 1.6%. So that tells you the nature of the story per se. But very quickly, I mean, if for whatever it's worth, the oil marketing companies, HPBP, could be interesting ones because they would have fallen. HPCL in particular, the marketing margins look so attractive for HPCL at these prices on crude that no surprise that HPCL is trading in the green. So that is a respite. Harsh spoke about delivery being one. GMR Airports is the other one which has gotten about 1% higher. And FMCG, Godrej Consumer, HUL, Britannia effectively look okay. What's looking ugly is of course Trent, and we'll talk about that in detail, of course. So keep that in mind as well. And a clutch of others which have fallen quite a bit. But we spoke to some very important voices in addition to, of course, Jim O'Neill that we just spoke to. So Robert Sokin, senior global economist at Citi Research, spoke about the approach of countries amidst global tariff outbreak. He also emphasizes that how the US economy is going to shape up. Listen in.
The Federal Reserve is not playing a political game. They try and be as apolitical and as technically oriented as possible. But I do think, to President Trump's point, I do think where the Fed is going to be rate cuts, because with the tariffs, it's a stagflationary shock for the U.S. economy. It boosts inflation and it lowers growth. For the Fed, that's between a rock and a hard place, because when inflation's higher, you should be hawkish, and when growth is lower, you should be dovish. So there's a question of which side of the mandate they'll put more weight on. But I think they will focus more on the downside risk to growth. They'll look through the inflation effects. So I think we're looking at least several rate cuts this year, potentially starting soon in the second quarter. But bottom line is, I think rate cuts are coming down. Rates are coming down, and it will depend in terms of the number of cuts. All of the questions we were talking about earlier: how long these tariffs stay in place, what type of retaliation we get, how large the negative effects are. But I think it will be a Fed that is easing policy this year. Right now, we're assessing many channels through which the tariffs will impact the U.S. economy and the global economy and economies that are directly hit with these tariffs. And there's kind of the math of the direct effect of what these tariffs will do. But then there's all sorts of channels through which those effects could be worsened and magnified. In particular, if consumers and businesses really get concerned about this environment and they start to pull back spending even more, investment even more than they would otherwise with these tariffs, you can get kind of magnified negative effects. And I think with the way this first couple months have moved, with a lot of uncertainty and a lot of surprises from the Trump administration, I do think uncertainty is here to stay. Even if you end up with some negotiations on these tariffs, you could get more tariffs coming on and off. It's a very hard environment to plan. And so I think, at least for the foreseeable future, uncertainty is going to be high. And that really runs the risk of weighing on economic activity and also weighing on financial markets.
Okay, so that's Robert Sorkin, of course, giving views. We've had plenty of them, frankly, and those views keep pouring in. We have Nilesh Shah with us, founder Envision Capital, to talk to us about everything markets. Hi, Nilesh, Harsh here. Quick check with you with regard to how you're viewing this entire setup from a global standpoint, as well as how should you look at Indian markets. First off, let me have that broad-based view.
Yeah, so clearly there is now an extended period of uncertainty. If last year the whole year was more around uncertainty around inflation and interest rates, this year it's back to tariffs. And clearly the tariffs have been a negative surprise, not conceptually, but just in terms of the extent and how widespread they are. Clearly, that's actually something which has spooked the markets. I think in terms of India itself, I clearly believe that the impact is probably going to be relatively minimal compared to the impact that could have on some of our Asian peers and some of the other emerging markets. So I clearly believe that fundamentally the impact is going to be relatively less versus others, but nevertheless there is going to be some impact. And that we will have to live with a period of uncertainty. So what it looks like is that maybe this uncertain times could last for a few more months. Maybe it could last for another maybe 3 to 4 months. By the time we have some bit more clarity in terms of which way growth and earnings are likely to unfold. So I clearly believe the markets will go through a period of consolidation for the next few months before it develops a sense of direction.
Right. Nilesh, I wonder how bad the India impact actually is. The uncertainty, understandable, and market-facing jitters, also global markets having a bit of a rub-off effect on India, understandable. But do you believe that the India impact may not be as earth-shaking as is being felt elsewhere globally, or is being estimated at this point?
So surely I think as an economy, we're going to essentially be relatively less impacted. So it's quite possible, and basically one kind of reads the views of economists, and maybe from a 6.5% GDP growth rate, we probably slip down to maybe about 6% or so. So there would be maybe a 50 to 75 basis point impact in terms of GDP growth, which obviously is going to be a fantastic place to be in context of where the global economy is going to be, and the fact that a market like US or an economy like the US is expected to kind of slip into a recession. So versus maybe economies like US having probably a negative growth rate, or maybe a large economy like China would probably see significant shave off in terms of its GDP growth rate. Versus that, India could probably still be able to kind of grow at close to about 6%. I mean, surely in this environment, it's going to be hard to kind of think about India growing at more than 6%. So clearly believe that from that context, the impact is going to be relatively less. But the bigger challenge for the markets is that in the short term, the markets move with sentiment and with liquidity. And because of the kind of uncertainty that has got created, we're going to see both sentiment and liquidity getting impacted. And that to me is a bigger risk for markets versus a significant deterioration of the growth outlook. And that's something which we will have to kind of navigate through maybe for the next 1 or 2 quarters.
Nilesh, good afternoon, Neeraj. I was really looking forward to talk to you. Now the question is this, Nilesh. You've seen some of these cycles, and I was trying to ask our guests earlier that are there parallels in history which was similar? And most answers were a no, in some sense. You could drag it all the way back to 1930. Maybe you get some parallels to it, but not quite there too. So the question is this: can the uncertainty last for longer? Can there be a currency devaluation or goods coming into other countries, therefore tariff barriers erected by other countries, and therefore a global tariff war, etc., etc.? And therefore, can this picture get much uglier before it becomes worthwhile to buy? Is it possible to hypothesize on that?
Neeraj, yeah, one can't rule out all possibilities. This is surely a situation which none of us have basically seen or witnessed, even over the last 30 years or so. The big difference, Neeraj, I think, between what we have seen over all the kind of crises that we have seen over the last maybe 20, 30 years and the scenario today is that earlier there was a lot of conciliation and conciliatory action and coordinated action, or basically a coordinated response to the big challenges. Versus that, we are now in an era of unilateralism, and so that's something which none of us have seen. And this is a scenario which probably has not played out in maybe the last 80 to 100 years, or probably played out 80 to 100 years ago. So that to me, I think is the very big difference. But Neeraj, keep in mind one thing, that one is markets do tend to exaggerate the eventual outcome. And just to kind of think about it, markets peaked out probably in September, October, but the event is unfolding in April. Okay, maybe it might take another 12 months for the entire outcome to play out, but keep in mind that markets will bottom out a lot more earlier. So we have to keep that in mind as investors. And we have to also keep in mind that there will be a situation where the valuations become so attractive that it more than factors in even like kind of a base case scenario. So these are some of the situations that we as investors have to be prepared for, or keep preparing ourselves for, that we don't necessarily have to wait for 100% clarity or certainty. The markets do tend to peak out much before, and the markets do tend to bottom out much before. So one has to, as investors, keep that in mind.
But you're not saying we are at that stage right now?
No, I don't think so. Probably because, it's something which is barely 1 week old, right? And there is unilateral. This is not like that COVID has struck And therefore, there's going to be concerted action by all the world's countries and governments together. This is not about a global financial crisis where all the central banks say, okay, now let's step in together and ensure that there's enough liquidity to bail out stressed firms or firms which are on the verge of bankruptcy. This is not like 2001, when there was a 9/11 strike and therefore saying, let's together fight out or weed out terrorism. Okay. This is something which is very, very different. This is I think what makes this so different from the past challenges is essentially unilateralism. And you're going to see unilateralism being responded again by unilateralism. That I think is something, and so clearly it's going to take a few weeks. It probably will take a few more months to see how essentially the responses play out. And so therefore, I don't think that we're kind of done with it. We probably essentially will still have to kind of go through for another few weeks and a few more months before we essentially have some sense in terms of whether this is played out or not entirely.
Such an important distinction, and Nilesh, thanks for making this, because this was really, really good to kind of distinguish between COVID or some of the other things that have happened in the past, 2008 also maybe, versus right now. Now, I have one more question for you, Nilesh. I'm sure Harsh has maybe a couple more, but you spoke about some of the markets bottoming out a lot earlier than when the economy does, if you will, broadly speaking, right? I wonder if sectorally some of the themes might be there, and you would have guessed it that I will ask you about IT. We're on the cusp of a commentary from TCS this week, but be that as it may, from December peaks 30% lower, a clutch of stocks even more lower. The sad part is in the last 30 days, not one IT company has come and spoken. So it's very difficult to get a sense of how they are feeling. But maybe you've got a chance to speak, you've got to analyze, and you look at this space so closely. What's your feeling about IT services?
So Neeraj, my broader sense about IT services is that it's probably been one of those sectors, especially I'm talking now about the large cap IT, is like it's probably something which has been the most overrated in terms of prospects. The bottom line is that even when we didn't have a crisis like this in the last 10 years, these are companies which probably have grown only in single digits. And keep in mind that a lot of this spending by the Fortune 500 companies is non-discretionary, which means a lot of the spending is basically about maintenance, application, and things of that kind. Okay, so I honestly don't think that basically that it's the end of the world for the IT services companies. Okay, so to that extent, I'm honestly not sure whether it's going to kind of play out so badly for the IT services companies the way we've seen the reaction to stock prices in the last few days. So I probably think that instead of maybe a 5 to 7% growth, maybe you will have companies grow at maybe 2 to 4%. But I honestly don't think, Neeraj, that we're going to basically have a situation where there will be degrowth. Okay. And we have to keep in mind that the big IT companies typically have been in a range of between 20 times to 30 times P multiples to trailing earnings, 20 to 30 times. They're probably almost there. It doesn't mean that, of course, they cannot fall below that. But my view is that any fall below that will just be an aberration. So I would still kind of think about IT services companies being more an arbitrage on PE multiple valuations, which means that closer to 20 times, they kind of end up being a good time to kind of start being constructive upon. And obviously closer to those 30 times P multiples, you obviously have to be taking your money off the table. I mean, this is obviously for the large cap IT services that I'm talking about. So it's quite possible, and I'm not saying it's going to turn around immediately. It will still take another 1 to 2 quarters for things to essentially fully come to grip with it. But that's about it. I honestly don't think it's end of the world or end of business for IT companies. Yes, there will be some 200, 300 basis point chip off in terms of growth rate on a very temporary basis. And if you have more than a 1 year plus outlook, I think spending on technology services will bounce back maybe a year from now. And again, the market is going to see that much in advance, much ahead.
Point taken, Nilesh. Nilesh, therefore, what should one do at this point? Stay away from export-facing sectors or pick US facing stocks and sectors and stay away from those? And only look at domestic, therefore, how should you play it at this point?
Yeah, so I still think there are 3 or 4 opportunities which at least seem to be the least affected. One, clearly, I think broader theme is going to be, it's going to be about domestic growth, domestic facing businesses. They could be consumer-led companies. I clearly believe some of the consumer internet companies, some of our fintechs, clearly are relatively less affected because of all of this. At least there is no first order impact. There could be second order impact on them, but I clearly believe this current environment is more about thinking about the first order impact. So that's a good place to be. I also believe that the government will up its spend on infrastructure a lot more. I clearly believe conventionally we always thought about fiscal measures, monetary measures to deal with the crisis. I think this time it's around, I wouldn't be surprised if the government thinks about a third measure, which is to basically significantly step up its spending or its investment on infrastructure. So obviously there is a budget at 3.1%. I also believe that there's a bonanza for the government in terms of lower crude oil prices. And my view is that the additional kitty, the accretion to the government's finances that we're going to see because of lower crude oil prices would probably be well spent on significantly upping the ante in terms of infrastructure spending and give an additional leg up to our economy and to our growth. So I clearly believe again that there has been a lot of correction in some of these cap goods and those kind of spaces. I think in this bout of correction that we are witnessing, probably there's an opportunity lurking out there as well.
And not core infra, not roads, etc., Nilesh, or would that also be part of this basket?
I have generally preferred to not be in asset-heavy businesses.
Sure.
So typically companies which operate road projects, which operate airports, which operate maybe power projects, those are not the places to be. I think it's more about spotting businesses which are providing consumables, providing components, providing equipment, or probably just providing high-end services for building infrastructure projects or for basically beefing up India's drive of indigenization on defense. These are probably some of the opportunities to look out for. Again, EMS is an interesting area, though valuations are still challenging. But who knows, over the next few days, few weeks, we again see significant correction there. It might again create an opportunity because this whole round of tariffs, we seem to be relatively well placed versus other countries like maybe Vietnam and China. So I think there are plenty of businesses which are probably relatively less affected. And then the recent round of correction actually is probably just the icing on the cake that one would have wanted for.
Point taken. Nilesh, last question. Wouldn't let you go without a quick take on pharma. I want to understand from you how you view it. There's some amount of uncertainty, of course, with a possible tariff on pharma. But can the US, one, afford that? And if so, would you therefore avoid it? Or do you believe that's one pocket that could be an opportunity?
No, it certainly could be an opportunity. I think right now, I don't think decisions are being made on tariffs based on whether they can afford it or not. I think it's one broad brush kind of a policy initiative which has been unfolded. And till that the rate does not come out in terms of what's going to be the tariff rate, you will continue to see a period of uncertainty. But having said that, I still think there are two things. One is the demand for pharmaceutical products still is very non-discretionary. I don't think alternative substitutes can be created. So I honestly don't think the demand is challenged for Indian pharma, number one. Number two, with this collapse of crude, keep in mind that a lot of the raw material prices are the base is basically crude oil prices. So I think a few months down the line, the margins also for pharma companies should be better. And with this round of correction, obviously some of them become interesting investment bets as well.
Nilesh, looking forward to the podcast soon. It'll be good to have a longer format conversation. But thank you for today. Some very interesting nuggets.
Looking forward as well, Neeraj and Harsh. Good interacting with you guys. Thank you so much.
Cheers. Okay, that's Nilesh Shah, Envision Capital, and some very nice insights, including the fact that there's a difference in how central banks would respond currently. No concerted action this time around versus what we saw in COVID. Before we slip into as we slip into a break, we need to slip into a commercial one. Also hear out from White Oak Capital's Prashant Khemka, who believes that leading consumer companies have barely gained compared to 5 years ago. And he speaks about some sectoral bets.
Structurally, we have not from a top-down view that this sector would do better or the other, but because of the construct of the sectors, we tend to have higher allocation in certain sectors and lesser in others. So first of all, we have two key biases in our portfolio. One is size. So we'll have greater allocation to small and mid because they're inefficient segments of the market. We do not believe ever that small caps would outperform large caps as a benchmark or index. But because they're more inefficient segments of the market, we can extract more alpha. So benchmark return is the same for large and small. If we can extract more alpha, we can generate higher return in small and mid caps. So that remains the case. We have overall higher allocation to small and mid, which we've always had. Second, and so first of all, if I take this small and mid, there are certain sectors which are more small and mid cap heavy.
Right.
Like consumer discretionary, industrials, healthcare, as against, let's say, energy, banking, which are skewed more towards. So that aspect would tend to favor certain sectors. Second, what skew we have is that of governance. Tend to have, I'm not saying we are looking only for AAA governance or anything, but on balance, our portfolio tends to have better governance than weaker governance. Now, there are certain sectors which tend, and there's no such sector where every company is, of course, good governance. So 80-20 rule does apply. Not to name any particular sector, but I think one sector one can comfortably, or worldwide investors tend to agree, is real estate as a sector where, governance leaves a lot to be desired. Again, at the risk of generalizing, and a lot has improved over the last decade or two.
Still,
But I think nobody takes offense. Real estate managements are the last to take offense because they believe other than them, everyone else is a crook.
Can we see illogical prices on the downside in asset classes as well? Because everybody's saying that Indian economy doesn't get impacted, but the uncertainty may still bring market valuations much lower than maybe long-term averages too, right? Can it happen?
Undoubtedly, Neeraj, but markets can remain irrational more than you can remain solvent. While this phrase is used mainly for shorting side, it can be true even on long side. If you are taking leveraged position, you may think today X is the fair value, but with a policy change, X minus something can become fair value, and hence markets will have to make adjustment. Anyway, markets are always trying to forecast future. As of today, we don't know what kind of tariff will be there on pharma products. Who will bear the burden, manufacturer or the distributor, which has disproportionate margin? But yet market is going to take pharma stocks down, assuming that tariffs will be levied as irrationally as it has been levied on other products. So Great Depression is unlikely to occur because today both political class as well as central bank are far more cognizant about learnings of Great Depression. To a great extent, Great Depression can be blamed on very, very tight monetary policy of central banks around the world. I'm sure they have learned from the same, and unlikely that they will allow recession to go into Great Depression.
AB Real Estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment.
Welcome back. You're watching India Market Close here on NDTV Profit. That time of the show, and today becomes critical in that sense. You also have European markets flashing at the bottom of your screen, so maybe something to look for. But what becomes critical is to understand what's happening in dealing rooms on a day like this. And Somit, as always, gives us those nuggets and insights. Somit, what are you hearing and what are you picking up today?
Well, stock-specific buy flows are there. We have seen recovery in multiple stocks from lower levels. In fact, Nifty IT index is one of the clear examples of that. It is one of the highest gaining index from the day's low. It's up around 4.5% from the lowest point. Strong buy flows is what I'm hearing when it comes to IT specific names from both foreign and domestic institutional investors. Then apart from that, it's Zomato. That is one stock that we need to watch out for, and that's and dealers are indicating that the 49% FI limit might have been breached in case of Zomato, and this could trigger a potential selling that would come in because of the from the FTSE and the MSCI indices. Apart from that, it's IndusInd Bank. That stock is seeing some buy flows on DI and large HNI desks. Dealers are expecting some positive announcement to come in for IndusInd Bank. HPCL is one stock that has been in focus among the oil marketing companies. In fact, HPCL is the only oil marketing company that is in green, while the other two are still in red despite the recovery that we have seen. And one of the reasons that dealers are highlighting is that that is the only oil marketing company that has a pure play domestic exposure, while BPCL and IOCL have some foreign exposure in terms of foreign assets, foreign exploring assets as well, but HPCL does not have, and hence high buy flows that we are seeing on mutual fund desk when it comes to HPCL. Then there is Industars that has been in focus. Buy flows at lower levels on institutional desks, largely unaffected by tariffs is what dealers are indicating. Plus, there's a high potential of a possible dividend announcement that could come in from with the Q4 results. And hence, Industries is also seeing buy flows at lower levels. So keep an eye out for all these stocks. Today, we are seeing some downtick all the back because of the Trump tariffs and market sell-off in general. But there are buy flows in specific names that I'm hearing.
Well, some interesting names out there, and you could probably believe that some of these would be usual suspects from a perspective like that. But interesting to see institutional flows being there on a day when VIX is up 62%. Any comments on VIX?
Well, as I was speaking with Chinmay, it is he was saying that it's implied and not what it's been predicting currently. So yeah, implied it's because of the fall that we have seen, but actually there's not volatility. We are seeing a steady recovery in the markets from the day's lowest point, and we saw that at the first half of the trading session as well. 12:30 again we had hit a low, but then again from those levels we are seeing a recovery.
It does seem to be wanting to defend 22,000 for sure. Thanks for that, Somit. Let's get in Hemen Kapadia of DR Choksi FinServ on that perspective as well. Hemen, good having you. Thanks so much for joining in. Are you giving out a brave call today, Hemen?
Very good afternoon, Neeraj. Thank you for having me. I would rather not be here today, but honestly speaking, not so brave to give a call enough because these are unprecedented times, Neeraj. Frankly speaking, you don't see this every day. Hope we don't see this often soon. 35 years in the markets and Saddam Hussein's war, nuclear tests, any number of things, Neeraj, but this is something which came just completely out of the syllabus. The VIX that you were speaking with, Somit, the US VIX on Friday appreciated by 50%, ended at 45.5. Comparatively, we are still at 22.5 and cooling off a bit. So, frankly speaking, I think there are too many things together. 21,800 was a support level. We've taken support now, Neeraj. There's a bearish gap, which is not a good sign. I spoke earlier with you and Harsh also. There were three bullish gaps. Now, I didn't expect the third one to get covered up, but that has also been covered up. So, frankly speaking, doesn't augur well, but time being, maybe like I said, in-street buying, maybe PSU buying. So, probably a small spot of respite is what I see around 21,800, Neeraj.
Would you initiate a short, Hemen, on anything at all today?
No, So
no long, no short.
No, too late to sell, too early to buy.
Oops. Okay. Can I ask you for your stock ideas today, or are you staying away from that?
No, I'm staying away. But if you were to put a gun to my head, I'll go for 4 basic stocks, which I think, had discussed earlier.
Let's try.
4 years of hatching eggs, not doing anything. HDFC Bank, Kotak Bank, Bajaj Twins, and SRF. 4-5 quality stocks which have not done anything in a raging bull market over the last 4 years. So I think I would go for something like that. 1, it's not a short-term call. 2, you need to have patience. 3, you need to put more money after this if it falls down further. Bajaj Finance is 11,000 rupee buy call. But once again, do not go the whole hog at the same time. Keep space to add more in case this madness continues. Neeraj.
Hemen, good afternoon. Good to have you here on a day like this. Just amused with the way you've given your calls today. But what about an IndusInd Bank? Again, I'm putting a gun to your head because outside of the ones that you've given in terms of names, you're not willing to pull a trade. So views on IndusInd Bank, because Somit was suggesting some amount of buy flows, possible positive news to trickle through, and therefore trying to understand this from a technical perspective as well.
Well, I'll repeat what I said, Harsh. I wish I could run away, go on a beach, sipping Mai Tais. Having said that, I thought we were good friends. You wouldn't put such guns to my head. But having said that, on a more serious note, it's been a miserable stock over the last, 7 years? Harsh, Nifty, Bank Nifty, n number of stocks posted new highs. High posted by IndusInd Bank in 18 was 2038. We haven't come close to that in 7 years of a fantastic bull market. So frankly speaking, near-term respite, yes. Support at 650, yes. I wouldn't venture a trade because 7 years of woeful, abysmal underperformance and it's still going nowhere. So I'd say stay away. I mean, some of the banks just are not cut out for this, frankly speaking.
Hemen, the view on something like a Trent, because that's the other one which is reeling under pressure today.
Well, many of these 10-bagger, 20-baggers needed a reality check. Technically, I'm not saying fundamentally though. So yes, I believe that the worst is not yet over. Deeply oversold, there's a bearish gap today, which is not a good sign. There could be support coming in. There would be bounces coming in. For me, the support comes in at 4,200, which is a distinct possibility. Maybe not today, tomorrow, maybe next month. So, and we've had a brilliant move, frankly speaking, Harsh. And this move has been on for what? It made a bottom in 2008. So that's 17 years of an up move, Harsh. I'd say it's going to do nothing for the next quarter. Yes, I'm not saying it's going to go one way down. There is support oversold, but for me, if I were to venture a trade, a contra buy call, I mean, obviously not futures, in cash would be at 4,200.
Okay, well, Siddharth Khemka joins in as well, and of course we'll get in Purit for the stock of the day, but before that, Siddharth Khemka, thanks for joining in. What's the mood in the dealing room? Are you guys telling clients to buy and clients buying, or are people sitting on the sidelines?
Yeah, good afternoon, Neeraj. I think views are clearly mixed. A lot of people, a lot of clients, they are clearly sitting it out and waiting for clarity to emerge. While we definitely have seen a lot of other large clients coming in and deploying more money into the fall that we are seeing today. So clearly it's a mixed view, and what we are suggesting is to clearly focus on fundamentally strong stocks, the domestic themes or the domestic consumption oriented sectors where the global volatility risks are minimal. And third is areas where the valuations are not that expensive. I think these three combination is where we are suggesting our clients to focus on. And finally, the fourth thing is not to put in all in right now. We are suggesting to go in tranches, 3 or 4 more tranches, because a lot of things are likely to go up. And the biggest worry right now is how this escalation in trade war could result into a global economic slowdown, and sectors which are globally linked could see a big impact in earnings growth going forward.
Okay, well, our stock of the day is Tata Motors, trading 6% lower after JLR decides to pause exports. Puneet Johnson with more. Puneet.
Well, thanks for that. So definitely the key trigger is that from UK, they've stopped the export of these JLR vehicles to the USA, and that's going to have a revenue impact. Now, earlier it was expected to have a margin impact, but now with halting of sales, at least from the first quarter, this is expected to have a revenue impact probably in the end of the first quarter, at the start of the second quarter, because they still are maintaining a sizable inventory. They have mentioned that they'll be working with its new trading partners apart from the US, but US is a behemoth. It's roughly around 26% of the volumes for Jaguar Land Rover and 23% of its revenue for FY24. So definitely a big impact is expected because of the tariff tantrum. I just want to talk about the recent MS note today. In a bear case scenario, they actually see the target price of Tata Motors at 416 rupees per share. Out of that, 90 rupees will be for the JLR business. So effectively, you are saying that the whole, even in a bear case, where the stock prices have corrected today, we are seeing a sizable impact and a bear case scenario going forward as well. Morgan Stanley has also mentioned that it could, because of this tariff tantrum, essentially, they could see that for free cash flow could be negative for FY26, and it will make that difficult to value the business. The other key aspect of the company's update in terms of wholesales, it's coming at 4 lakh units per share, 4 lakh units in the FY25. That's almost flattish on a year-on-year basis. But the key highlight here is that they mentioned that they've achieved the net debt zero target for FY25, and that could be the only silver lining in a day that's been difficult for Tata Motors.
Okay, thank you so much for that, Puneet, for that perspective. Siddharth Khemka, very quickly, with regard to Tata Motors, what's the view coming through according to you?
I think clearly the company would be under pressure. 22% of JLR sales comes from US, and there is a clear direction from the company that until clarity emerges, they are going to stop exports into the country, and clearly they are looking at clearing off the inventories that is already there in US over the next few months. So I think a big earnings impact could come over the next few quarters, and which is what the market was fearing, and that impact has taken off. We downgraded the stock to neutral in early January, mostly on back of fears of a slowdown, especially in the key markets. That is also playing out, and I think clearly it's an avoid situation right now until there does emerge some clarity, either in terms of a trade pact between Europe and US, or JLR talking about setting up a unit in US. But that apart, on the domestic front, I think things are looking pretty decent, but that alone cannot help the stock in the current downside. So clearly we are avoiding, or you can say we'll remain underweight on Tata Motors at current levels.
Hemen, view with regard to Tata Motors?
Well, frankly speaking, one of the earliest stocks to sort of peak out, Harsh, and 538 was the support level where it's taken support. So at the risk of sounding a bit optimistic, I believe the downside is now getting minimized, and only if we close below today's low is there a cause for concern. We've come up from 1180 deeply oversold support levels, positive divergences coming. Very difficult to hazard a bottom in such a market, but I wouldn't be bearish at this point in time. It's set up congestion area support. There's a monthly support. I'm not sure if I'd buy, but absolutely not a sell, and I feel this level should hold.
Siddharth, what are you recommending at this point? If at all there are investors waiting on the sidelines wanting to buy, you're guiding for staggered buying at this point. What sector are you focusing in on? Because I believe it's all become sector. It's completely sector related, right? Because you'll want to avoid US import or India export into US kind of companies. So what's the sector which you're really banking on at this point?
Harsh, I think clearly the focus is on domestic-oriented sectors. And if you look at some of the large sectors in India, say, for example, banking and financials is one such sector which is largely domestic-focused. Yes, there are certain, you can say, the interest rate outlook is governed by the global economic. And currently, we are seeing that last few months, RBI has created a lot of liquidity through the OMOs, through the CRR cut, and the start of the rate cut cycle, all of which is positive not only for the banks but largely for a lot of NBFCs where the NIMS improvement is expected over the next few quarters. So banking and finance is something that we believe valuations are comfortable, growth is improving, and the interest rate cut cycle as well as improving liquidity is structurally positive. So within the banks, what we are suggesting, ICICI Bank, SBI, HDFC, Kotak, these are some of our preferred picks. Within NBFCs, we like Bajaj Finance, Shriram Finance. These are some of the NBFCs that we like. From the other space, domestic consumption, that is a key theme that we believe could revive this year. Domestic demand is improving with a lot of commodity prices coming down. The commodity price inflation that will come down, margin should improve. And so the sector has not participated in the last few years. So A, sectoral rotation, B, we could see a lot of fund flows into the consumption theme because some of them are large, good management, and the exposure to their sector has been relatively lower. So all these things make them a good candidate for fund buying into them. So not only these staples, I think the broader consumption theme could also do well. So for example, some of the food and beverages companies like the likes of Varun Beverages, Jubilant Foodworks, then you have the hotels, Indian Hotels, Lemon Tree are our preferred picks. And finally, aviation, where it's a big dependent, crude is a big input price, and crude has fallen to more than 3-year low. So margins improvement plus demand for Q4, we saw very strong demand. That numbers will come. Q1 will have the holiday season where again domestic demand will be pretty strong. So we believe some of these sectors could be in focus in the current global and volatility.
Okay, so point taken. But let's go across. We have Apollo Microsystems Management. We have Mr. Krishna Sai Kumar, who's the whole-time director at Apollo Microsystems, joining us this afternoon. Of course, numbers posted. And sir, was it your best ever top line in terms of quarterly top line? And I want to understand what the FY26 prospects seem to suggest on the basis of this.
Yeah, we are in line with our guidance. Earlier we have given 40 to 45% guidance as the growth is concerned. So we are very much in line with our guidance for the concluded financial year FY25. And the same trend will continue with the 40 to 45% growth for the next financial year FY26 onwards. And this quarter is the best quarter ever. That's how I have to say. Anyway, the audit is yet to be completed. We'll have to see how the bottom line, finally envelops into.
And how's the order book building up, sir? We've seen very strong order flows in Q4 FY25. Is that correct? And therefore, what's the outlook for FY26 on this higher base? What's the growth looking like in your view?
So order book in next 1 year will grow at least by 3.5 to 4 times. That's what we are estimating. So it could be close to around, by the time we conclude March 26, our order book should be anywhere the minimum of around 2,000 crores.
Okay. And what's the execution looking like? You also have a unit 2 which is going to commence operations Q1 FY26. Are we on course for that? And therefore, what's the outlook like going forward?
Yeah, the unit is already ready in last quarter itself. So the teams will be moving in next couple of weeks. The unit 3 is getting ready, and unit 3, 50% of the phase 1 of the unit 3 will occupy by September. And balance 50% of the phase 1 will occupy before December 2025. So this overall net cumulative, expansion of the entire facility would support us for the upcoming, large projects, for the production actually.
So you're going to end the year at roughly 500 to 550 odd crore in terms of top line, if I've got this math right, and ballpark. Where do you go FY 26, 27, 28? What's the growth clip like? You'll have a 2,000 crore order book. How quickly do you execute?
Yeah, as of December, we concluded 400 crores, and this quarter is around 161. We have already posted today to the stock exchange. So it concluded at around 561. As a disclaimer, the audit is yet to be complete, but this is how the figure would be. And with the kind of the current orders and the upcoming orders coming forward, I think 40 to 45% minimum growth will continue to demonstrate for the next, the current financial year, FY 26 as well.
Are predominantly all your clients India centric, Mr. Kumar?
Yes, mostly all my programs are indigenous programs, and we have started our overseas business development. We may get some decent contracts this financial year, but I'm not sure if we would be executing in this financial year. But yeah, for sure, most of the programs are indigenous, and the revenue comes from the indigenous programs only.
So very little to no impact of the entire buzz around tariffs for you?
Absolutely no. I think there is, as far as we are concerned, the tariffs absolutely have no impact. And the trade war, I don't know how far this trade war is going to continue. But, I think, the piling up of the inventory for the actual war is actually being done across the world. I think that's a good news for all the defense companies around.
Right. And your margins have largely been around 20 to 26%. Would you say that there is more scope for upside rather than downside, given the kind of growth clip you're growing at with regard to top line?
Major expansion for this financial year in terms of the margin may not be, if I have to, give a guidance. But from the next financial year onwards, FY 27 onwards, I think there should be a good margin expansion. But broadly, the margins will continue to be stable and a little on upscale, definitely. Even after the long-term debt that we have taken for increasing our infrastructure. But yeah, I think from FY 27 you will see a decently good margin expansions as well.
So apologies for trying to push you on this. So around 20 to 23%, is that the kind of range we can expect in FY 26? Is that the thought? And thereafter, how much of an expansion does that leave you with in terms of bandwidth?
I think for me to give a good number to it, it will take another couple of quarters with the order and the product mix that is going to come. I think that's the best time I should give a better guidance rather than at this stage.
But FY 26 around 23%, is that reasonable?
Yes.
Okay. Point taken. Okay. Thank you so much, sir, for joining us, and of course, wishing you all the very best for a very strong Q4 in terms of numbers and FY 26 as well. So great having you. Thank you.
Thanks so much.
Okay, time to slip into a very short break. Plenty happening, frankly. The last half hour of trade on a day like this looks very interesting. And of course, we'll discuss more stock-centric ideas on the other side of this very short break, along with BTST calls as well. So stay tuned.
Basically, see, all said and done, as I keep saying, that one should not go by what we recommend on the stock specific basis, because markets are going to remain choppy and volatile, and every day is a new learning, every day there is a new event. Luckily, market gave very good opportunity on, I would say, Thursday, when markets were steady and not falling much, and Friday opening was also only 60 points down for the Nifty, where we raised a lot of cash. Luckily we raised around 13.5 to 15% cash in the portfolios, and that will put to work slowly and gradually after today's fall.
So, okay. So are you saying that you will start deploying?
Yeah, a little bit, gradually.
At about
and that's what I always do, because in a falling market like this, and where this will end, actually nobody will know, right? But I would agree with Mr. Ramesh Damani's statement that over next 2 weeks or 3 weeks maximum, something will happen, and Trump will claim victory, and things will start to reverse. So.
Right, back with India market close right here on NDTV Profit, in conversation with Siddharth Khemka and Hemen Kapadia. And Hemen, I know you mentioned that it's kind of hands off for now, but there has been a perceptible recovery in some of the IT names today. Nifty IT is now down, I never thought I'll say it, but only 3%. So the question is, are any of the IT stocks looking like creating a bottom, even if you wouldn't buy them?
I think the bigger ones, at least starting with TCS, were the weakest of the lot, Neeraj. So I think, yes, I think TCS is something which one can look to buy. The reasons are we haven't gone below 3,000 or sustained below 3,000 in the last 4.5 years. We are oversold. We are at close support. So yes, I would say for a trading bounce, I'm not saying an investment point of view, because I feel IT as a sector is going to be a washout for the calendar year of 2025. But yeah, I would say for a trading point of view, one can use today's low. One gets the feeling that TCS looks better than many of the other stocks, Neeraj.
Okay. Well, Siddharth, before we thank you, is IT coming in the realms of people saying that they want to buy at all today? Any of IT, mid-cap, large-cap IT, ER&D, anything else?
Sorry, Neeraj. So I think mostly, as we said, IT is one of the top sectors where clients and even advisors, we are avoiding any recommendation. So what we see is that even a 50% probability of a US recession suggests that over the next 3 to 6 months could bring further earnings cut. There could be guidance which could be withdrawn. There could be a freeze in tech spending, and something like a COVID, which was a recent reference point, we see that there could be negative earnings growth, and if those kind of spending freeze happens, larger ones, for example, Tech Mahindra could report a revenue decline of 3%, Wipro about 2.5%, TCS could report a revenue decline of about 1% in constant currency terms. So before things get better, I think next 1 or 2 quarters is where the things could get ugly, and I think downward revision could happen. So clearly we are avoiding any fresh positions in the tech space.
Okay, point taken. Thank you so much, Siddharth. We'll let you go on that note. Thanks so much for joining us this afternoon, giving us that perspective. The one big loser in trade today is Trent. It's lost over 15%, at least just about holding that 15%, in fact, after analysts shared bearish commentary on the stock after its numbers. Mahima here for a bull versus bear case on the stock. Mahima, take it away.
Right. So, as you rightly mentioned, Trent stock has cratered in trade today. And before I move on to the bull versus bear case, let's take a look as to how the stock performance has been so far. This is the biggest fall since COVID, that is 23rd of March. And since then, we've not seen such a big fall in Trent. In terms of how the stock has fallen since its 52-week high, it's fallen over 43% now. It's around 22% away from its 52-week low. And overall also, if you see, the stock has fallen 36% in the past 6 months itself. In terms of what's working and what's not working, Q4 performance, revenue, standalone revenue, as per the business update, saw a growth of 28%. But the street was estimating a growth of approximately 35%. 25%, which is one of the reasons as to why the stock is under significant pressure. And this Q4 overall is also weaker than expected. Plus, the overall margin pressure shall also continue, because in the last con call also management had said that they are taking up store upgradation, and this could lead to margin pressure as well as some pressure on the EBITDA as well. But companies looking for upgradation of smaller stores to larger formats, that is one of the positive points. But it's also interesting to watch out for, because now people are shifting towards online sales, and it'll be an interesting play to watch out for as to how people will stick to the brick and mortar model as well. In terms of competition, well, right now the growth is ahead of its peers, somewhat in tier 1 and tier 2 cities, but overall the competition that is coming in from small players, something like a V2 retail or V-Mart or like a bazaar style, the competition from there is coming in high, and that could probably impact sales of Zudio as well. Plus, Shein coming in India might also put some pressure in terms of competition for Zudio sales as well. In terms of the store addition this quarter for Zudio, the store addition has been quite significant. They've added around 132 new Zudio stores. But overall, they are opening a lot of stores in similar location, and that could or may lead to stores cannibalizing each other as well for a shorter period of time. Moving on to the brokerages, Morgan Stanley today has maintained overweight with a target price of 7184, even after considering the kind of business update that came in. But Kotak has maintained sell and cut the target price to 5150. They had downgraded the stock earlier, had given a target price of 5850, but today they've again cut the target price to 5150 for something like a Trent. In terms of Elara, they had said that Trent leads the peers, and according to them, outperformance will continue for something like a Trent. But Kotak still believes that the growth story is priced in now, and it's time to book profits, and we've seen that kind of profit booking already in the stock. Lastly, in terms of what the street is expecting in terms of the revenue as well as PAT CAGRs, Elara is expecting a revenue CAGR of 27% and PAT CAGR of 38% by FY28. This is the FY28 estimates, and Kotak has trimmed the FY25 to 27 estimates by around 1 to 2%. So, in terms of earnings estimates also, there are starking different views between these brokerages. Lastly, in terms of where the valuation picture stands, well, Trent was never a cheap stock. It has always been expensive. Right now also the 12 months trailing PE stands at 86 times, which will move to 105 times as per Bloomberg. So the PE increases next year, and then it will go down to around 74 times in 2026 as per the estimates, which is still not cheap for something like a Trent. And lastly, in terms of what brokerages are viewing as per Bloomberg estimates, there are right now 17 buys, 3 holds and 4 sell for the counter. So this is the overall view as to what has happened, and of course the bull versus bear case for Trent.
Thank you so very, very much, Mahima, for that very comprehensive view with regard to a Trent. You know, what's really not going away at this point, Neeraj, is FMCG. Probably, I wouldn't say that there won't be a hit, but likely the least hit out of the major sectors in terms of the tariffs, and therefore interesting to take a quick view from Sandeep Agarwal joining us for this discussion and more. Fund manager and co-founder Sovilo Investment Manager. It's also your time of the season, Sandeep, with regard to IT, and we will quiz you on that as well. But first off, on a Trent and on the FMCG basket as a whole. First, your quick view with regard to a Trent, how you view it, how you view the numbers, because this 15% stock decline, could it be a presentable opportunity for prospective investors?
Hi, good afternoon, and thanks for having me on the show. We run a PMS, so it is very difficult to comment on stock, and I won't comment, but let me give you some perspective that, you know, FMCG obviously has been perceived as defensive for a long time, and rightfully so, because we have good GDP growth and growing population and, you know, growing per capita income and all that, which augurs well for FMCG. But at the same time, you know, the valuations have always been very demanding, and that's the reason they go a long phase of time correction and sometimes price correction. And right now we are witnessing it in some of the pockets, while because of Trump tariff, they are looking better now. But I believe that when sanity returns, and again, probably people will find other spaces where there is growth and will try to get out of them. So we want to buy FMCG and QSR space, but at right price, not at insane valuation. And I think some of the stocks are very insanely priced in retail, in apparels, in QSR, and even in FMCG. And those are the stocks which are currently not doing well, or where the one-day shock in price falls are alarming.
And what about the larger FMCG basket, Sandeep, if I may venture? QSR has been one space where there's been plenty of pain. Footwear is the other space where there's been plenty of pain. Do these pockets likely start to become more of something that would interest you at some point?
See, right now what is happening is that, the challenge is that most of the companies have some exposure to export, and those are getting hammered very badly. And compared to that, all these spaces are more defensive and looked at more like, domestic stories. So they are relatively better off. And that's the reason these arguments are coming off that, they have corrected quite a bit. There has been time correction, and whether we would like to look at them. Our view is that, what has happened relatively is that the stocks which we are in, which we like, the growth stories and all, they have become much more cheaper than earlier. So, again, for us, relatively, those same names make more sense because we have done a lot of work on them. We have been tracking them. So we will be preferably, there only. These spaces will become very interesting when, the multiples come down meaningfully. Right now, while there is some correction and more time correction, but still the stocks are very, very expensive. So very hard to, still make a bull case scenario or an investment case for them. But yes, for people who are taking 10-year, 20-year call, and where, there is a patient money and low cost of equity, there, this may make the cut, but probably for us, it is a little difficult.
Also that time where we have an exclusive coming your way. Sources tell your channel that the government believes that India is better positioned amid the reciprocal tariff policy versus peers. Shrimi joins us with that perspective. Shrimi, what are you hearing?
Yeah, so top bureaucrat tells NDTV Profit that, India is quite better positioned in terms of global trade landscape, as the country is...
Shrimi, we'll have to patch you. Shrimi, we'll have to patch you again. The line is completely not clear out there, so we'll try and get that going in just a bit. What are individual stocks, though, factoring in is the key question. Now, are stocks... are there companies or stocks which are recovering a little bit? So, well, a small cap stock, Umang Dairy, might be recovering a little bit, but not too much otherwise. Still, a clutch of names under a lot of pressure in the session today. Themis Medicare, Gravita. There's just a lot of pain out there at the mid cap and the small cap end of the market. Himen, did we talk to you about FMCG? And I wonder if, while you only want to recommend a long if there is a gun put to your head, I'm enticing you with a coffee and asking you that would you buy an FMCG name for a trade, because they are bucking the trend today.
I think so, Neeraj, because FMCG has, FMCG peaked with the market on the weekend of 27th September. Having said that, HUL is the big gun. It normally leads the FMCG pack up or down. I wouldn't venture out to say this is a double bottom, but it's tested the previous bottom, and that previous bottom has held. So in a market like this, yes, I'd stick my neck out and say if you want to play for a small bounce, I think HUL seems like it. I'm not sure if the risk reward ratio is in favor if I tell you to buy with a stop loss of today's low. About 2300, I think it should surprise, and it's also making a medium-term base. So yeah, FMCG, especially HUL, seems like it's sort of stabilizing after a multi-month fall, Neeraj.
Okay, fair call. Now on to that story with Shrimi. I believe we got Shrimi on a better line with regards to what the government believes about India's position. Shrimi, can you hear me?
Yeah, I can. I'm
Great.
sorry for the disturbance.
No, you can't help it. Please tell us. Yeah.
Yeah, so, the top policy makers tells NDTV Profit that, the India is currently focusing on enhancing its economic resilience despite this ongoing reciprocal tariff policies. And they are also saying, and in fact underlining, that this policy per se is implemented globally and are not kind of aimed at any specific country, and it's a part of a broader trade dynamic. However, the official admitting that there is a downside risk to the growth outlook amid this uncertainties, but the outlook for FY26 remains largely unchanged, which is in the range of 6.3 to 6.8% is what Economic Survey, highlighted. And as far as steep reciprocal tariff of 27% goes, India continues to engage in talks with the US. The government is actively working to finalize the BTA. And in fact, it's saying that it's, reviewing its existing tariff structure under this ongoing trade pact discussion. However, the policy makers are emphasizing that unlike some other nations, they have resorted to, go retaliatory measures. India is opting for more calculated approach, more balanced approach, and kind of aiming for stability and a long-term growth and trying to strengthen its economic ties with the US. So they're also pointing out that some of the developments are favorable for Indian economy, particularly the reduced energy costs, which are expected to benefit the country, manufacturing sector, and overall economic competitiveness. And they're also pointing it out that all those reforms which was announced in the February budget, as you remember, as far as personal income tax policies are concerned, they are going to have a positive impact on the economy, as the target which is being set for growth is mainly reliant on the domestic demand. So that's what the officials are telling us at this point, that there is a downside risk. That more or less they are as far as economic growth is concerned, they are quite stable and steady. And they are trying to sort of finalize this trade deal to navigate this entire tariff issue.
Okay, thanks a lot for that. And from one policy, Shrimi, thanks a lot for putting that into perspective. The government, as you see, has hiked the excise duty by 2 rupees each on petrol and diesel. Somit Johnson with more. Somit, why would this be the case? Are we also looking at a price cut at the till level coming in to offset this, if you will?
Well, yes, most likely this excise duty hike that the government has done, OMCs will take the brunt of that, and technically this 2 rupees hike will eat up to the marketing margins of the oil marketing companies, that is Indian Oil Corporation, BPCL and HPCL. Now, if you look at the integrated gross marketing margin that the oil marketing companies have been earning by selling every liter of petrol and diesel, it has been around 11 to 13 rupees per liter, which is at a multi-quarter high, and this has increased because of the sharp drop that we have seen in the crude oil prices. Now, this 2 rupees cut is what pretty much the street was expecting to happen, because last time also, back in March 2024, government had reduced the fuel prices by around 2 rupees. So something like this was expected by the street when it comes to the oil marketing companies. And this time government has in fact increased the excise duty and not cut the fuel prices. So this 2 rupees hit that we are seeing will put down the gross marketing margins of the oil marketing companies. And if you look at the impact that could come in on the estimated EBITDA of these companies, it could be more than 10% for all the oil marketing companies, that is Indian Oil Corporation, BPCL and HPCL. Now, interesting part here to note is that will this increase in excise duty will also impact an inventory loss for the oil marketing companies. That is, we still need to watch out for whether that will happen or not. But at the face of it, it seems like this 2 rupees increase in excise duty will not be passed on to consumers. Oil marketing companies will take the hit of this increase of excise duty, and their EBITDA estimates could come down by at least 10% But do remember that oil marketing companies were already earning a very high gross marketing margin, and street was expecting this to happen anytime soon. So not much of a big negative impact, given the fact that street had already factored in. Had the hike been much more than that, then it would have been much more negative for the oil marketing companies here.
You can see those moves. Thank you so much, Somit, for that perspective. You can see those moves on some of those counters. Sandeep, let me first take your view with regard to OMCs and the excise duty hike. What's the sense like at this point with regard to that play?
No, so obviously, this is something which was not anticipated, and in my view, I think HPCL and BPCL were stocks which were least hurt today when markets opened until some time back before this announcement came in, and now with this announcement, obviously, the stock price has reacted. I believe in a way, when the way crude prices are falling, this company should be big beneficiaries of it. But probably, that information will come in, that processing of data will happen, and probably then that reaction will be separate. Right now, what we are seeing is a reaction to the excise hike.
Okay. Yeah, I mean, this is the thing that crude prices being lower, if anything, people are expecting a cut at the till. What we have right now is that may not be happening, but the government earning a little bit of that share and eating into the marketing margin of the OMCs. Now, it's a 3.5% gash for HPCL by virtue of that 2 rupee hike in these prices. I wonder if the trading picture for these stocks gets damaged. I mean, not that you were looking to trade into any of the companies, but I thought the oil marketing company charts were looking much more resilient because of the crude price fall. Does this damage this, or is it just a small blip for them?
Oh, well, Neeraj, frankly speaking, what you said, I totally agree with you. They were looking much more resilient than the rest of the market. So as of now, it seems like a blip, but this blip turns into a deluge if we don't stop at around these levels. So things were stabilizing, things were looking good, they were correcting, support, everything. Like you said, resilient, and I feel, in fact, HP, BP, IOC, all of them looked as if they were still in a correction within a bull market. So as of now, it is a small blip. Now, if HPCL closes, okay, it's far off, but if it closes below 320 on the weekly chart, I think then it creates a problem.
Okay, so those are some views coming on OMCs. Also wonder what what you make of metal counters, Sandeep, because that's one pocket where there's been significant pain both on Friday as well as today. The Nifty metal is down nearly 6% today, was down 6% on Friday as well. What's the sense like? Is it a bit of an overreaction, or would you stay away at this point? How would you play metals?
So, metals and other commodities, everything is under pressure, and they are direct derivative of how you perceive global growth, and the way, the fear of recession in the largest economy in the world is going up, the probability of that, and also the impact of that, the impact of tariff on most of the economies in the world. Obviously, all the commodities will go through pain, and there is a fear that the demand for commodities can tank, and because of that, the prices can go down. And this sector is a huge capex sector where the operating leverages are very high. So obviously, there is a fear which is there, and that fear is playing on the mind of the people. I think uncertainty is not the time when people will buy metal, because metal type of sectors are being bought when there is a lot of certainty, when there is a risk on. Right now, no one is in a mood to have risk on. Everyone wants to take risky money off. So I think this will be preferred less. Probably right now, people will be more comfortable buying something like IT, Pharma, or FMCG rather than buying metal.
Okay. Let's also talk a little bit about consumption, because some of those names in focus on the back of their numbers which came out, and trying to compare and contextualize this. A Godrej Consumer, for example, doing well in trade today, and how do they stack up in terms of their quarterly update numbers, Mahima, with that perspective?
Right. So I'll start with Godrej Consumer. Well, we've seen that it's completely weathered the storm that the markets have had today. And this is because the Q4 update overall in terms of revenue uptake was better than what was expected and what street analysts estimated. In terms of volume growth, they're expecting a mid-single digit volume growth and overall a high single digit revenue growth. Adani Wilmar is another company which has posted strong Q4 business update. They're expecting volume growth of around 7% and revenue growth has been around 36% YOY. Dabur, on the other hand, has posted a weak Q4 business update where they're expecting volume growths in low single digits and revenue growth will be flat as per the management commentary coming in. Lastly, Marico. Well, mid-single digits volume growth is something that is expected by Marico, and overall revenue growth will be in high double digits. Now, in terms of the retailers as well, revenue volume growth around 7% and revenue growth around 17%. Nykaa is expecting revenue growth to be around mid-20s, and Trent, we already saw that the revenue growth, standalone revenue growth stood at around 28%. But when Trent is being compared to retailers in the tier 2 and tier 3 cities, something like a V2 retail or bazaar style, V2 retail has seen a revenue growth of 69% this quarter YOY, and the same store sales growth stood at 24%. This is much better than, of course, V2 retail is very small as compared to Trent, but the growth that it has penciled in is much higher. Bazaar style saw a revenue growth of 55% and the same store sales growth stood at 20%, and lastly V-Mart retail revenue growth stood at 17% and the same store sales growth stood at around 8%. So this is the overall roundup as to how Q4 updates and how Q4 has panned out in the consumption space, both for staples as well as retailers.
Okay, thank you so much, Mahima, for that. Sandeep, views with regard to specific stocks difficult to get, but what about your take with regard to some of the FMCG updates? What is your expectation now from the FMCG space?
So I think, FMCG will keep posting nominal numbers the way they have been growing. I don't see a big positive surprise in them because the tax benefits which have been announced, they will take some more time to percolate down. So the numbers will be broadly where they were earlier. But because, they are more defensive in nature and the certainty of them not getting impacted will be there. And that's the reason there will be more resilience in the FMCG index. So it is a good hiding place currently.
Okay, point taken. And Sandeep, your quick take with regard to IT as well. What are you expecting in terms of numbers this quarter?
So, I think, and this is what our view has been for last 7-8 months. We expected some correction because we believe that, the stocks were overhyped, the PEG ratios are very high. Now, I think there has been a good correction in last 2 weeks, and now the stocks are building in little bit of realistic growth. And I believe that, another few percentage of correction when the companies come and they update how they are seeing the demand environment, if that happens, then the FCF yields will start looking like more than 4% to between 4 to 6% for all the large names. And that is the place where I have seen historically in last 20-25 years, most of the stocks make a bottom. So I think, the only thing which needs to be seen post that is that there is no increase in cost of doing business. The American administration should not come and, impose some restrictions which will increase the cost of doing business. If that doesn't happen, then I think with some percentage point correction from here, low growth will be built in and the multiples will be more reasonable.
Okay, Himen, Sandeep, thank you so much for joining us this afternoon, giving us all of those views. We're just about closing for the day. It's a bit of a relief in that sense because we're closing very, very close to the day's highs. 22,220 is where we're settling in at, or 240, very close to the day's highs in that sense. And 3% down nonetheless. A tough day for the index, 670 odd points, but not as bad as we had started off actually. The banking index also down roughly 3% odd and therefore largely in line with how the Nifty 50 index has done. Small and mid caps is where a bulk of the pain is, but again they're off their lows. 3% lower on the Nifty small cap 150, around 3.5% lower on the Nifty small cap. Sorry, the mid cap 150, 3% odd lower. The Nifty small cap down around 3.5 odd %. In terms of where the Nifty 50 stocks are concerned, HUL is one of them. NTPC may be closing flattish, so is Zomato and Apollo Hospitals. Outside of that, there's quite a bit of pain across the board. Trent was the top loser, 14.5 odd % lower. JSW Steel, Tata Steel following suit, 7.5% odd. And then you had Hindalco, L&T, and then something like a Shriram Finance and Tata Motors bearing a bulk of the brunt among the Nifty 50 counters. In terms of sectors, and this is very interesting, the Nifty Auto down 3.5 at close, but Nifty IT, surely the sector of the day. If we can pull up the intraday chart on the Nifty IT, you'll see a sharp recovery from the lows. 30,919 is what we touched on the low. 32,784 is where we closed, nearly 2,000 points, but absolutely 1,800 odd points higher from that absolute low that we saw in trade today. The Nifty Pharma down 2.25%. So pressure there continues with uncertainty on tariffs. PSU banks were down 2.5%. Realty was down over 5%. Oil and gas down 2.5%. So that's how it actually played out. The metal index was the key biggest loser, 6.5% lower, along with Nifty financials also down nearly 3.5%. So the Fin Nifty also not insulated in that sense. Broadly pressure across the board. If we can pull up the advanced decline as well, when you're looking at those numbers, it looks difficult to see. Within the Nifty small cap 250 index, of course, there is a bit of a recovery that's visible, but just about 15 advances to 234 declines within the small cap 250 index, 150 odd advances to around 2,100 declines. From that double-digit number, definitely moving towards triple digits, the advances, but still the pressure was quite solid. In terms of stocks, Delivery was up 4% on the back of acquisition. Manyavara, Vedant Fashion up 2.5% odd. Westlife also up roughly 2.5% odd. Then you had a Zensar Tech up 1.7 and Aegis Logistics up 1.7. So those were just some of the names in the larger carnage which kind of somewhere were able to do okay in trade on a day like this. In terms of what to watch for tomorrow, and there are plenty of cues, of course there will be plenty of commentary as well coming through with regard to how tariffs is playing out. But we'll have our eye on the global aspects of it, but also you have certain other perspectives and views coming in from the US Fed as well. You have US consumer credit change. You have but that's pretty much it with regard to the cues that are coming through. Okay, with that, I believe out of time on this very, very happening day, Neeraj, in markets today. Not often that we see this kind of pain.
Yep, good. We don't want to see it more often either. But thanks so much, viewers, for tuning in today and giving us your thoughts. Can we see illogical prices on the downside in asset classes as well? Because everybody's saying that Indian economy doesn't get impacted, but the uncertainty may still bring market valuations much lower than maybe long-term averages too, right? Can it happen?
Undoubtedly, Neeraj, but markets can remain irrational more than you can remain solvent. While this phrase is used mainly for shorting side, it can be true even on long side. If you are taking leveraged position, you may think today X is the fair value, but with a policy change, X minus something can become fair value, and hence markets will have to make adjustment. Anyway, markets are always
Hello and welcome to our special programming on US tariff wars. What does this mean? Because stock markets across the world are falling on the back of Trump's tariffs and increased fears that the world's largest economy, the US, could go into recession. In fact, some experts say invest in the markets now since the valuations are cheap. Others say sit tight on the sidelines and wait for this to play out. Yet others say that you should move your money out of equities. Now, in this confusing situation, it is natural for investors in India to be worried about what they need to do to safeguard their money. Uncertainty is perhaps the most difficult scenario to tackle, and because no one really knows what's going to happen, there are estimates and guesstimates galore. At NDTV Profit, we're asking the questions that many of you have and provide you with sound, recent advice from the best of the experts. For many of you, this is probably the first market fall you're witnessing. Panic will not help you in any way, so we urge you to keep calm and weather the storm and keep watching NDTV Profit to get the best advice on how to be resilient in these trying times. In fact, we will get you market voices who tell you what to buy, what to hold tight, and what you should be doing. First up, we have the focus that's coming in terms of domestic consumption theme for the next 2 quarters. And this is what market expert Nischal Maheshwari said on the current market situation. He added that there's no point in selling in the kind of market that we are in. Let's listen into a bite of that conversation.
Yes, it's been a turbulent morning, basically. Yes. At the moment, I think the best thing to do is just stay away from the market. There is no point on catching a falling knife because you really don't know how the other countries are going to react. China has already done it. Other most countries, smaller ones, basically have all come to the table to negotiate. So let's see how all this pans out. I think it's best to avoid for next 1.5 weeks. See how all these things pan out. Maybe the Nifty will go to whatever levels. Nobody can predict that. So best to avoid. There is no hurry to buy in this market.
To buy, but then would you avoid selling as well, Nischal? Because the point is that, and here I'm talking about something like a trend. Okay, so there was a business update that perhaps was not as rosy as some would have liked, but 28% growth in the revenue for the fourth quarter. It was expected of over 35%. It's a stock that is down 17%. It's a Nifty 50 stock. Do you avoid selling as well is a question.
So it depends upon basically whether it's been selling because there has been some margin calls. If there is no margin call, I don't think so at this point, basically not only trend, but anything. There is no point in selling in this kind of a market. The markets are very low. I think some sane sense is going to come back to this market and maybe you will get better rates basically to sell. So I totally agree with you basically that there is no point on actually going out and panicking and selling at these levels. Yes, you may still see lower levels than this. That's what I'm saying. I'm not sure basically how low it can go, but there is no need to panic at the moment because I'm saying, yes, conditions are bad. And but what my thought remains to be that cooler heads will come to the table and things are going to work out, not at pre-tariff levels, but definitely somewhere in between the pre-tariff and the level of tariffs which the Trump administration has put. So across the world, I see maybe there is going to be some giveaway, mostly a 10%, which was the base level of tariff, and some percentage above that. But then it is much better than what we are today. So that's why I'm saying basically just cool off and see for the next 2 weeks how this market comes, and then only whether you want to buy or sell, then only take a call.
Okay, and Mr. Maheshwari, if you wait for 2 weeks and we see a significant dip in the next 2 weeks as well, any counters that you would want to enter into and see that these counters are now looking attractive where valuations are concerned? And will those bets be domestic play bets?
Surely, I think last week itself, basically, I think it has become clear that you have to focus on the domestic companies for the at least next 2 quarters. And beyond the next 2 quarters also, I believe the Indian economy is going to revive. I think the government is taking enough measures, whether it is the rate cuts. I expect another rate cut to happen in another couple of days. Then there has been an income tax cut. So I think all those things, measures which the government is doing basically will show up in the second half of the current financial year. So that's why you are saying basically that at least for the next 2 quarters, wait out, and thereafter basically we are going to see earnings coming back, maybe some amount of earning upgrades also happen in the second half. So better economic sense will prevail.
Nischal, if we're talking about, and your point is well made, right? Because if you're talking about announcements that the Chinese government is already making to focus on domestic growth, you'll have European leaders that are talking about, hey, don't invest in the US, questioning whether or not it makes sense and saying double down on investments in Europe. So if all of these geographies, and I take your point to say that perhaps a common ground will be found on trade, but once bitten, twice shy. If you're dealing with the US administration, you'll have a lot of administrations around the world that will double down on domestic growth. And so from that perspective, for the Indian investor, what areas do you see? For example, financials have been relatively resilient. And in order for domestic to grow, you need financials. Similarly, you would talk about cap codes, you would talk about power. What are the places that you would look at and say there is value here?
So I think financials definitely as a sector basically has got good value, and it's not performed for the last 3-4 years. So I think the outlook seems to be good for the financials. If we have another rate cut happening, which is most likely to happen, I think it is going to be favorable for the whole financial sector. So financials is one. I would for the moment still wait out to see whether the consumption is coming back or not. Because there I think with these kind of numbers, there are question marks. FMCG, it's a very mixed bag. There are a couple of companies saying yes, others are saying no. So really, I think one should wait out for the consumption sector. Government spending is another definite thing happening. Government spent around 12 lakh crores last year. I think similar number is happening this year also. So I think there you should be looking at industries like cement. Steel is a global commodity, so avoid it for the moment because you don't know if there is a tariff war between China and US, so China has to find newer markets to dump their steel. So India could be one of them. So avoid steel or metals for the moment, but cement is one basically definitely you should look at. The other ones basically capital goods to an extent, but capital good one has to be very clear saying that it's not the companies which are exporting because India has a large capital good export to the US also. So one should be very careful where we are investing.
In fact, Kotak AMC's Nilesh Shah also echoed Nischal Maheshwari's opinion and said that domestic-focused companies will stand out in this storm. Let's listen into that conversation.
Today, we don't know what President Trump will do. His actions have been fairly unpredictable. We would have never guessed on political side he'll say Canada should become 51st state of US or Greenland should be given to us. On the commerce side, we would have never assumed that he'll be levying tariff as trade deficit with America divided by exports to America. But this is the world in which we are living in. Do remember that the objective of President Trump is appropriate. Even mighty US, the world's biggest, most strongest nation, cannot afford fiscal deficit at 6 to 7% year after year. It cannot afford current account deficit at 3.5% of GDP year after year, despite having reserve currency. The debt to GDP ratio at 125% with unfunded pension liability, clearly they needed to tackle. The objectives are right. The process has been fairly difficult to understand, and which is why this uncertainty is likely to persist. The process which they are following, it will create lose-lose situation for US as well as the globe, and hence there is little hope that it might get reversed before it is too late. In the order itself, there is a clause 4 which says that America is open to negotiation. Vietnam, which allowed China to use their base for manufacturing or actually assembling and exporting to US, has already announced that will make zero tariff. So there will be negotiation, and that's the hope. But clearly that uncertainty is likely to persist as President Trump remains fairly unpredictable.
Nilesh bhai, so can it happen that because of this uncertainty prevailing, and who knows, it could last for a better part of 2025, can we see illogical prices on the downside in asset classes as well? Because everybody's saying that Indian economy doesn't get impacted, but the uncertainty may still bring market valuations much lower than maybe long-term averages too, right?
Undoubtedly,
Can it happen?
Neeraj, but markets can remain irrational more than you can remain solvent. While this phrase is used mainly for shorting side, it can be true even on long side. If you are taking leveraged position, you may think today X is the fair value, but with a policy change, X minus something can become fair value, and hence markets will have to make adjustment. Anyway, markets are always trying to forecast future. As of today, we don't know what kind of tariff will be there on pharma products. Who will bear the burden, manufacturer or the distributor, which has disproportionate margin? But yet market is going to take pharma stocks down, assuming that tariffs will be levied as irrationally as it has been levied on other products.
Got it. Nilesh bhai, just pure domestic plays. So I mean, you maybe put in cement out there, and I wonder if steel, for example, while it's a global play, but because of the duties having been added, that does it kind of qualify as a quasi-domestic play now versus it being a global play? I'm just trying to think, what do you think of pure domestic assets like cement, steel, and some of those commodities? Not steel, but
cement
for sure.
Undoubtedly is pure domestic sector. You can't export much of a cement, you can't import much of a cement because of bulk nature. On the steel side, undoubtedly, there is little bit of exports, little bit of imports as well, and largely it's a domestic driven sector. But the most important thing for us is that steel or any other commodity is a sector where tail wakes the dog. There will be excess capacity in China. Their free access to US is getting curtailed. Their free access via using countries like Vietnam to export is also getting curtailed. And that extra capacity could be used to dump in rest of the world. We are one of the largest market and also nearest to China. We'll have to be very, very proactive in levying tariffs on Chinese imports. Otherwise, it can hit a sector like steel. So in steel sector, apart from domestic growth, domestic demand, we'll have to also see how proactive our government is in levying tariff on Chinese imports.
Meanwhile, Robert Sokin, senior global economist at Citi Research, talks about the approach of countries amidst global tariff outbreak. He also emphasizes on how is the US economy going to pan out from here on. Let's quickly listen in.
Right now, we're assessing many channels through which the tariffs will impact the US economy and the global economy and economies that are directly hit with these tariffs. And there's kind of the math of the direct effect of what these tariffs will do. But then there's all sorts of channels through which those effects could be worsened and magnified. In particular, if consumers and businesses really get concerned about this environment and they start to pull back spending even more, investment even more than they would otherwise with these tariffs, you can get kind of magnified negative effects. And I think with the way this first couple months have moved, with a lot of uncertainty and a lot of surprises from the Trump administration, I do think uncertainty is here to stay. Even if you end up with some negotiations on these tariffs, you could get more tariffs coming on and off. It's a very hard environment to plan. And so I think at least for the foreseeable future, uncertainty is going to be high. And that really runs the risk of weighing on economic activity and also weighing on financial markets.
In fact, we also caught up with Nomura Sonal Verma, Managing Director and Chief Economist, India and Asia ex-Japan. Here's what she had to say about the tariff war that is likely to play out.
So I think the direct impact is probably easier to estimate, given India exports about 2.2% of its GDP to the US. So we know that there's probably a 20 to 30 basis point kind of a direct impact. But I think this is much bigger than that, and that is where the concern really is. It's really the weaker global demand, uncertainty weighing on investments, tighter financial conditions, which basically feed back into weaker business investment, and also hurting consumer demand because of the negative wealth effect. And actually, the second round effects are extremely difficult to quantify and are still playing out as we speak. So our growth projection for FY26 is at the low end of consensus. We think growth will be softer the ongoing financial year at 6% on a year-over-year basis. But we do see downside risk even to this projection. And, globally, Neeraj, we've cut our numbers more significantly for other open economies in Asia, and for the US as well. We've downgraded our growth numbers for 2025.
That was going to be my next question, that would you reckon that global growth at large as it stands takes a significant cut on current scenario, and does that, Sonal, change meaningfully? Let's say growth for the ASEAN region, does it change meaningfully if economies are able to strike some kind of a deal with Donald Trump? Because everybody at least in Asia and Australasia, maybe Australia, Japan, Vietnam, all of them are on record saying that they want to go to the US, talk to Donald Trump and try and reach a deal.
That's right. I think outside of China and EU, at least most of Asian countries are looking to negotiate with the US rather than retaliate. And this negotiation is either in the form of lower tariffs, more investment in the US, buying more of US goods. So a lot of countries are offering that. The question is, the reciprocal tariff is actually not just about lowering tariffs. And for instance, the VAT or the GST that countries charge this is an important source of fiscal revenue for these countries. And therefore, it'll be very difficult to negotiate on the GST rate, for instance. Similarly, the tariff on politically sensitive sectors like agriculture is potentially non-negotiable in a number of countries. So I think it is possible that some countries do manage to negotiate their tariffs slightly lower going forward. But even countries that actually have basically an FTA with the US have been slapped with a 10% tariff. So the extent of rollback on tariff is possible, but may not be very substantial. And therefore, our assumption for the US is that US effective tariff rate on its import will be above 20% this year. And if the US wants companies to invest in the US, then they will likely keep tariffs high for some time. So the tariff rates will also be sticky. So some rollback is possible, but I think, it may not be very substantial is what I'm saying. Now, what it means in terms of global growth, nevertheless, is that the tariff shock is quite significant, both directly as well as indirectly through the various channels that we discussed. Particularly for the US, it is a stagflationary shock, and we have cut our growth projections for 2025 for the US. So on a Q4 over Q4 basis, we've cut our numbers to 0.5% down from about 1.4%, so nearly a percentage points drop. For rest of the world, it's more of a negative growth shock as well. So for Europe, Euro area and Japan, we've cut our numbers by 0.2 percentage points. And Asia, we think, will be hit the hardest because this is basically home to the open economies in the region, and the tariff rates on Southeast Asia are quite elevated at between 35 to 50%. So the growth impact will be quite substantial for countries like Vietnam, Thailand, Singapore, Korea, Taiwan. So we've made cuts anywhere between 0.3 to 0.6 percentage points across countries.
Moving on, the other commodity which is impacted right now is crude. Actually, it hit a low of almost $60 per barrel. We also spoke with Vandana Hari, expert in the oil and gas space, about how deep the crude fall could be from here on. And she believes that the levels absolutely depend on what US President decides to do. He is the only one who can put a lid on the pricing right now. Let's listen in.
That's probably, those are the most important questions and probably the hardest to answer. With regards to how much lower we could see prices go, I think it depends on what we see in the coming hours. And I'm saying hours rather than days, because I am expecting Trump to put out some kind of messaging, some signal that things are not going to be as bad as the markets are fearing, that what he's doing, he's talked about short-term pain, right? But I'm not sure that pain, that recession qualifies as the pain in his statement. So watch out for what Trump does and says. If he signals that it's not going to be as bad, I would expect crude first to find a bottom, and second to start moving up. Your question also was, how quickly it'll move up? I think it'll be very, very cautious, because it will take time for the markets, for the dust to settle. This is a huge shock. There's going to be aftershocks and ripple effects. So the market will be cautious. But at the very least, I think Trump is the only person who can put a floor under prices right now. And as we've seen last week, OPEC Plus has left the stage. So there's really nothing else that can come in to rescue. And I don't think the Fed either. I noticed you were talking about that earlier. I think they are in a wait and watch mode as well.
So what is the upside at this point? And is it too early to call?
Yes, I mean, look, you start thinking of all the supportive factors, one of them being, for instance, that, you just mentioned that TI slipped below 60. Even in the low 60s WTI, it is a bad environment for the U.S. shale sector. So you can assume that instead of the 200 to 300,000 barrels per day increment in U.S. oil output that we were factoring in for this year, at low 60s, below 65 WTI, it's going to be closer to zero. The other argument typically that comes into play is that as prices fall, that will ease inflationary pressures. There will be a little bit of a fillip in demand as a result to low prices. But see, the thing to keep in mind is all of these are very slow-acting factors. So as of now, again, they are not ones that can quickly step in or will quickly step in to steady market sentiment. So we, as I said again, I'll repeat that I think it's watch out for what Trump says and does in the coming hours.
So inventory losses with regards to OMCs, and if you talk about marketing margins, that could improve. So it's a double whammy with regards to, which direction OMCs go from here on, but an interesting aspect that we should be considering as well. But moving on, we also spoke to Walkart founder Habil Karakiwala, who said that Indian pharma companies that export to the US could face some pricing pressure as well as a temporary drop in sales. This was in connection with what impact the tariffs could have on the sector. Let's listen in.
Currently, there are no duties on pharma, but what will happen in future only Trump will know. I could mention that the impact, it's not easier for anyone to switch manufacturing from India or anywhere else to US. So in the short term, certainly there would be a price pressure on US consumer and healthcare provider in the US. As far as Walkart is concerned, we hardly have a significant presence, hardly less than 5%. And we have planned to exit the US generic business. But many other pharma companies have a very large exposure to US business, somewhere between 30 to 50% of their revenue. And they will have to adjust themselves by maybe a little squeeze in margin, little impact also on the sales, because it may affect, but it will be very, very difficult for pharma industry to manufacture all the products in the US, because it will take several years to do that. And it is a multi-product industry, because we have so many products, so many API suppliers, and many of them are from India and China. US hardly manufacture much of the active substance. So it's going to be a fairly complicated affair, but the end result would be the US consumer and healthcare provider will have to accept a significant part of a burden. And the future of pharma industry from India, who have a very large exposure, they would certainly rethink their future strategy. And probably they would diversify the business a little more away from the US.
So that's the overall roundup of what is happening in the markets currently. Completely out of time. With that, it's a wrap on this edition of at NDTV Profit. Please stay tuned to lots more.
Inventories over a 45-day period. And if you go back to, say, early January, the crude price then was $83, which came down subsequently to $75. So the crude inventory that they're carrying is at $75 on an average per barrel. So, but if your question is going forward from here, if the price remains at $60 a barrel, as it is today or thereabouts, and I'm not going into the Indian basket or Brent, etc., I'm not going into that, then can you legitimately expect prices of petrol and diesel to be moderated by the oil marketing companies in keeping with the global price? To which my answer would be yes. In a deregulated sector, you can expect them to accordingly adjust the market retail price. But that's not the only reason why I've called you here. I have requested you to come because we have also had to look at some other areas for decision making. And I want to draw your attention. We'll be giving you a note. The note I'm using, I'm also going to share with you, both electronic copy and otherwise. You know, we have come a long way on LPG. There was a time when an LPG cylinder was an item which was rare, which you had to stand in a queue for, etc. When the Honorable Prime Minister assumed office,
So you said below 60, below 65.
by today it's 60 or thereabout, 61 or 62. Yeah. But please let me complete, then you ask me whatever question you want. So there was a time when, you know, you had to stand in a queue to get a cylinder, you had to use influence. Today, you can actually SMS, you can also do what we call IVRS, voice call. You can send a WhatsApp message and they will deliver a cylinder to you at your residence. The total coverage of LPG for the population, it stood at around 14 crores or 140 million in 2014. That has gone up to around 33 crores or 330 million. So if you go by the yardstick that you have one cylinder per connection per household, then the entire country is covered. In fact, I would say there's more than 100% LPG coverage. In addition to that, we have an Ujjwala scheme. The Ujjwala scheme was introduced in 2016, and the Ujjwala scheme also has something like 100 billion plus or 10 crore plus beneficiaries. And the advantage of the Ujjwala scheme and overall LPG connections is that today our brothers and sisters, more our sisters, they can have freedom from firewood, coal, cow dung, cakes, etc., all the traditional cooking fuels, which is not the case even in some advanced countries, where even though the country is developed, the rural countryside is still using firewood and coal, etc. Now, the LPG infrastructure in India, I just wanted to tell you, we have now gone from 55.9% LPG coverage in 2014. We have gone today to 107.4% LPG coverage. Number of bottling plants of our OMCs or oil marketing companies has gone up from 187 to 212. Number of LPG distributors in India was in 2014, we had 13,896. Today we have 25,554. The domestic LPG connections I've told you, the consumption in the country of LPG through the OMCs, it's 17.6 million metric tons. In 2014, it has gone up now to 30.4 million metric tons. Now I want to come to LPG pricing, and I think this is one of the subjects on which I wanted to have this exchange with you. The price of LPG. Now LPG is the product which comes out of a refinery. When crude oil is refined, LPG comes out, petrol and diesel are also products of refineries. The international price of LPG, which has been determined by the Saudi CP international benchmark, has been going up. It went up from 415 metric tons, dollars per metric ton to $712 per metric ton, but we never passed it on to the consumer. We kept it exactly where it is, and I think the rate of increase has been moderated and absorbed by the OMC. As a result of which, last year, the OMCs had a loss of 28,000 crores because of the LPG are keeping the price of the gas cylinder, the 14.2 kilo gas cylinder under control, providing Ujjwala subsidy. They incurred a loss of 28,000 crores. And the government, through its provisioning, through the budget, we gave them 22,000 crores back. I just wanted to give you this background. Now, more recently, on 5th October 2023, the targeted subsidy on an LPG cylinder increased to 300 rupees, which in other words, and in the effective cost of a Pradhan Mantri Ujjwala Yojana cylinder came down to about 503 rupees, and for an ordinary cylinder to 803 rupees. Now, this has resulted in a cumulative loss of 41,338 crores last year. 41,338 crores. Madam, I'll be giving you these notes also. Whatever I'm using, you will have the same information. I'm just trying to set so that you can ask me questions. As a result of which, what has happened is that the Saudi CP international benchmark rose by 63% from 385 metric tons in July 23 to $629 per metric ton in February 25. It was a 63% increase. Whereas we brought the price of Ujjwala and the cylinder down. So, you are two simultaneously competing trend. International prices going up by 63% and our prices coming down. This is what resulted in the loss for 43,000 crores. So what are we planning to do? The statistics will give you all the paper, this thing. You compare the price of LPG cylinder in India and Pakistan, Bangladesh, Sri Lanka, Nepal. Even if you equalize the currencies in terms of the exchange rates, India, as I said, a normal cylinder was 803 for the normal cylinder. LPG cylinder 503. In Pakistan, it was 1,080.59. In Bangladesh, 557.81. In Sri Lanka, 1218.09. In Nepal, 1206.39. The cost of cooking gas per day for a family, average family of 4 in India, was 6 rupees and 10 paise. And the cost of cooking per day in a non-beneficiary, that is somebody who's not an Ujjwala beneficiary, is 14 rupees 58 paisa. Now, by any yardstick, that's a very reasonable price. And if you look at the cost comparison with neighboring countries, I've already given you ours. The thing has come down by 23% in our price at a time when global prices were riding. Pakistan, rose by 5.53%, Bangladesh on 1 rupee 11 paise, Sri Lanka by 10 rupees 60 paise, Nepal by 5 rupees 73, in India it's come down. No, these are percentage. India it's come down 23.74. These are all percentage figures. I'm going to give them to you. Now, what has happened in Pakistan and all those countries, I'm giving you. What we have decided, therefore, is that the average price, not the average, the price per cylinder of LPG will increase by 50 rupees. In other words, from 500 it will go up to 550, and the other one will go up from 803 to 853. Now this is a step which we will review as we go along. As it is, we review these every 2 weeks or 3 weeks. And therefore the excise duty that you have seen increase is not to go on to the consumer on petrol and diesel. As I kept telling you, that excise increase is intended to compensate the oil marketing companies for the 43,000 crore that they have incurred as a loss on the gas part of it. Now you will say, what will happen to petrol and diesel? As I told you, the inventories that they are carrying are 45 days old. The inventories are very clearly at a much higher price. My expectation is that petrol prices, even if they increase beyond 60, because this is an international evolving situation, they are unlikely to go back to 75. And if they are in the vicinity of 60 or 65, Madam was asking this question, is it 60 or 60? Just now I think it's 61 point something. But if 62, that's 61.89 is what I heard. Even if it goes up to 65, I think the oil marketing companies will have the cushion or the, what do you call it, the bandwidth or the headroom in order to look at price moderation, but not in the upward category, in the downward category. So I have given you a backgrounder. I'm going to give you these notes also.
This LPG, you have said that 50 rupees have been increased.
In the LPG cylinder.
In the LPG cylinder.
Yeah. But I also wanted to tell you that what is happening in some of the non-BJP states, where the difference between a BJP state and a non-BJP state, let me give you Chennai, the difference between Itanagar and Chennai is rupees 9 and 93 paise. 9 rupees 93 with nearly 10 rupees difference in the cost of a cylinder. In between Lucknow and Telangana, it is 12 rupees 76 paise. Between Gandhinagar and Bangalore, it's 8 rupees 22 paise. Between Panaji and Kerala, it's 11 rupees 5 paise. Guwahati, it's 105 rupees. The difference is 6 rupees 82. So there is between BJP and non-BJP states, it's a very clear difference. Today I've seen that Karnataka has raised their price. I haven't. First statement. No, I have the here. Yes, I have this notification issued by the Karnataka government dated 1st April. I only saw it today because. I'm just coming. Yes, correct. For the words and figures 18.44%, the words figure 21.17% shall be substituted. Yeah, but Karnataka, I'm not surprised. They are not stopping at fuel only. They've taken milk prices also, etc. So we'll leave that aside. So now again, I want to give you the overall picture. My assessment is that as we go forward from here, international prices of gas also are expected to come down. By next year and year after, they will come down substantially. But since we are giving such a comfortable cushion to our companies, now I've already told them this will be in their notes, what's happening in Pakistan, Bangladesh, all the countries. So this 50 rupees increase per cylinder will be for the Ujjwala beneficiary, and overall for the non-Ujjwala beneficiary, it will be again 50 rupees, will go up from 803 to 853. Again, this will be reviewed every 15 days or 1 month, whichever is the system. And in the case of petrol and diesel, as I said, if this trend remains, then the price is likely to be revised by them. It's a deregulated sector. They don't have to come to us. हाँ जी, आप कुछ सवाल पूछ रहे थे. हाँ जी, एक मिनट. किस चीज का प्राइस? Tomorrow morning.
tomorrow morning.
So you are getting a first preview into it.
तो सर ये सारे उज्ज्वला और नॉर्मल जो सिलेंडर
50 रुपए पर सिलेंडर भैया बढ़ेगा, वो भी at a time like this is really to deal with that 41,833 crore loss that they've made. So the excise duty rate is for that, not for relax.
सर 830 करोड़ और 330 करोड़
हाँ 41,000 some 800 some crores यार. मैं एग्जैक्ट फिगर आपको इसमें मिल जाएगा. Digitally sent also यार. I'll give it to you in a minute because I don't want you to be मेरे अपने नोट्स का आई है. Just give me a second. It is 41,338 crores exact.
How long would it take for this amount to be recouped through the excise duty?
I don't know the calculation. It's I think about 16,000 crores in.
So I mean, our anticipation is about a year.
Year or
During
so.
the course of this financial year, 25, 26, we should be able to find ways to recoup that money.
No, we are committed to giving the money to the oil companies because the oil companies have incurred it on our behalf as a subsidy. But whether the full 41,000 will be done or 16,000, that remains to be seen. That's government has enough headroom for that.
So this price will not be effective for non-Ujjwala scheme, right?
50 rupees per cylinder for Ujjwala and non-Ujjwala. Ujjwala अगर 500 का मिलता है वो 550 का हो जाएगा. दूसरा 803 का 853 का हो जाएगा.
Sir, how much will we be able to recoup? You just made some reference. So, and how much can we expect to this excise hike?
No, देखिए ऐसा है. Our commitment when they incurred a loss of 28,000 crores, we gave them 22,000 crores back. Okay. Now this is very important for you to fact this point that we are committed so that the companies don't have to bear the brunt for it. They are commercially run company. So कितना होगा कितना उनको finally उतना ही मिलेगा जितना loss उसके आसपास ही मिलेगा.
So this increase of excise policy, the Congress party is saying.
Sir, commercial का भी
मैंने बोला ना भैया 50 रुपए उज्ज्वला का नहीं कमर्शियल का तो वैसे ही कम हो रहा है यार. कमर्शियल तो हम करते ही नहीं वो तो मार्केट करती है. वैसे पीछे 42 रुपए कम हुआ है कमर्शियल का. We will find ways यार. अरे भाई one request one by one each one of you will benefit and I am also now I will be able to absorb and respond also by one. Please ask
So
whatever.
on English and Hindi, the Congress party is reacting on this. The Congress saying that it's robbery by Modi government when crude oil prices are at $6 a barrel. The government raises excise duty. In whose pockets is this money going? This is going to
उसको बोलो whoever has given you this reaction say my response to that is the Congress's way of doing business was to float oil bonds for 1,40,000 crores out of which we are still paying back 3,10,000 crore. We are still paying back, which is a robbery and which is as far as this is concerned, tell them we are not increasing the cost or the price being charged to the consumer. If these trends remain, the fundamental arithmetic of oil diplomacy is that the inventory which is being carried by the OMCs today is 45 days old. That was brought at an average price of $75 to $80. When the $60 has to kick in still, if it remains $60, the price will be lowered. इतना समझा दो तो कांग्रेस पार्टी के लिए काफी होगा. देखिए प्रश्न ये उठता है कि कांग्रेस का काम करने का तरीका ये है कि जब वो सत्ता में थे उनके वित्त मंत्री ने ऑयल बॉन्ड्स फ्लोट किए थे. 1,40,000 करोड़ के ऑयल बॉन्ड फ्लोट किए जिसमें हमें अभी 3,10,000 करोड़ वापस लौटाना पड़ रहा है. जो ऑयल मार्केटिंग कंपनीज होती हैं इनकी जो ऑयल की इन्वेंट्री होती है वो 6 हफ्ते होती है, 45 डेज होती है. तो 6 हफ्ते वाली इन्वेंट्री जो है वो 60 में नहीं खरीदी गई थी, वो 75 प्लस में खरीदी गई थी, $75 पर बैरल. और कुछ जो अर्ली जनवरी का रेट था $83 था. तो हम उस पे चल रहे हैं. ये $60 अगर रेट आज हुआ है, अगर $60 रहा तो संभव है कि आने वाले समय में ऑयल प्राइसेस जो ऑयल और डीजल प्राइसेस कम होंगी. इट स्टैंड्स टू रीजन. या one by one.
Can you please help us understand as to why government has imposed excise duty on petrol and diesel? Is it because international fuel prices are falling and that could have given companies the gain, so government wants to mop up that?
No, not at all. The reason is very simple. the companies, those companies which will get the, or which have incurred a loss of 43,000 crores have to be compensated. Simple as that. So let me come to that. See, I explained to you the overall loss was 41,338 crores. Okay, that money has to be compensated. We stand committed to compensate. When they lost 28,000 crores, we gave them 22,000 crores. As far as international fuel prices are concerned, petrol, that's entirely separate. I told you we are carrying an inventory of 45 days old. That inventory was bought at $75. So when this comes down, when the current inventory, current holding is 60 or 63, 65, obviously there will be headroom to reduce it.
No, sir, but what we are saying, what I trying to understand is that petrol and LPG are not related.
But the company is the same.
I know, but you have not compensated. You are not compensating them yet. You are only talking about it last year.
No, it's an ongoing.
Not compensated them. Second, sir, just related question and last question. Is it because government is anticipating tougher days ahead? Because during COVID also, what happened when prices crashed? Government imposed additional duties to mop up the gains which were coming because of the gains several times. So is it just a preparation for the
No.
It's
Trump's tariffs, nothing. Trump's tariffs. Look,
that you might need more resources to support many of the.
Please. You asked a question. Let me answer it. If you have an alternate thesis, I'm willing to sit down in a half-day seminar with you. It's a very simple issue. Simple issue is the process of compensation is not a one-time action. It's an interactive process, all right? We have, as I said, last time they had losses of 28,000 crores, we gave them 22,000 crores. Now also they are not coming to us and saying, we are preparing the ground for whether it's done in this financial year. This question, Secretary was brave enough to say it will be done in this financial year. I don't know. This is unrelated. The 2 rupees excise additional which the finance ministry has imposed, we will not pass that on to the consumer. That is the first thing. That is being done in order to the companies. Now the companies will take that and the companies will also be reimbursed by us for the loss they have committed.
So it's very difficult to understand how LPG subsidy is linked to petrol, diesel, excise duty.
No, again, LPG subsidy is not listed.
If it had directly gone to companies, I could have understood the math, but this is beyond comprehension. How government is taking away the money with the general lecture that it will someday be compensated.
No, hold on. I think we should be civil about this. There's not a general lecture. I'll give you the whole copy of the note. It is not unrelated and yet it is not directly related. Let me explain what to you. The company which gives LPG is also in the petrol and diesel business. They are into the refineries. The LPG is a product of the refinery. So they are buying crude oil at a particular price. The inventory I'm holding today is of a crude which is average price $75. So again, I'm trying to tell you is if this $60 price kicks in, we will have the headroom to bring down prices of petrol and diesel. Now you're saying, is that because the first news that all the channels ran was fascinating. Excise duty gone up by 2 rupees, price to the consumer will go up. I was then left 20 minutes calling all of you saying by price to the consumer is not going up, price to the consumer is not going up. And now your question is a very interesting one and it's partly philosophical. Am I preparing for headwinds in case some global thing? Answer is no. Answer is no. It's as simple as that. We are the 2 rupees excise duty has been imposed by the finance ministry. It will not be passed on to the consumer. It will come into the general kitty and it will be utilized for reimbursing the LPG losses of the same companies. So please add to this. Yes, 1 minute, ma'am. Let the secretary who does this full time. I also try to do it full time.
So look, the additional excise duty goes to central coffers. Right, it goes to the Consolidated Fund of India. Any claims which are eventually approved for reimbursing the losses incurred by the OMCs on LPG also come from the Consolidated Fund.
That is the point.
One can keep trying to do, in my mind, I can keep trying to draw a line between the two. It's never that simple. It's not that there's some separate escrow account in which something goes. Everything will go to the Consolidated Fund of India. Thereafter, and every rupee to be spent from there follows a process of approvals It is appraised by the Ministry of Finance, it goes to the cabinet, all those processes are yet to happen. But our track record is...
Once we make a commitment, otherwise what will happen? I mean, let me be very frank with you. You see, if the story goes out, like one day, as soon as this excise 2 rupees increase came out, all the channels were carrying, consumer, it will be dearer. I mean, I said it will not be dearer, it will be exactly the same. Then I also had to say, bhai, chalte, it will be dearer the other way around. It will be less expensive if this trend holds. No, 1 minute. Somebody also said, no, this excise has been imposed on exports. I don't know where that story came from also. So the idea of having this interactive discussion with you is to clear your cobwebs, and if there's still something down, we will discuss it. But this is to...
How much money
can you let him come back.
Excise duty plus the rupees 50 increase in LPG cylinder will be used to compensate the oil.
No, it's not that. It's slightly different. Let me explain this.
Well, can you let us complete? Can you?
Somebody's asked me a question.
No, hold on. Now, listen. I don't like to play the monitor here, but please, there has to be some decorum that everybody else is here. Please answer it here, please.
See, there is something which relates to last year, which, as the Honorable Minister explained, is about 41,000 crore, right? Has that ended this year?
No.
No. There is under recovery on LPG, which is going on a concurrent basis even as we speak. So the 50 rupees increase actually addresses the concurrent under recovery. It is not addressing the backlog. The backlog remains where it is. For the backlog, we will be making a request. Our request goes to the Ministry of Finance. They process it, goes to the cabinet. So there's a whole process which goes through.
The other thing, let me tell you, when you're dealing with something like the Consolidated Fund of India, once it's in the Consolidated Fund of India, you can't say this compartment or that compartment. The idea is that the government believes, you see, the normal expectation is that all prices have to come down. But sometimes when you have a situation like this, you must have the ability also, especially when your domestic LPG price is so much cheaper than the rest of the world. That's why I gave you those long statistics, cheaper than in the neighboring countries, cheaper. So we have, as a measure for the time being, raised it by 50 rupees per LPG cylinder. As gas prices become, my own view is that from a few months from now, more and more gas, we may bring it down. We bring it down to 50, we'll review it. Yeah.
Sir,
1 minute. Now you.
Sir, there is anticipation the Saudi CP price बढ़ेगा. तो ये भी क्या consideration में है?
Just now, Minister answered that question.
But sir, isn't it further compounding the problem of OMCs? They have a backlog of 41,383 from the last year. Plus now they have to bear the subsidy or the excise duty hike as well, because it will be reflecting into the bottom lines or the profitability of the companies.
Let me answer
50 rupees is not meant for the previous coverage, or neither it is going towards meeting the.
First of all, let me answer that question. Madam,
Sir, please.
Compounding the problems of the OMCs. You know how much profit? No, मतलब तो ये पिछले साल उनका क्या प्रॉफिट था 1,59,000 करोड़ और नहीं गुना नहीं अच्छा हो गया. अरे my friend, let me tell you, 31st मार्च का और उनका क्या हुआ, वो जो क्वार्टर एंड हुआ है उसमें भी उनका प्रॉफिट अच्छा रहेगा. अभी अगर 50 रुपए बढ़ाना तो आई एम सो हैप्पी टू से योर ब्लूमबर्ग और रॉयटर्स, which one?
No.
I'm so happy that an international agency is so worried about the profitability of the OMCs. I deeply appreciate that.
50 rupees I'm not bothered.
Then
if it's reflecting the market prices, that's fair enough. But 2 rupees, they have already absorbed the loss of 41,000.
Hold on.
Sir, ये duty on export
नहीं. सुनिए. Okay.
Last time petrol and diesel prices were reduced in March of 2023-24. The crude price were at $83-84.
Yeah.
And they, according to you, are now at 75. So
It's what happens is we reduce the excise not twice, thrice. May 22, it's a continuous process. You reduce the excise when the price is at somewhere, then it comes down, goes up. All I'm saying is the potential for reduction whereas the price goes before 75 is also there, but that's not for me. It's a deregulated sector. The OMCs will do it. That's the point I'm coming to. Insofar as whether they have the headroom, whether we're compounding, I don't think the OMCs have any difficulty in absorbing that 2 rupees excise. In fact, all the discussions that we've had for them prior to this. So I'm so happy to say a distinguished member of the fourth estate trying to argue on behalf of the OMCs. OMCs are very content with what we discussed.
So, but sir, they are the taxpayers' money, na?
So they are, so they will, they're answerable to, so you are the...
Ujjwala cylinder hike will be implemented from today onwards.
Sir, how many liters of petrol and diesel we sell daily?
Sir, will there be any impact?
Please address questions to me.
No, you should answer that. How many, these are factual questions. How many liters of petrol and diesel do you sell in a day?
I think in a year we sell about 16,000 crore.
6,000 crore?
116.
1,000 crore liters of petrol and diesel combined.
Sir, just one question. Instead of hiking the excise duty, and then going through a mechanism to give a part of that money back to the OMCs to compensate for their previous LPG losses, wouldn't it have been simpler to not hike the excise duty and let them make an additional margin for
You're taking money from me to make good my losses, you know?
And then
फाइनेंस मिनिस्ट्री में वैकेंसी इसको भिजवा दो. I would recommend एक मिनट. Look, I love talking to you guys. It's always very instructive. The whole productivity of this exercise, we have called you here to explain to you and explain what has been done, what is going to be done from tomorrow, etc. Okay? Let me tell you, so far, we are the one country in the world which, thanks to the Prime Minister's forward-looking policy, we have been able to navigate this global turbulence rather well. Okay? We are the only country in the world where prices over a 3-year reference period on petrol and diesel have actually come down. We are the lowest priced country in the world for domestic cooking fuel. Okay, so we've been able to do all that. Whether we do it through one means or another means, it's all the same. I deeply respect you, say, couldn't you have done this? But this is not the kind of exercise we are in. This is a decision I sprung into action because the finance ministry notification came at
3 o'clock.
3 o'clock. I anticipated it. I didn't know what time it will come. I requested you to come at 4 o'clock to explain to you in a very candid, open, transparent manner what we are doing. Let me also, I think, don't mind taking 1 or 2 more questions. Let me also explain to you my own personal view. I see international prices softening. Pankaj, you agree with me? Over a period of time. So what we are doing now for the current phase is to, well, you can say equip ourselves, insulate ourselves, but this is a very small thing. If you say, why don't you allow the oil marketing companies to take the whole responsibility? Well, as you say, they're commercially run operation answerable to the stakeholder, but we are also 50% part of that, something like that, no? So we always try and accommodate one with the other, and so far they have done very well. Last year 1,59,000 crores. So when we end this financial year, utna hi hoga ya thoda kam hoga. They're all in the pink of health. So they will do well.
Sir, do you foresee
एक मिनट one by one.
वही पुराना सवाल कि सर आम आदमी को राहत कब मिलेगी? अभी बता दीजिए सर.
आम आदमी को तो राहत मिली हुई, इतना सस्ता पेट्रोल डीजल और कब होगा?
कब होगा सर?
देखो, मैंने आपको बोला यार, आम आदमी को जब ये आम आदमी के साथ पीठ जुड़ जाता है ना, तो मैं घबरा जाता, फिर वो जो डायलॉग है वो थोड़ा सा क्रांतिकारी हो जाता है दूसरी तरफ. Look, it's like this. As I told you, we have the lowest prices. We are the only country where prices have come down over a 3-year period. और किसी कंट्री में कम नहीं हुआ है. क्यों है कि सेंट्रल गवर्नमेंट ने अपना एक्साइज कम किया. बट मैंने बड़ी मेहनत के साथ आपको ये कन्विंस करने की कोशिश की कि अभी इन्वेंट्री जो है वो 75 प्लस भी है. जनवरी अभी आने से पहले हम लोग बात कर रहे थे आपस में, भाई जनवरी के बिगिनिंग में क्या क्रूड प्राइस है? 83 थे, उसके बाद 75 हुआ है. सो हमने क्या किया है, अगर ये 60 वाला ट्रेंड जो है ब्रेंट और ये चीज़ें ये रहा तो फायदा नहीं है. दिस दे विल गेट द नोट यार, व्हाट इज द प्राइस इन अदर कंट्रीज, गिविंग यू स्पेन में इतना बड़ा, जर्मनी में इतना बड़ा, ऑल दैट यू गेट. अगर ये रहा 60 के आसपास का ट्रेंड, और मैं आपको रेंज में 60, 65, 68 रहा, तो ऑब्वियसली Aam Aadmi can then expect further softening.
So government will further not increase excise duty
You want me to answer questions on behalf of the finance minister? यार क्या मैं थोड़ा ना एक्सरसाइज करता अरे नहीं ऐसे सुनो यार गवर्नमेंट का ऐसा है वी आर अ रिस्पॉन्स मैं फिर एक्सरसाइज बढ़ा दूंगा one by one he is asking the question. I know you want I'm so happy. I'm feeling very happy that this is a vibrant press conference. एक मिनट I'm a very important for petroleum and diesel. I'm a very important part. I'm the line minister. Yeah. अच्छा हाँ बोलो. I'm not in the business. Parliament में भी वो थम्बी दोराया from DMK asked me, why don't you give an assurance that you will do more? मैंने कहा I'm not in the business of giving assurance. देखिए मैं आपको बोल रहा हूँ ये जो एक्साइज ₹2 का इंक्रीज हुआ इसका मैंने रैशनल बता दिया है क्यों हुआ. अगर आप मेरे से पूछते आपको क्या लगता है आगे तो मैं सकता आगे जाके ऐसे नहीं होगा. पर ये एश्योरेंस वर्ड जो है ये मेरी डिक्शनरी में नहीं है. जब से मैं मंत्री बना हूं तब से मैं आई टॉक अबाउट नहीं सही सीरियसली बोल रहा हूं. मैं कौन होता हूं एश्योरेंस देना. ये डिसीजन मेरा थोड़ा मेरे से ऊपर का पे ग्रेड का है डिसीजन.
And cooking gas or LPG price has been raised by 50 paise per cylinder. This is what we're hearing from Union Oil Minister Hardeep Singh Puri as he addressed the press. We'll slip into a short break right now, but more news and updates on the other side.
Basically, see, all said and done, as I keep saying, that one should not go by what we recommend on the stock specific basis, because markets are going to remain choppy and volatile, and every day is a new learning, every day there is a new event. Luckily, market gave very good opportunity on, I would say, Thursday, when markets were steady and not falling much, and Friday opening was also only 60 points down for the Nifty, where we raised a lot of cash. Luckily we raised around 13.5 to 15% cash in the portfolios, and that will put to work slowly and gradually after today's fall.
So, okay. So are you saying that you will start deploying?
Yeah, a little bit, gradually.
At about
and that's what I always do, because in a falling market like this, and where this will end, actually nobody will know, right? But I would agree with Mr. Ramesh Damani's statement that over next 2 weeks or 3 weeks maximum, something will happen, and Trump will claim victory, and things will start to reverse. So things cannot continue to fall all the time. So we have to deploy very gradually, slowly, in the pockets which you feel are least impacted, or whether or in the pockets like IT, for example, where the impact is already pricing in. For example, if today also it falls by 3-4%, then I would say that even the bad numbers which are going to come for the March quarter gets little bit priced in. And then if suddenly something improves globally, then you can see a very sharp bounce back.
AB Real Estate might look to sell their paper business to ITC. So that would be an interesting deal, not too big for ITC, but from AB Real Estate's perspective currently.
On the 20th, he reported this in his segment Heard on the Street, which runs at 2:30 p.m. every day.
Markets are rattled as the Nifty plunges over 1,000 points and the Sensex nosedives more than 2,000 points, marking one of the steepest declines in recent months. Nifty saw its worst intraday drop since June 2024, but a sharp recovery from the lows helped limit the damage. Meanwhile, stock markets across Asia plunged sharply as shares nosedived around the world as higher tariffs and a backlash tepid growth of corporate tax collection in Q1. And the Reserve Bank of India's Monetary Policy Committee commences its first meeting of FY26. This MPC will determine the outcome of key lending rates for the central bank, scheduled to be announced on Wednesday. Good evening. You're watching Profit 360 on NDTV Profit. I'm Sanjana. The tariff storm is rocking global markets with Indian equities plunging, sectoral indices deep in the red and volatility spiking. Despite the turmoil, however, India may be better positioned than its peers, opting for a balanced long-term approach over knee-jerk retaliation. Plus, expert voices weigh in on what's next, from recession risks to market recovery and the outlook for key sectors. Stay with us as Profit 360 brings you everything you need to know. So first up, a look at how the markets fared today. A volatile session for markets today as Nifty saw its worst intraday drop since June 2024, but a sharp recovery from lows helped limit the damage. The Sensex and the Nifty rebounded nearly 2 to 2.5%, while broader markets staged a strong comeback. Nifty mid-cap surged 4.7% and Nifty small-cap jumped over 7% from the day's lows. A roller coaster day with investors navigating deep losses and a resilient pullback. Let's go across to my colleague Harsh Satya for a detailed market wrap now.
Well, it was always expected to be a tough day of trade. Global cues suggested it. We slipped below the 22K mark, but we've recovered fairly decently in that sense. 500 plus points from that day's low is how the Nifty has recovered. So that's quite a bit of turnaround. Within the Nifty, IT was the pack to watch out for. Nearly 2,000 points up from the day's low. We've closed 2.5% down for sure. But the bounce from the day's low was very, very sharp. And even if I can pull up quickly an Infosys, it will show that it's one of the stocks which has really recovered from the day's lows. Infosys, TCS, those were 2-3 counters which have done very, very well within that IT pack. And the recovery from the day's low was extremely sharp on some of these counters. Also, when you're contextualizing auto, a Tata Motors was one of those which has been hurting and reeling under tariffs. Again, the recovery from the day's low was very, very sharp within Tata Motors in particular. Nifty Auto a bit, but Tata Motors in particular, from 535 we've gone and closed at 582. So a very, very sharp recovery at that where Tata Motors is concerned. But let's talk about the Nifty 50 basket of stocks, and within that FMCG was the one area which was okay, and you'll see HUL leading that. Nestle also down just about 1/3%. ITC largely down just about 1%. Trent was the one hurting. Commodity stocks and Nifty Metal was the one big casualty for the day. Let's pull up the sectoral heat map as well, and within that pocket we'll see that the big movers were Nifty Metal, Nifty Realty within the broader markets, and Nifty Auto, which is down 3.4% nearly. Nifty Bank largely in line with the Nifty 50 index, but pinpoints all around. Nifty FMCG down 1.1 odd%. So that was the one outlier. Nifty IT down 2.5%. We did speak about that. The Nifty Pharma was down 2.8% as well. So that one in focus. Last off, I want to also talk about the breadth. The breadth was extremely weak as expected, but we saw a bit of recovery right towards the end. So 172 advances to 2060 declines. It was a painful day of trade overall. Broader markets, I want to quickly zoom in on those. We saw recoveries from lows. Nifty's mid-cap and small-cap also saw sharp recoveries from those lows. 17,269, we saw 800 points of recovery there. And the Nifty small-cap as well. From 13,300, we've closed around 900 points higher. So all of those seeing a bit of recovery from the lows, but nonetheless, pain is elevated at this point, clearly 4% lower despite that. Those are the top gainers and losers. Siemens, there's a special situation, but outside of that, plenty of them. Delivery, of course, making that acquisition. But let's go across, let's listen into some views. We had a Mihir Vora as well as a Nilesh Shah to talk to us about everything that's happened in markets today.
Clearly, domestic focused sectors will stand out in this storm. Undoubtedly, India's growth can take a hit if global growth slows down, but we will still be a positive growth. We will still be one of the fastest growing major economies. So your portfolio should tilt towards domestic focused sectors rather than international focused sector. Within these sectors, which could take advantage of opportunity as India has been levied little less tariff compared to others, there could be opportunities in textiles and garment. There could be opportunities in footwear. There could be opportunities in some of the pharmaceuticals and chemical sectors and so on and so forth. But please remember, if the American demand itself comes down, then these opportunities will be back-ended, not front-ended.
You know, this is a diametrically opposite situation compared to 2008, I would say, in a lot of ways. In 2008, when there was a crisis, people would turn to the US dollar for safety. The people would turn to the US for safety. This time is the other way around. That time, the inflation problem was in other markets. Here we are going to face a deflation problem, and the US will face an inflation problem. So we are in a diametrically opposite situation to 2008. That's why I'm saying I'm not too worried.
Reassuring responses coming in from experts. Meanwhile, let's take a look at what the experts are saying with regards to sectors. The auto sector we saw sank 4%, while pharma and oil and gas stocks slid nearly 3% as market jitters intensified over these fresh US trade measures. However, industry experts are warning that uncertainty could weigh on demand, with actual policy implementation taking weeks or even months. In pharma, the US faces challenges in shifting manufacturing and keeping Indian exports critical. Meanwhile, as crude dips below $65, market sentiment hinges on Trump's next move. Let's quickly hear from these experts on what lies ahead.
Below 65 WTI, it's going to be closer to zero. The other argument typically that comes into play is that as prices fall, that will ease inflationary pressures. There will be a little bit of a fillip in demand as a result to low prices. But see, the thing to keep in mind is all of these are very slow-acting factors. So as of now, again, they are not ones that can quickly step in or will quickly step in to steady market sentiment. So we, as I said again, I'll repeat that I think it's watch out for what Trump says and does in the coming hours.
It will be very, very difficult for pharma industry to manufacture all the products in the US because it will take several years to do that. And it is a multi-product industry because we have so many products, so many API suppliers, and many of them are from India and China. US hardly manufacture much of the active substance. So it's going to be a fairly complicated affair.
We're in this period of uncertainty that is going to dampen demand overall. So whatever good positive benefit any country might get from having a better tariff environment relative to China is probably going to be mitigated to some extent just because we're going to be reducing demand in the marketplace.
Now, the shockwaves from Trump's tariffs have reverberated far beyond India, triggering absolute chaos across Asian financial markets. Equity indices across the region have plunged to multi-year lows, with some experiencing their sharpest sell-offs in months as investors scramble to reassess risks. So for a closer look at the scale of this kind of turmoil, let me quickly head over to Malika, who has the latest on what's happening across Asia. Malika, over to you.
Right, Sanjana, thank you so much for that. And of course, right, you mentioned that there are multiple reasons why we're feeling the spooks of markets trembling across the globe. And before I get into the reasons, I simply want to give you first a glimpse of how markets have performed. Let's begin with some of the splashes that you'll see. For example, ASX 200, Australia, dipped close to 4.23%. Let's go across to Hang Seng next. That's 13.22%. So one of the sharpest falls that China in fact saw. Next up, we have another market, Kospi, Korea, reacted over 5.57% down. Next up, I think we have another example for you, Nikkei 225, over 7.83% down. So you can actually feel the pain. And let's look at Nifty 50 as well. We started the morning with deep cuts and we were trading below 4% in trade today as well. Now, giving you some of the reasons why we're seeing the markets plummet the way they are currently behaving. One is because there is fear of global trade war. If I can just request to show that screen again. You see maps of America, China, Japan, the European Union, and Canada. Now, these are countries that are actually talking loudly amongst each other and talking about how they can really negotiate or retaliate back with reciprocal tariffs. And that's why there are fears of a global trade war. Next up, you'll see recession in the US is another fear that's literally spooking the markets across the globe, because there are severe economic impacts of these tariffs. You would see margin compression due to higher prices. This is because when US imposes reciprocal tariffs on imported goods, that means the price of products sold in the US markets gets expensive. That ends up hitting margins, and therefore businesses could get impacted because of this. And therefore, what happens? Inflation could be another byproduct of this entire saga. Because of that, there could be an impact on consumption as well, because people will consume less if products become expensive and there is less demand. Also, commodity prices. We have seen a lot of commodity prices also plunging, like oil and metal prices. These indexes have also seen sharp cuts lately because of reciprocal tariffs and tariff fears across the globe. FII selling is one of the last points that I'd like to show you, because as global investors become cautious towards emerging markets, they might also retract back and sell a lot of their positions in emerging markets. And therefore, these are some of the reasons that I could collate behind why we are seeing Asian markets fall so badly.
Absolutely, Malika. Thank you so much for that perspective. Really very clear now as to what's happening in Asia and why Asian markets are particularly so fragile or sensitive to what's happening with regards to these tariffs. Meanwhile, let's just get in an insight from Sonal Verma, the Managing Director and Chief Economist at Nomura, who weighed in on the economic fallout of these retaliatory tariffs, warning that downside risks could persist for some time.
Our growth projection for FY26 is at the low end of consensus. We think growth will be softer the ongoing financial year at 6% on a year-over-year basis. But we do see downside risk even to this projection. And, globally, we've cut our numbers more significantly for other open economies in Asia, and for the US as well. We've downgraded our growth numbers for 2025.
Global trade tensions rising, Beijing is taking action to protect its economy. China is exploring early stimulus measures to soften the impact of Trump's tariffs after already announcing, if you remember, a 34% retaliatory tariff on US imports that will take effect on April the 10th. The Chinese government has strongly criticized US trade policies, calling them economic dominance and insisting that global trade should be based on fairness and not power struggles. So for more insights, let's quickly go over to CGTN's Liu for the latest developments.
The Chinese government has launched a forceful response to what it calls US tariff bullying, denouncing Washington's policies as economic hegemony. On April the 5th, the state news agency Xinhua published Beijing's official stance, declaring the world needs fairness, not domination. This comes after Beijing unveiled 11 countermeasures last week, including a 34% tariffs hike on all U.S. imports starting April 10th, a WTO lawsuit against U.S. practices, export controls on heavy raw earth, critical for lasers, radar, wind turbines, and advanced tech, blacklisting U.S. firms under the unreliable entity list, and suspending some of the imports of U.S. poultry, sorghum, and bone meal. Analysts warn the rare earth restrictions could cripple U.S. industries. Bloomberg notes these minerals are the lifeblood of modern technologies, used in everything from jet engines to communications gear. Well, meanwhile, CNN reports China's retaliation is broader and more targeted than ever. As tit-for-tat measures escalates, fears grow of a global economic rupture. 刘嘉欣 CGTN 北京。
And reassuringly, a quick update coming in as sources are indicating that the Indian government is viewing India as better positioned than its peers under the reciprocal tariff policy. By focusing on balanced, long-term strategies, India aims to navigate the challenges without resorting to retaliatory measures that we're seeing in other countries. For more on this exclusive story, my colleague Shrimi joining us with the latest insights. Shrimi, how does India's approach to reciprocal tariffs give it an edge over other economies? And if you could give us an insight into what key strategies is the government considering to maintain stability amid the global trade tensions?
Yeah, so indeed that top policymakers stand being that India's, is in better position as far as global trade landscape is concerned. And in fact, they're saying that, the reciprocal tariff policies, which is being announced recently, is implemented globally and are not aimed at any specific country, but are a part of, broader international trade dynamics. So official, however, admitting that there is a downside risk to the growth outlook on the account of, uncertainties arising out of reciprocal tariffs, particularly in certain sectors, export-oriented industry. However, the growth outlook for FY26 remains largely unchanged. Now, remember, the economic survey has set the target of 6.3% to 6.8% as far as FY26 growth is concerned, and they are saying that it will remain unchanged. As far as steep tariff of 27% goes, India continues to engage in talks with the US. The government is actively working to finalize BTA, and the official, in fact, stating that they're trying to sort of navigate this entire tariff-related concern for the industry, for the exporter, and they are also reviewing the existing tariff structure under this ongoing trade pact discussion. And the sources also indicating that cabinet is also expected to meet on tariff concern and discuss how they're going to resolve the exporter issues, whether they could, incentivize them in some manner, some incentive scheme could be announced. So, however, with all these works, officials are making it clear here that unlike some other nations that have resorted to, retaliatory measure, India is opting for more calculated approach, aiming to strengthen its economic ties with the US. And in fact, they are saying that some of these sectors turn out to be very positive for India. For instance, reducing energy costs are expected to benefit the manufacturing sector at least. So quickly on the point that, they are saying that the growth is mainly, dependent on the domestic consumption, and the kind of policy that has been announced in the budget is going to help the overall economic situation of the country.
Right, Shrimi, thank you so much for that. With ongoing discussions shaping the future of bilateral trade, this information reassuringly highlighting India's strategic leverage. And that's all the time we had on this edition of Profit 360. Stay tuned to NDTV Profit for more news and updates.
Can we see illogical prices on the downside in asset classes as well? Because everybody's saying that Indian economy doesn't get impacted, but the uncertainty may still bring market valuations much lower than maybe long-term averages too, right? Can it happen?
Undoubtedly, Neeraj, but markets can remain irrational more than you can remain solvent. While this phrase is used mainly for shorting side, it can be true even on long side. If you are taking leveraged position, you may think today X is the fair value, but with a policy change, X minus something can become fair value, and hence markets will have to make adjustment. Anyway, markets are always trying to forecast future. As of today, we don't know what kind of tariff will be there on pharma products. Who will bear the burden, manufacturer or the distributor, which has disproportionate margin? But yet market is going to take pharma stocks down, assuming that tariffs will be less.
Hi, thanks so much for joining in. You're watching Your Money Matters on NDTV Profit. My name is Alex Matthew. Now, when you started investing in the equity market, I'm sure that a lot of people had warned you that there could be days like this. And indeed, it's been a tough day for Indian equity investors because finally, you have the Indian equity market that has caught up with the rest of the world. Last week, you saw severe drawdowns in the US market as well as in the Chinese equity markets and several other major stock markets in the world. And that's because of Donald Trump's tariffs that were announced. And over the weekend, of course, you had China that announced that it was responding in kind and that it was also raising tariffs. And this weaponizing of tariffs has created a very uncertain environment the world over, and our stock markets are reacting to that. The question is, how should you react? How should you adjust your investment strategy, if at all, in the mutual fund space? And I also want to specifically talk about a few global or international ETFs that are currently available here in India. They were trading at a premium to the net asset value, and that premium has shrunk very dramatically. Some of you might have been caught on the wrong foot. We'll talk about what you should do as well. Joining me to give you the advice that you need right now is Mohit Gang, the co-founder and chief executive officer of Moneyfront. Mohit, thanks so much for joining me today.
Thank you so much, Alex. Always a pleasure.
I'm sure you've been fielding a lot of calls, and I want to talk to you about some of that as well today, because the initial reaction to a fall like this is absolutely important from an investor standpoint. But before we get to that, let's address that ETF issue that a lot of people will have witnessed over a period of time. We've been speaking about it, Mohit, where that premium to the net asset value of some of these international ETFs, simply because the units were not being issued by the fund houses, had gotten to 18-20%. But that has shrunk very dramatically, and what that means is that if the Hang Seng has dropped 20% over the last 1 month, people who invested at the peak at a 20% premium to the NAV, they've actually lost 20% plus 12 percentage points. Is that the right way to look at it?
Oh, yes, absolutely. I think we've been always warning against that, Alex. The faster the rise, the sharper the fall, honestly, in these kind of scenarios. They were quoting at a premium because obviously mutual fund houses were not able to create fresh units because of RBI restrictions around the ETF limits and the global investment limits. Now, ETFs which were already created had some units which were getting traded on the exchanges, and people who wanted to sell were quoting obnoxious discount on those ETFs. And there were enough and ample warnings being issued.
Not discount, premium, na?
Sorry, my bad. Were quoting at a premium. Yeah. And there were ample warnings being issued that investors should not fall in lure just because the market is doing good or looking attractive right now. You should not buy the units at premium. And so is the case. Now that markets have corrected, there is a double whammy. A, the underlying has corrected, and B, the premium has shrunk dramatically. So the investors who bought at that high premium are now reeling under the pressure of dramatic correction on both the counts, the premium shrinking and the markets having corrected. So it was never a wise call. Even today, if there is a little bit of a premium, our advice would only be that not to go in lure for that premium or not to get over drained into it. I think as long as you get fresh units from the mutual fund, as long as there is good supply which is available, it's only fair that you buy then. Otherwise, I think one should just stay away from buying an ETF by paying a premium on it.
Okay, and what about if, for example, and I was looking at the NASDAQ ETF as well, Motilal Oswal, if I'm not mistaken, there the premium has not necessarily fallen as much as maybe the Hang Seng has fallen. So if there is still a premium, would you say sell and get out of that position, because you could potentially lose a lot more than what the underlying loses?
Look, I was just checking some data, Alex, right now, and I'll just give you a data. The Mirai Asset Hang Seng ETF today is quoting at an NAV of 11.75. Okay, but if you were to go and buy the Hang Seng ETF, it is coming at around 18.25. So there is substantial premium still. It has compressed a bit, but there is substantial premium still, which is out there on this thing, right? So similar is the case with even the Nippon thing, the Nippon India Hang Seng Bs, that also is quoting at some amount of premium to the NAV, right? So again, it depends. Look, there is scarcity, and the sellers would always command a premium in this kind of a market. I'm honestly would want to suggest investors that you never know if the tide turns the opposite way, which it is turning right now. The differential will shrink massively and the losses will get magnified. So to avoid those kind of scenarios, I would still suggest not to get into the lure of this purchase.
Okay, not to get into the lure, I take that point, but would you sell at this point, Mohit? That's the question.
Look, if you're getting substantial premium still, And I would say yes, it is not a bad option to sell unless your call on the underlying remains pretty strong, right? If your call on the underlying is very strong, which means that you're very bullish on the Chinese or the Hang Seng market per se, then you might want to continue to hold. But if your call on the underlying has changed and if you're still commanding a premium, then yes, by all means, you should exit.
Okay, let's also address some of those calls that you've probably been fielding since morning, Mohit, which is a lot of investors panicking and saying, what do I do in this kind of a market? I'm guessing those are the calls that you've been fielding, and how has your response been?
Oh, absolutely, Alex. It's been a crazy day and morning both. We've been continuously on the calls with all our investors, and I think all kinds of calls. We've got calls where investors are wanting to relook at their SIP allocation. We've got calls from investors who are panicking and who are asking what should be done. Should they redeem? Should they hold? Should they continue? We have got calls from investors who are wanting to put in more money, and we have also proactively reached out where there was liquidity available, and we were aware that there is liquidity available in investor portfolios. We have also proactively reached out and said that there needs to be some allocation which has to go in at these levels also. I understand that you can never clearly fathom the fall and you can never clearly call out the bottom. But if investors don't invest at these levels, then you will never make those superlative returns. You will always make normal returns if you keep investing at higher and higher levels and in good market conditions. But it's only when the tide turns against you, that's when, if you are taking those chances, that's when the portfolios will give you some superlative returns, right? So it all totally depends on the investor's risk appetite, the time horizon, the liquidity available, and the financial conditions. This is not a blanket call. No one can just go out clearly and say, oh, it's a buy day today or it's a sell day today. It is a very typical investor to investor, case to case scenario.
Okay, a few questions then. Would an STP approach in this kind of a market over a shorter time frame be more appropriate? Would a lump sum be better? And it's a no-brainer for a lot of people, but a lot of people do ask this question as well. Typically new investors, should you stop your SIP?
Look, three questions, Alex, out there. On the STP part, we've always been pretty clear on this for since the start of this year, that all STPs for this year need to go with a 6 to 9 month kind of a tenor. And we continue to maintain that stance that if you have a lump sum pot today and you really want to tranche it out, then I think 6 months is the ideal horizon, ideal time tenor that you should tranche it out. At best 12 months and at the least 3 months, but I would still suggest 6 months. That's to part number one. To part number two, should you be investing at these levels in a lump sum tranche or something? Yes, honestly, look, I think dips like these where Nifty corrects by over 1,000 points, a 5% correction in the market, these are rare days in the market, right? If you really have liquidity, a huge pot of liquidity which you're sitting on, then yes, 20% of that liquidity needs to go in the market at these levels if that is meant for risk allocation, if that is meant for equity allocation. So definitely yes, that money needs to go in at these levels. The third part, which was on the SIP front, you need to just relook at your SIP portfolio. You need to have a second look, a fresh look in terms of what allocations you are doing, what are the kind of schemes, what are the kind of market cap allocations, and the diversification which you have in your portfolio. By all means, try and increase the SIP allocations if you can. These are times when you accumulate more and more units in your portfolio, right? And try and increase the SIP by whatever amount, little proportion you can. And also try and see what is the proportion which is going. If it is less towards large cap, then yes, you need to align more in favor of large caps right now. If it is equally distributed, or if it is, let's say, there is nothing in mid and small caps. Let's say if the entire portfolio is large cap, just for hypothetical say, this thing, then you need to start a mid and small cap SIP because they've also gone through a serious wave of correction. Right? However, a new SIP portfolio, which is getting constructed today, to my mind, should be more tilted towards a large cap or a flexi cap allocation.
Okay. And the final question, which has to do with buying the dip, you mentioned that if you have liquidity available, then 20% can go right now. But a simple formula, because a lot of people wonder when to buy the dip. So if there is an asset allocation that you are following, something as simple as 60-40 or 70-30 or 70-20-10, 10 towards gold, then it is likely seen a big shift today and over the course of last week. Should you go out and simply correct that? And do you use incremental funds or do you use your fixed income and gold to shift to the other side?
Look, that's a very interesting question, Alex. Always incremental fund is better. In case you are sitting on a war chest, in case you're sitting on some dry gunpowder, then the first rule of asset allocation is that whatever asset has fallen in composition, let's say if you were following a 50-40-10 portfolio, which is equity, debt, commodities, and if equity is corrected from 50 to 45, then you beef up your equity allocation. If you don't have fresh funds and if you have to rejuggle within the same framework, then yes, by virtue of equity falling, the proportion of debt or commodities would have gotten up, or maybe because of gold rally, the commodity portion would have gotten up. So you need to trim down from portions which have got up, which have rallied in this rally, and then you need to allocate towards the one which are lagging. And that's so again, you could have a static asset allocation, or you can have a dynamic asset allocation, depending on what liquidity mix are you sitting at. But either ways, you need to have a relook on your portfolio.
Fantastic. All right, Mohit, thanks so much for joining me today. Pleasure speaking with you.
Thank you so much. Thank you.
All right, now, guys, we've also got the start of the new financial year to talk about. And ultimately, the new tax regime is something that a lot of you will automatically gravitate towards because it's simply better. But what are the aspects to focus on? How much tax will you be saving? And what are the do's and don'ts heading into the new tax year? Here's a conversation that I had with a tax expert. Joining me on this show is Parizad Sirwala, who is a partner and national head tax at KPMG in India. Thank you so much, Parizad, for taking the time, and pleasure speaking with you. Let's talk about how revolutionary this change in the tax regime has been, just to set the context.
Sure. So thank you for having me. And yes, we've just begun the new fiscal year, which is 1st April 25 and ended one of the earlier financial years, which is 24-25. The choice of personal tax regimes, as you mentioned, as we say, the old regime and the new regime does coexist, even for the year that just ended, which is March 25. But increasingly, if you see the announcements, even during the budget of Feb 1st that was announced, and going forward, it's the new tax regime which seems to be the default personal tax regime. And just to give you, just to start with some bit of statistics as per officially published data of the government, for individual returns which were filed last July, that is July 24, apparently 72% of the taxpayers have already migrated to the new tax regime. So let's just take a look at what are some of the unique features of these old and new tax regime. And daunting as it sounds to understand, few and far there are some differences. So first of all, in terms of the slab rates and the tax rates, so we did have an old tax regime and a new tax regime even for the year ended March 25, and it's been made more liberal for the current fiscal year, which is 25-26. As we speak, the first slab rate, which does not attract taxes, is increased even from 3 lakhs to 4 lakhs, even under the new regime, with effect from 1st April 25. And there are roughly now, 7 slabs with different tax rates. Above income of 24 lakhs is now a rate of 50% is against about 15 lakhs, which was there up to March 25. So if I were to just compare the progressive rates of tax with the slabs, even vis-a-vis the new tax regime, which was existing as of March 25, definitely there has been, some amount of improvement. That's one change. If I look at the old personal tax regime, of course, for every individual taxpayer, it depends on his or her personal facts and circumstances, investments, deductions made, so on and so forth. But the slabs itself are different from the old tax regime. So as an example, under the old tax regime, up to 2.5 lakhs of income, there is no tax. The first slab in the revised new tax regime is now 4 lakhs. That's the first thing on the slab rates. The second thing is that, the higher standard deductions for salaried income taxpayers. So you have 75,000 rupees, which is available in the new tax regime as a standard deduction, as against 50,000, which is under the old regime. We may discuss it a little later during our conversation, but we've also heard a lot about the rebate that is available in the budget announcement. And now literally for total taxable income of up to 12 lakhs per annum, you don't land up paying any taxes by virtue of marginal relief, which is under the new tax regime. Again, the threshold of income is up to 12 lakhs, which is 5 lakhs of income only.
Let me come in and ask you about that, because I think a lot of people will be confused about this, Parizad. The rebate exists, and it existed in the old new tax regime, if we can call it that, and it has been raised to 12 lakhs. So this is a major benefit. A lot of people will not have to pay tax on account of that. Now, if you calculate the standard deduction of 75,000 as well, what that means is that if your income is 12.75 circa or around that much, assuming that you have that standard deduction, it comes to 12 lakh, you won't pay tax because you get a rebate on that. But then if you do cross over with your net taxable income into say 12.1 lakh or 12.2 lakh, can you explain how that marginal relief works? Because my understanding is that if it crosses by 10,000 rupees, you would only have to pay 10,000 as tax, and that goes up to a certain level, right?
That's correct. So many people actually get this wrong in terms of the mathematics of calculating marginal relief. First of all, as a concept, what is marginal relief? It's a relief given to taxpayers only in certain circumstances to compensate for this incremental tax liability which arises when your taxable income is just marginally above the threshold. Now, this marginal relief or the rebate concept was always there under the domestic tax law. It's just that the threshold income at which it triggers has kept on changing. So under the old tax regime, it is still at 5 lakhs. Under the new tax regime, till March 25, it was 7 lakhs of income. Under the new tax regime, with effect from the fiscal year, which is the current year, from April 25 onwards, that threshold has gone up to 12 lakhs. Now, to your question, if you work out the maths, the way it's calculated is, if your taxable income annually is 12,10,000 rupees, your gross total tax liability roughly upon that, including before cess and surcharge, amounts to roughly to the tune of 61,500. And then the way the marginal relief is prescribed or the rebate is prescribed, you literally land up getting, you subtract the 61,500 from the 51,500. So you literally land up paying only 10,000 as your taxable income. So the way the maths works is that your excess income over 12 lakhs, your tax liability on total income, and if that is greater, then your relief is basically the difference between the two. As complicated as it sounds, the numerical, working of it is roughly up to 12 lakh of 70,000 rupees, as you said, is the break even, where your incremental tax liability would be barely 10,000 rupees. Above that, of course, your normal tax triggers it.
Okay, so you've explained this very clearly. Now it comes to the point where I'm asking about deductions, because this is a reason why, Parizad, a lot of people chose the old tax regime in years past. But as you've pointed out, already last year, I think people, when they did the math, they were surprised to find that the new tax regime was actually beneficial. Even though they thought that with HRA, with certain other Section 80C, Section 80CCD, Section 80D, with all of these deductions put together, they thought that the old tax regime was better. Is there a threshold that you have calculated to say that if you have deductions of this value, then in this year, the old tax regime is still okay?
Yeah, so once again, to reiterate, the choice of both the regimes exists even today.
Yeah.
It's very individual. But to your point, what are some of the things that are not allowed in the new regime at all? So your big ticket items are your rent payments. So for those who are claiming rental HRA benefits, or if you have a loss from self-occupied house property, then that's not allowed under the new tax regime. And as you said, all your popular Chapter 6A deductions of ATC, etc., 50,000, those are no longer available. But yes, a rough and ready working of the break even to your question, and I have the numbers out here. If I do the break even for the current fiscal year, which is from 1st April 25 onwards, then on an annual income, and I'll give you some ranges, on an annual income of 16 lakh plus, only if your deductions as per your old regime, including standard deduction, is as high as 6.5 lakhs per annum. So if you're a person who's having deductions or exemptions 6.5 lakhs and above, only then will the old regime be beneficial to you. Otherwise, clearly you're more benefited if you move to the new tax regime because of the liberal slabs and the liberal tax rates there, and so on and so forth, depending on the threshold of income. I'll just give you of income. So if you're an annual income of 24 lakhs, then the comparison between the old and the new regime, again for this fiscal year, which is April 25, if you have deductions from literally 8 lakh plus, 8.3 lakhs plus per annum, which is a pretty high amount, only then will you benefit under the old regime. Otherwise, you're clearly better off under the new regime.
Yeah, and you'd have to be stubborn. You'd have to be stubborn to try and push those deductions, Parizad, all the way up to 8 lakh. It may be detrimental at that stage to try and still go to the old tax regime because really the advantage is in the new tax regime is giving you more money in your hands. But there are deductions still available in the new tax regime. I want to talk to you about one of them in particular, and that's the National Pension Scheme, which is available. Yeah. Can you explain that, and what are the limits in that deduction available?
Sure. So first of all, I just reiterate, Alex, that every individual's fact pattern is different. So yes, as a general rule, optically it does seem that the new tax regime is beneficial, but there are a few items like rent and other stuff that if you're claiming those deductions, your old regime will still be beneficial to you. Coming to the NPS, as you said, which is some of the key highlights. Of course, contributions are made to the new pension system. The employer, it is a scheme governed by the pension fund and regulatory body. It can be opted for on a voluntary basis by the employer and the employee, a retirement benefit avenue as well. And the eligibility is basically anyone who's in the age group of 18 to 70 years is eligible to contribute towards this scheme. Now, there is something called a Tier 1 account, which the employers contribute, and the minimum pension amount is around some 100 rupees per month, and maximum can be, INR 500 per month is the minimum contribution. Now, a lot of it, withdrawals are also linked to the age demographics of the contributor. But just to give you the perspective on the tax benefits on this scheme, the employer contribution up to 10% of the basic salary is allowed as a deduction to this NPS. It's under the old regime, and if you're under the new regime, then employer contribution up to a higher amount of 14% to the NPS is allowed. Then 60% of the total corpus is received as lump sum at the time of exit. That is also exempt from income tax under the provisions of the domestic tax law. You can also get a partial withdrawal on completion of 3 years of up to 25% of the contribution amount. That is also exempt as per the provisions of the Income Tax Act. The employee contributions, there was an extra deduction of 50,000, which you get only if you're under the old regime, not under the regime.
One specific point that has occurred to me that I've also come across is that if you have a certain amount of money that you're paying as rent to your landlord or landlady, and if it is above a certain amount of money, can you be asked by a tax authority why you have not been collecting tax deducted at source? And what would you need to bear in mind from that respect?
So those are separate TDS provisions, I think you mean, that any payer of rent to a resident landlord has to deduct TDS above threshold rents of 50,000. So it's a compliance obligation that applies even to individual payers. And you cannot pay the gross rent to the landlord. You have to deduct the requisite taxes, deposit them into the government treasury. And there are compliance obligations and, forms that are required to be filled. So if you're paying rent, you have to take care of those obligations as well above a particular threshold. But those are separate TDS obligations under the law.
Just to follow up to that, because a lot of people, and Pariza, this is my last question, is that a lot of couples tend to pay rent as well, right? So if you're splitting your rent and if you're claiming your HRA benefits based on the half of the rent that you're paying, do you still have to do that TDS? For example, let me give you an example. If you're talking about 75,000 rupees, which is split equally, and so therefore you're not crossing that 50,000 rupee threshold individually, do you still have to calculate TDS?
So individual payer so it depends on how the agreement is also structured. So the rent payment for individual taxpayer above a particular threshold attracts TDS, and there are lots of others around this dual payments of rent, even from an HRA exemption perspective and a TDS perspective. But rent exceeding a particular threshold for an individual taxpayer attracts TDS withholding obligations.
Fantastic. Thanks so much for joining me, Pariza, this show. It's been an absolute pleasure speaking with you. All right, that brings us to the end of this edition of Your Money Matters. Thanks so much for watching. Do stay tuned. This is NDTV Profit.
No, basically, see, all said and done, as I keep saying, that one should not go by what we recommend on the stock specific basis, because markets are going to remain choppy and volatile, and every day is a new learning, every day there is a new event. Luckily, market gave very good opportunity on I would say Thursday, when markets were steady and not falling much, and Friday opening was also only 60 points down for the Nifty, where we raised a lot of cash. Luckily we raised around 13.5 to 15% cash in the portfolios, and that will put to work slowly and gradually after today's fall.
So, so are you saying that you will start deploying?
Yeah, a little bit, gradually.
At about
and that's what I always do, because in a falling market like this, and where this will end, actually nobody will know, right? But I would agree with Mr. Ramesh Damani's statement that over next 2 weeks or 3 weeks maximum, something will happen. And Trump will claim victory, and things will start to reverse. So things cannot continue to fall all the time. So we have to deploy very gradually, slowly.
Hello and welcome to our special programming on US tariff wars. What does this mean? Because stock markets across the world are falling on the back of Trump's tariffs and increased fears that the world's largest economy, the US, could go into recession. In fact, some experts say invest in the markets now since the valuations are cheap. Others say sit tight on the sidelines and wait for this to play out. Yet others say that you should move your money out of equities. Now, in this confusing situation, it is natural for investors in India to be worried about what they need to do to safeguard their money. Uncertainty is perhaps the most difficult scenario to tackle, and because no one really knows what's going to happen, there are estimates and guesstimates galore. At NDTV Profit, we're asking the questions that many of you have and provide you with sound, recent advice from the best of the experts. For many of you, this is probably the first market fall you're witnessing. Panic will not help you in any way, so we urge you to keep calm and weather the storm and keep watching NDTV Profit to get the best advice on how to be resilient in these trying times. In fact, we will get you market voices who tell you what to buy, what to hold tight, and what you should be doing. First up, we have the focus that's coming in terms of domestic consumption theme for the next 2 quarters. And this is what market expert Nischal Maheshwari said on the current market situation. He added that there's no point in selling in the kind of market that we are in. Let's listen into a bite of that conversation.
Yes, it's been a turbulent morning, basically. Yes. At the moment, I think...
you avoid selling as well is a question.
So it depends upon basically whether it's been selling because there has been some margin calls. If there is no margin call, I don't think so at this point, basically, not only trend, but anything. There is no point in selling in this kind of a market. The markets are very low. I think some sane sense is going to come back to this market, and maybe you will get better rates basically to sell. So there is, I totally agree with you basically that there is no point on actually going out and panicking and selling at these levels. Yes, you may still see lower levels than this. That's what I'm saying. I'm not sure basically how low it can go, but there is no need to panic at the moment because I'm saying, yes, conditions are bad. And but what my thought remains to be that cooler heads will come to the table and things are going to work out, not at pre-tariff levels, but definitely somewhere in between the pre-tariff and the level of tariffs which the Trump administration has put. So across the world, I see maybe there is going to be some giveaway, mostly a 10%, which was the base level of tariff, and some percentage above that. But then it is much better than what we are today. So that's why I'm saying basically just cool off and see for the next 2 weeks how this market comes, and then only whether you want to buy or sell, then only take a call.
Okay, and Mr. Maheshwari, if you wait for 2 weeks and we see a significant dip in the next 2 weeks as well, any counters that you would want to enter into and see that these counters are now looking attractive where valuations are concerned? And will those bets be domestic play bets?
Surely, I think last week itself, basically, I think it has become clear that you have to focus on the domestic companies for the at least next 2 quarters. And beyond the next 2 quarters also, I believe the Indian economy is going to revive. I think the government is taking enough measures, whether it is the rate cuts. I expect another rate cut to happen in another couple of days. Then there has been an income tax cut. So I think all those things, measures which the government is doing basically will show up in the second half of the current financial year. So that's why you are saying basically that at least for the next 2 quarters, wait out, and thereafter basically we are going to see earnings coming back, maybe some amount of earning upgrades also happen in the second half. So better economic sense will prevail.
Nischal, if we're talking about, and your point is well made, right? Because if you're talking about announcements that the Chinese government is already making to focus on domestic growth, you'll have European leaders that are talking about, hey, don't invest in the US, questioning whether or not it makes sense and saying double down on investments in Europe. So if all of these geographies, and I take your point to say that perhaps a common ground will be found on trade, but once bitten, twice shy. If you're dealing with the US administration, you'll have a lot of administrations around the world that will double down on domestic growth. And so from that perspective, for the Indian investor, what areas do you see? For example, financials have been relatively resilient. And in order for domestic to grow, you need financials. Similarly, you would talk about cap goods, you would talk about power. What are the places that you would look at and say there is value here?
So I think financials definitely as a sector basically has got good value, and it's not performed for the last 3-4 years. So I think the outlook seems to be good for the financials. If we have another rate cut happening, which is most likely to happen, I think it is going to be favorable for the whole financial sector. So financials is one. I would for the moment still wait out to see whether the consumption is coming back or not. Because there, I think with these kind of numbers, there are question marks. FMCG, it's a very mixed bag. There are a couple of companies saying yes, others are saying no. So really, I think one should wait out for the consumption sector. Government spending is another definite thing happening. Government spent around 12 lakh crores last year. I think similar number is happening this year also. So I think there you should be looking at industries like cement. Steel is a global commodity, so avoid it for the moment because you don't know if there is a tariff war between China and US. So China has to find newer markets to dump their steel. So India could be one of them. So avoid steel or metals for the moment, but cement is one basically definitely you should look at. The other ones basically capital goods to an extent. But capital good one has to be very clear saying that it's not the companies which are exporting because India has a large capital good export to the US also. So one should be very careful where we are investing.
In fact, Kotak AMC's Nilesh Shah also echoed Nishchal Maheshwari's opinion and said that domestic-focused companies will stand out in this storm. Let's listen into that conversation.
Today, we don't know what President Trump will do. His actions have been fairly unpredictable. We would have never guessed on political side he'll say Canada should become 51st state of US or Greenland should be given to us. On the commerce side, we would have never assumed that he'll be levying tariff as trade deficit with America divided by exports to America. But this is the world in which we are living in. Do remember that the objective of President Trump is appropriate. Even mighty US, the world's biggest, most strongest nation, cannot afford fiscal deficit at 6 to 7% year after year. It cannot afford current account deficit at 3.5% of GDP year after year, despite having reserve currency. The debt to GDP ratio at 125% with unfunded pension liability, clearly they needed to tackle. The objectives are right. The process has been fairly difficult to understand, and which is why this uncertainty is likely to persist. The process which they are following, it will create lose-lose situation for US as well as the globe, and hence there is little hope that it might get reversed before it is too late. In the order itself, there is a clause 4 which says that America is open to negotiation. Vietnam, which allowed China to use their base for manufacturing or actually assembling and exporting to US, has already announced that will make zero tariff. So there will be negotiation, and that's the hope. But clearly that uncertainty is likely to persist as President Trump remains fairly unpredictable.
Nilesh bhai, so can it happen that because of this uncertainty prevailing, and who knows, it could last for a better part of 2025, can we see illogical prices on the downside in asset classes as well? Because everybody's saying that Indian economy doesn't get impacted, but the uncertainty may still bring market valuations much lower than maybe long-term averages too, right?
Undoubtedly,
can it happen?
But markets can remain irrational more than you can remain solvent. While this phrase is used mainly for shorting side, it can be true even on long side. If you are taking leveraged position, you may think today X is the fair value, but with a policy change, X minus something can become fair value, and hence markets will have to make adjustment. Anyway, markets are always trying to forecast future. As of today, we don't know what kind of tariff will be there on pharma products. Who will bear the burden, manufacturer or the distributor, which has disproportionate margin? But yet market is going to take pharma stocks down, assuming that tariffs will be levied as irrationally as it has been levied on other products.
Got it. Nilesh bhai, just pure domestic plays. So I mean,